Welcome everyone to the lesson. The subject is known as communication skills. The topic is a new one, namely group and team communication. This topic has 5 sections. The first one is group communication networks. Number 2, team communication. Number 3, communicating in virtual groups and teams. Number 4, meetings. Number 5, conferences and symposia. In today's session, we are going to study the first section, which is group communication and networks. Group communication networks. Group communication networks. That is our area that we are going to focus on today. So by the end of this lesson, should be able to explain various group communication networks. Now, candidates, let's first define group communication. Now, group communication, just as the name suggests, it takes place when there are more than 2 people involved. If you have minimum of 2 people communicating, then you say that is group communication. It takes place where there are more than 2 people involved in communication. The number of people will be small enough to allow each participant to interact and converse with the rest. So in a group communication, every member of the group has an opportunity to communicate. So the number should be small enough to allow everyone to contribute. Things like press conferences, board meetings, team meetings are examples of group communication. And unless a specific issue is being discussed, small group discussions can become chaotic and sometimes difficult to interpret by everybody. Group communication. So what are these group communication networks? We've defined group communication. How about communication networks? Group communication networks. Candidates, a group communication network or just communication network refers to the method in which employees pass on information to other employees in an organization. And communication can flow in a variety of directions within the organization. That is what we are referring to as internal communication, and can flow between also organizations. Information can flow within a company where, for example, a finance department communicates with the, say, sales department internally between employees. Information can also flow between the organization and its constituents, between the organization and external organizations. Now, candidates, in an organization, members contact each other. And the pattern of contact and flow of information is what we are referring to as communication network. Discuss 3 communication networks. 3 communication networks. The first one is the chain network. Chain network. The second one is known as the wheel network, and the third one is the all-channel network. All-channel network. But let's first describe the chain network. Now, under this network, the chain network transmit members transmit members transmit the members transmit messages via one person at a time, via one person at a time. Members transmit messages via one person at a time. Members transmit, let me put down that, members transmit messages via one person at a time. Members transmit messages via one person at a time. And this is how that chain looks like. The members transmit messages via one person at a time. One person at a time. So if this member has a message, that message is transmitted to this member. Then this member again transmits the message to the next member, one person at a time. One person at a time. One person at a time. The formal chain of command is strictly followed. The chain communication network is known as the wheel network. The wheel network. The wheel network. Now, candidates, here under the wheel network, the leader plays the key role. The leader does what? Plays the key role. And how does the leader play the key role? Other members depend on the leader for group communication. What does that mean? That means that the members route communications to and through one part network, the wheel network. And this is how the wheel network looks like. That is the wheel network. The wheel network. The leader here plays the key role. This is the leader. All these members pass messages to each other through the leader. Here we have the leader. He plays a central role, the key role. Members depend on the leader. If this member has a message for this member, then that member here must wait for the leader to get the message from this member. If this member has a message for this member, then this member has to rely on the leader to get the message from this member. The leader does what? Plays the key role. Members route communications to and from the leader. To and from the leader. And this we have seen it in, say, in projects that require very close supervision. The projects that require very close supervision will use the wheel network, communication network. Members route message through wheel network. Wheel network. I've said that the wheel network, I repeat so that you remember. The leader plays the key role. Members depend, write it. Members depend on the leader for group communication. I've also said that members route messages to and from the leader. Members, the wheel network. Then let us see how the third network looks like. We are moving on to the all channel network. All channel network. All, this is number 3, all channel network. All channel network. Now, the all channel network may also be referred to as the circle pattern network. Circle pattern network. It's also known as the circle pattern network. Also known as the circle pattern network. Now, under this communication network, it allows, this network allows all group members to communicate with each other freely. It allows all members in the network, in the group, to do what? To communicate with each other freely. The circle pattern network or the all channel network allows all members in the group to communicate with each other freely. That means that every member talks directly to everyone. All right? Every member talks to each other freely. And this is how we can demonstrate it in a diagram. So you can see candidates. That is the all channel network. This member can communicate to this member, can communicate to this member, can communicate to this one here. So this member can communicate to this member, can communicate to this member, can communicate to this member, can communicate to this member. This one you can see communication is flowing in all directions. 1, 2, 3, 4. This one again you can 2, 3, 4. All members in the group can communicate with each other freely. It allows all members to do what? To communicate with each other freely. Just to recap what we have done today, candidates, we've introduced the chapter Group and Team Communication. We've defined communication networks. We have defined in our today's lesson group communication. We firstly defined group communication, then we defined group communication networks. We've gone ahead to describe 3 communication networks, 3 group communication networks. The first one is the chain network. We say that the chain, under the chain network, members transmit messages via one person at a time. This member cannot receive any message apart from this one. And this one has to wait for information to come from the first member. So we say that it strictly follows the chain of command, strictly. This member cannot communicate directly to this one. This member cannot communicate directly to this member or this member. This one has to wait for message from this member. This member has to wait for information from this member. This member has to wait for information from this one. And this one relies on the first member for messages. Members transmit messages via one person at a time. We've also described the wheel network. We said that the wheel network, the leader plays the key role here on the leader for group communication, whether it is relaying information or giving or receiving information. All members must wait for this leader for information. Members route communications to and through the leader, to and through the leader, to and through the leader. The wheel network. We also described the all-channel network, which we said is also known as the circle pattern network. We've seen how the information flows here. We've said that this network allows all members in the group to communicate with each other freely. Members can interact freely. Every member talks directly to everyone else in the group. And here, candidates, this network is mostly used where teams such as construction of projects, such jobs may rely on the all-channel network. Okay? Members can communicate with each other freely. So that will mark the end. Describe 3 group communication networks. Thank you for attending our today's lesson. I hope to meet you in our next lesson, where we continue to study more in relation to group and team communication. Bye-bye.
Hi candidates, welcome to another session of Manifested Online Classes. My name is Joseph Keman, your lecturer for Financial Reporting and Advanced Financial Reporting. So in this session, I want us to start on an important topic, and the topic is interest in other entities. So as far as this particular topic is concerned, we're going to look on 2 important subtopics. The first subtopic is the topic to do with the group accounts, or the presentation or preparation of the consolidated financial statements. And also later on, we are going to look on another important topic, or start by looking on what are group accounts, or basically what are consolidated financial statements, the presentation of the same, and also the various accounting standards which are applied during the preparation of the group account. So therefore, first of all, when we talk about the group account or the consolidated financial statement, these are those financial statements which are prepared by a parent entity which has some interest, or basically which has invested in other entities, of which now when talk about the parent entity, we can refer to it as the investor because it has invested in other entity, whereas now the other entities, we can refer to them as the investee companies, of which in this case we are going to look on a subsidiary. It can be an associate, it can be a joint arrangement, or basically it can be termed as what? As a mere investment. But maybe to start with, we can say that group accounts which are also known as the consolidated final accounts prepared by a parent entity. So the parent entity, in this case, we are referring to this as the investor, the parent entity, which has interest in other entities, which has some interest in other entities, and basically the other entities which the parent company has invested in, we refer to them as the investee company, or basically companies. So therefore, is a requirement that a parent entity or basically a parent company has to prepare the group account at the end of each financial year, and that is a requirement under the Companies Act and also under the various accounting standards. Now, in this case, when talk about the investee companies here, we have various types, and maybe you can just mention that. So we can say the investee company, or basically entity can either be, number one, we have a subsidiary. We have a subsidiary company. So when company has a control, or basically this is an investee company whereby the investor company has a control. And basically in this case we say that the parent entity has a control if it has acquired shares which lies between 51% to 100%. So therefore you can say that this is an entity. This is an entity controlled by the parent company. Controlled by the parent company. Remember, in this case, we are saying that the parent company here is the investor. So therefore, a subsidiary is a company which is controlled by the parenthood company. So basically, by saying that the decisions which are made by the subsidiary company are controlled by the parent company, and also on the other hand, the composition of the board of directors of the subsidiary company is controlled by the parent. So, and in this case, we have said that a company shall be regarded to be a subsidiary whereby the parent company acquires shares which lies between 51% to 100%. To 100%. So basically what that means is that if you come across a question in an exam setup and maybe you're told that A Limited here, for example, acquires shares or basically equity or ordinary shares of B Limited, and those particular shares lies between 51% to 100% of the ordinary shares or basically equity shares issued by B, then automatically B here will be the subsidiary company. This will be the subsidiary company, whereas A Limited will be what? Will be the parent. And therefore, what we are saying is that under the requirement of the Companies Act, that this particular company here, because it has a control over B, at the end of the year, it is required to prepare the group account or basically the consolidated financial statement. So we're going to look on how those particular group accounts are prepared at a later stage. But on the other hand, this particular investee company, we are saying it can either be a subsidiary. Number two, it can also be an associate. It can also be has something called significance inference. It is an entity over which the investor company has a significance inference. So therefore, you can say that this is an entity over which the investor company, remember in this case when we talk about the investor company, we are talking over the parent company has a significance inference, inference. And in this case, we say that an investor basically has acquired shares which lies between 20% to 49%. To 49 what? Percent. So mean that if, for example, we are told that A Limited acquired between 20% to 49% of the equity shares or ordinary shares issued by B Limited, then it means that A Limited here will be the parent company. This will be the parent company, whereas this will be the associate. So reason being that A Limited here will be having something called a significance inference. Significance inference means that A Limited do not have the powers to control the operating and financial decisions which are made by B Limited, but A Limited has the powers to influence, not to control, but rather to influence the operating and financial decisions now which will be made by B Limited, which is known as what? As the associate. So therefore, an associate is that particular entity over which the investor company or the parent company has a significant influence. On the other hand, the investee company can also be a joint arrangement, previously known as a joint venture. And basically, when we talk about a joint arrangement, we say that this is an entity over which the parent entity and another entity acquire something called a joint control. An entity over which the parent company and another entity, a parent entity and another a joint what? Control. What does that mean? It means that the parent entity here and basically another entity, they have acquired a 50% shareholding in that company, which is known as a joint what? Arrangement. Like maybe in this case, we assume that we are told that we have a company here which is called maybe a B Limited. We can be told that X Limited and also Y Limited, these two companies have acquired equal shareholding, or basically have acquired shares which are equal, that is 50% of the shares issued by what? By B Limited. So mean that if X Limited, Y Limited both acquire 50% shareholding of B Limited, then we say that these two companies, that is X Limited and Y Limited, they have a joint control, meaning that the operating and financial decisions now which will be made by B Limited, those decisions are jointly controlled by the two entities here, that is X Limited and also what? Y Limited. Therefore, this joint venture. So on the other hand, the investee company number 4, that is, can be a mere investment, can be a mere investment. So in this case, when we talk about a mere investment, this whereby the parent entity, or basically the investor company or the investor, has acquired shares which are less than 20% of the shares issued by the investee company. So therefore, here we can say that this is an entity over which the parent entity or the parent company, company, which is also known as the investor, holds less than 20%, of the issued equity shares, equity or ordinary shares. So mean that if, for example, you're told A Limited here has acquired shares which are less than 20%, that is 1% to around 19% of the shares issued by B, then we say that that investment by A in B is a mere investment. Is a mere what? Investment. And basically such a mere investment is then termed as a financial asset. And basically this one should be accounted for in accordance with the International Financial Reporting Standard number 9. So therefore, in this case, what you have said is that the group account, or basically the consolidated financial statement, as an investor which has some interest in other entities. In this case, we are saying that the other entities whereby the parent company has invested, then we have referred to them as the investee companies. Now, these investee companies, we are saying, can either be a subsidiary, can be an associate, can be a joint arrangement, or basically can be what? a mere investment. Now, in the first part of this particular topic here, we're going to look on how we prepare the group account or the consolidated financial statement, specifically whereby the parent company has invested in a subsidiary. But at a later stage, we're going to look on how the group account or the consolidated financial statement are prepared, whereby the parent company has invested in an associate, has invested in what? In a joint what? Arrangement. But when it comes now to a mere investment, this is not supposed to be covered at this particular topic here, but that is supposed to be covered in a different topic of a financial instrument, whereby as a candidate, you look on how a mere investment is supposed to be accounted for in accordance with IFRS 9, and equally you look on the various types of financial what? Financial asset and so on. So, but maybe you can start by, or before you look on how the group accounts specifically are prepared, I want us we define some key important terms, and then from there we look on some of the standards which are applicable during the preparation of the group account. So therefore, here we're going to start by looking on the invested in a subsidiary. So we start by looking on the preparation of group account, whereby we have an investment in a subsidiary, investment in a subsidiary. But even before we look on how those particular group accounts are prepared, first of all, we need to terms. Definition of terms. So some of the terms we need to define here include the term group. So basically when we talk about the group here, we are referring to a group of companies. So what is a group of companies? A group of companies basically, this refers to a parent company and its subsidiaries, the parent company and its what? Subsidiaries. So mean that if, for example, you have a parent company having like 2 or more subsidiaries, or even a single subsidiary, then the parent company and its subsidiary, all its subsidiaries, then we can refer to that as what? A group of companies. So therefore, you can say that this is a parent company and its subsidiary. To define here is the parent company, the parent company. Remember in our introduction, we have mentioned what is a parent company, which we have also referred to as the investor company. So we have said that this is a company which has invested or which is having some interest in other entities. So a company is deemed to be invested in other entities by acquiring shares. By acquiring what? Shares. But in this case, we can say that the parent entity, we can say that this is an entity an entity having a control entity over another entity, which is now known as a subsidiary, The other term we need to define here is the subsidiary, subsidiary. So when we talk about a subsidiary company, we can say that this is a company now which is controlled by the parent, the parent. So we say that this is an entity controlled by the parent, parent entity. Essentially, what you have said here is that a company will be controlled, or basically a parent company will be controlling another entity, whereby the parent company holds or has acquired shares which lies between 51% to 100%. 100 what? Percent. Meaning that the parent company is in a position to control the complete of the directors of the subsidiary company. And number 2, we have said that the parent company is the one which controls the operating and financial decisions made in the subsidiary company. And therefore, we are saying generally, a parent company will be having a control over a subsidiary if the parent company acquires shares lying between 51% to 100%. So, and then from there we can also define the other term here, number 4, and that is the business, the term business combination. a business combination. So when talk about business combination, this is the transaction through which the parent entity acquires control over the subsidiary. For example, in this case, if we are told that A Limited here maybe acquired like 80% of the ordinary shares or equity shares of B on 1st of January 2024, that particular date when A Limited acquired majority of the shares in B, then we refer to that transaction as a business what? Combination. That's why we are saying a business combination here is a transaction through which the parent entity acquires a control. A transaction in which the parent entity acquires control over subsidiary company. So the other term, number 5, is a non-controlling interest. Interest, which is abbreviated as NCI, So what do we mean by NCI, non-controlling interest? So basically this refers to the shares issued by the subsidiary company and which are held by the minority shareholders. Like in this case, let's assume that you're told that A Limited here acquires 80% of the shares issued by B Limited. So it basically means that A Limited here will be the parent company, because you can see the parent company controls, or A Limited controls B, and then we have now the remaining 20% of the shares which are issued by B Limited. So those 20% of the shares issued by B, then in this case we say that they are held by the minority shareholders. So why do we refer to these other shareholders as the minority shareholders? Generally, we know that in a company, decisions are made by the majority shareholders. So therefore, those shareholders who hold just 20% of the shares issued by the subsidiary, they cannot control the operating and financial decisions made by the subsidiary, that is B Limited. They do not have now the powers to control the composition of the board of directors of what? Of B Limited. So therefore we say they have some interest in B Limited, but their interest is a non-controlling. They can't be able to control operating financial decisions, and also even they cannot be able to control the composition of the board of directors of B Limited. So therefore we say NCI that these are shares, and specifically we are talking of equity shares. These are equity shares issued by subsidiary company, not held by parent company, not held by the parent entity, not held by the parent what? Entity. So therefore, shares issued, or ordinary shares issued by the subsidiary company, not held by the parent company. In other terms, we can say that these are those particular shares which are issued by the subsidiary company and which are held by who? The minority shareholders. So therefore, the interest of the minority shareholders in a subsidiary company, we refer to it as NCI, non-controlling what? A non-controlling interest. So therefore, these are basically some of the terms you need to know. As far as the investment in a subsidiary is concerned, you need to know what is a group of companies, which you have said is a parent and its subsidiaries. The parent company you have said is a company having a control over the subsidiary. Subsidiary company you have said is a company controlled by what? By the parent company. And also we have said that that transaction through which now the parent company acquires a majority of the shares in the subsidiary, that transaction we refer to it as a business combination. And also here we have also been able to define the NCI, non-controlling interest, which you have said these are shares in the subsidiary, shares issued by the subsidiary, but which are held by the minority shareholders. So I want us to stop at that particular point. So once we come back in our next session, I want us to look on some of the accounting standards which are applicable during the preparation of the group account or the preparation of the consolidated financial statement. And then from there, we look on some of the specific standards, starting with IFRS 3. We see what IFRS 3 says, and then from there, we proceed to the other standards. So therefore, see you in the next session. Hi candidates, welcome to another session of Manifested Online Classes. So we are still soldiering on with the topic of group accounts. So in this session, I want us to look on specific standards which are applicable during the preparation of group accounts. Remember, in our first lesson, we were able to define what are group accounts, and basically we said group accounts are supposed to be prepared by the parent entity which has interest in other companies or in other entities. And we were also able to define various terms like what is a group of companies, what is a parent entity, what is a subsidiary, and so on. So in this particular session, I want us to look on various accounting standards which are applicable during the preparation of the group account, and then from there we can go ahead and basically look on some of those particular standards, including IFRS 3 and so on. And therefore here we can say that the following accounting standards are applicable in preparation of group accounts, preparation of group accounts, preparation of group accounts. So number one, we have issue to do with the business combination. Combination. Number two, we have IFRS 10. These relate to preparation of consolidated financial statement whereby the parent company has invested in a subsidiary. Investment in a subsidiary, how the parent company should prepare the group account whereby it has invested in a subsidiary. So then we also have another standard which is applicable, that is International Accounting Standard number 28. So this deals with the investment in associate and joint venture. So how to prepare the group account whenever the parent company has invested in an associate or a joint venture. And then the other standard which is applicable here is International Financial Reporting Standard number 31, which basically deals with in a joint arrangement. So therefore, these are some of the accounting standards which we are going to come across in this particular topic, specifically during the preparation of what we refer as the group account. So I want us to start International Financial Reporting Standard number 3, IFRS 3, and this deals with the business combination. Recall that this is a term we defined in our first session, and we said that a business combination is that particular transaction or even the events through which now the parent entity acquires control over the subsidiary. So mean that whenever the parent company here, the parent company has invested, or in other terms has acquired a subsidiary company, that particular transaction itself, we refer to it as a business combination. So according to this particular standard here, that is IFRS 3, it requires that once the parent company has invested or basically acquired a subsidiary, On the date of acquisition, the parent company should determine whether that particular subsidiary has been acquired at a goodwill or something called a gain on bargain purchase. A gain on bargain what? A purchase. And therefore, this particular standard here has gone further and basically prescribe some rules regarding the computation of goodwill, or basically has outlined the various methods to be used by the parent company in computing or basically determining the goodwill arising from the business what? Combination. But even before we look on the computation of the same, we can say that IFRS 3, parent entity, the parent entity to determine goodwill arising from business combination on the date of acquisition, and this particular date of acquisition here, this one we abbreviate it as DOA. That is the date of acquisition. Date of what? Acquisition. So therefore, on the date the parent entity or the parent company has acquired a subsidiary, the parent company should determine whether that particular subsidiary was acquired at a goodwill or something known as a gain on bargain what? Purchase. And before we look on how we determine this particular goodwill arising from business combination, first of all, what is goodwill? We need to define what goodwill is. So when talk about the goodwill here, the purchase consideration which will be paid by the parent company and the net assets which have been acquired. The difference between purchase consideration paid by the parent entity and the fair value of the net assets which have been acquired. So therefore you can say that this is the difference between purchase consideration paid by the parent entity and fair value of net assets acquired. So in this case, it is obvious that once the parent entity here has acquired majority of the shares in the subsidiary, the parent company must pay for those particular shares. So the amount of money which has been paid by the parent company, that amount we refer to it as the purchase consideration. For example, in this case, if we are told the parent company acquired 80% of the shares issued by the subsidiary company, we can be told that the parent company, for example, paid 100 million for the shares now which were acquired. So this 100 million is what we refer as a purchase consideration. So any difference between what has been paid and the net asset which have been acquired by the parent company, that difference is a goodwill, or it can be a gain on bargain what? A purchase. Now, this particular standard here, IFRS 3, we are saying, it outlines how that goodwill should be determined, and also it outlines the two methods the parent entity should be able to use to compute the goodwill arising from the business what? Combination. So therefore, in this case, we can say that there are of determining two methods of determining the goodwill arising from business combination, the full goodwill method, and number two, we have the partial goodwill method. So two methods, the full goodwill method and the partial goodwill method. So let's start full goodwill method. So under this particular method here, that is a full goodwill method, we compute the goodwill attributable to both the parent entity and also the non-controlling interest. So we can therefore say that the goodwill determined under this method is attributable to both parent company and NCI. So you have to recall that when talk about the NCI, we are talking of the minority shareholders. Like maybe in this case, what I've said is that if we are told that the parent company acquired 80% of the shares issued by the subsidiary, it means that the remaining 20% of the shares issued by this company, those shares are held by who? Minority shareholders. And we have said the interest of the minority shareholders, we refer to it as the non-controlling interest. So therefore, what you are saying is that under this particular method here, that is a full goodwill method, the goodwill which is computed or determined is the goodwill attributable to both the parent company and also the NCI. And then the NCI. So how do we compute this particular goodwill under the full goodwill method? So let's look on how we determine this particular goodwill. We refer to it as a goodwill on acquisition, or in other terms, we can just refer to it as the goodwill arising from business combination. So in this case, we need to have two columns here. So always we start with the purchase consideration. Paid by parent entity. Parent entity. When the parent entity acquired its shares, or for example, in this case, when the parent entity acquired 80% of the shares in the subsidiary, how much amount was paid by the NCI at fair value? So what is NCI at fair value? NCI at fair value in very simple terms, this is a purchase consideration paid by the minority shareholders when they acquired their 20% or when they acquired their shares in the subsidiary. Mostly this figure will be given to you by the examiner. The examiner will give you the NCI at fair value. That figure is not given because there are some instances whereby the examiner will not give you that. There is a way how we compute it. That is how we compute it, because what you just need to do is to determine the shares acquired by the minority shareholders here. If, for example, this company has issued like 1 million shares and the parent company acquired 80%, it means that the minority shareholders then acquired 20% of these shares, 20% of 1 million. So that gives you the shares acquired by the minority shareholders, and then what you do, you multiply those particular shares with their fair value. The fair value of the shares is the market price, because when buying the shares in a company, you pay a price equivalent to the fair value, a price equivalent to the market what? A price. So therefore, if that value is not a minority shareholders here, multiply that with the fair value per share. And then to this, add the two values, then you proceed and you less a fair value of net assets, net assets acquired. Now, this is something else which in most of the cases the examiner will not provide, and if this figure is not provided to you, or is not, you are not given this particular figure by the examiner, there is how we compute it, because what we want to determine here is the net assets which were acquired by the parent company and the minority shareholders in this particular subsidiary. So if that figure is not given, how do we compute this then? So number one, we take the subsidiary company. Ordinary share capital, and then to this we add the subsidiary company pre-acquisition reserves. So what do you mean by pre-acquisition reserves? When talk about the pre-acquisition reserves, we are talking of the reserves which the subsidiary company was having at the date of acquisition. And actually, when talk about the reserves of the subsidiary, we are talking of things like the share premium, things like the revaluation reserve, things like what he far as what maybe general reserves and so on. So therefore, you check which reserve the subsidiary company was having at the date of acquisition. You take them into account here, and then you add all of you add that now to the subsidiary company ordinary share capital, and then because you are interested with the net asset acquired by the parent and also the NCI, so what you do, you take 100% of this, 100% of that. So 100% of the figure which you'll get there, you take it to the last column here, take it to the last column, and then you less it from the total amount which you have up here. So here you can get a positive figure. So if you get a positive figure, we say that that is goodwill arising from acquisition, but there are some cases whereby you can get a negative figure. So if you get a negative figure, previously that was known as a negative goodwill, but currently that one we refer to it as a gain on bargain purchase, a gain on bargain purchase. So a positive figure we are saying is a goodwill, whereas a negative figure there we are saying is a gain on bargain what? Purchase. So therefore, this is how we compute now the goodwill arising from acquisition using the full goodwill method. Number one, you have said we take the purchase consideration paid by the parent company, and then to this we add the NCI at fair value, which may be given or some cases may not be given. If it is not given, I've explained how we compute that. Then get the total, and then to this you proceed, you less the fair value of the net asset acquired by both the parent and also NCI. Remember here we are interested with the goodwill of the parent and also the goodwill of what? Of NCI. So that's why we are saying you less the net asset acquired by both the parent and NCI. And actually you can see, that's why you can see here we are taking 100% of the net asset of this subsidiary, because we're interested with the asset acquired by the parent, the asset acquired by who? NCI. Take 100%. So you less that from the figure which we have up there. If you get a positive figure, is a goodwill. If you get a negative figure, is what? Is a gain on bargain what? A purchase. It's also important here to mention that a goodwill which arises from the business combination, this particular non-current asset by the parent entity. So mean that when the parent entity is preparing the consolidated statement of financial position, this one will be recognized as an asset, and then IFRS, not IFRS, but rather IAS 16 requires that the parent entity at the end of each year should basically determine whether this particular goodwill has done what? Has impaired. So therefore you can say goodwill is recognized as an asset in the consolidated statement of financial position, in the consolidated balance sheet, and reviewed for impairment on annual basis. So being reviewed for impairment, what that means is that the parent entity, or basically the parent company, at the end of each year should basically determine whether the value of the goodwill has reduced. So if the value of the goodwill has reduced, then that reduction in the value of the goodwill is in the consolidated statement of financial position. Maybe also we can mention that here, and we say any reduction in the value of goodwill, which now is an impairment loss, which is an impairment loss, is recognized as administrative expense in consolidated income statement. Consolidated income what? Statement. So therefore, it's very, very important that this particular goodwill is recognized as a non-current asset in the statement of financial position, and also reviewed for impairment on annual basis. Any reduction in the value of the goodwill, then you are saying, is recognized as administrative expense in the consolidated income statement. What about this particular gain on bargain purchase? Now, when talk about a gain on bargain purchase, basically this means that the purchase consideration which was paid by both the parent and also NCI in acquiring the net asset or in acquiring the shares of the subsidiary company was less than the net asset which were acquired. Basically what that means is that the minority shareholders, the parent, acquired the subsidiary at a profit. That's why we are referring to that as a gain on bargain purchase. And this particular gain on bargain purchase, according to IFRS 3, it should then be recognized as an income in the consolidated income statement. So therefore, you can say so that a gain on bargain purchase is recognized as an income, or basically as part of other incomes, is recognized as an income in the consolidated statement of a profit or loss. Immediately or at the end of the year, this particular gain on bargain purchase will be recognized as an income whenever the parent entity is preparing the consolidated income statement. Here, that is the partial goodwill method. So under this particular method here, goodwill which is computed is attributable to the parent entity only. So in other terms, we can say that under the partial goodwill, that goodwill does not include the goodwill of what? Of the NCI. So therefore, you can say under this method, the goodwill determined is attributable to parent entity only. So we determine the goodwill attributable to the parent entity only. So how do we determine the same? So let's look on how we compute this particular goodwill here under the partial goodwill method. So we look on how we determine the goodwill on acquisition using the partial goodwill method. So equally here we need to have two columns. So we start with the what? We start with the purchase consideration paid by the parent entity. Purchase consideration paid by the parent entity, or basically the parent company. And then to this we less the fair value of net assets, a parent entity, acquired by parent entity on bargain purchase. And in this case, I've explained how we account for this, because I've said that any goodwill arising from business combination will be recognized as an asset in the consolidated statement of financial position and then reviewed for impairment on annual basis. And any deduction in the value of the goodwill is equally recognized as an expense in the consolidated income statement. And then you have said that this particular gain on bargain purchase will be recognized as an income in the consolidated income statement. So therefore, these are the two methods which are used by the parent entity in determining the goodwill arising from the business combination. But mostly, once you come across a question in an exam setup, the examiner will not tell you specifically which method to use, either the full goodwill or the partial goodwill method, but mostly you will come across some statement in the additional information you'll come across a statement in the additional information. For example, number 1, you can be told that it is the group policy, it is the group policy to measure NCI, that is non-controlling interest, at fair or full value, in which case the examiner will proceed and further give you something called the NCI at fair value. So if you come across this particular statement in the additional information, it means that when computing the goodwill here, you are going to compute the goodwill using the full goodwill method. So if you come across a statement that it is a policy of the group to measure the NCI at fair or full value, in which case the examiner has also provided you the NCI at fair value, compute the goodwill using what? The full goodwill method. Alternatively, you may come across information, or you may be given some information by the examiner that it is the group policy, to measure NCI at the proportionate share of net assets, net worth asset. So if you come across this particular statement here, 1, the examiner will not give you what you refer as the NCI at fair worth value, and therefore by nation, then you use the partial goodwill method. So therefore, this is very, very important, because now this is the information which you'll come across in this particular question for group account, and this is the information which should guide you how to compute the goodwill arising from the business combination. So you can use either the full goodwill method, but if you come across this particular statement that is a policy of the group to measure NCI at fair or full value, and the examiner will further provide you that information, will give you the NCI at fair value, which then you need to use there. So alternatively, you can be told is a group policy to do what? To measure NCI at their proportionate share of what? Of the net asset, asset. So therefore, that basically what you need to know as far as IFRS 3 is concerned, the computation of goodwill, what is goodwill, and the various methods which are used in the computation of goodwill, the full goodwill method, the partial goodwill method, and actually how we compute those particular goodwill, in which case you have said that any goodwill arising from a business combination is recognized as an asset, actually a non-current asset in the consolidated statement of financial position, and then on annual basis it must be reviewed for impairment, and then in case there is a gain on bargain purchase, we have said that one is recognized as part of other incomes in the consolidated income statement. So I want us to stop at that point. So once we come back in our next session, we're going to look on some illustrations regarding the computation of goodwill using the two methods here, the partial goodwill method and the full goodwill method. So see you in the next session. Hi candidate, welcome to another session of manifested online classes. So in this session, I want us to look on some illustrations regarding the computation of goodwill arising from business combination or arising from acquisition. Remember in our previous session, we defined what is goodwill, and also we looked on the two methods which are used in the computation of goodwill arising from business combination. The first method was the full goodwill method, whereby we said the goodwill computed is attributable to both the parent entity and also NCI. We also looked on method number 2, which is called the partial goodwill method. And under that particular method, we said that the goodwill determined is attributable to the parent entity only. So in this particular session, I want us to look on an illustration regarding the computation of the same. And we go through that particular illustration. It reads, on 30th of April 2024, H Limited acquired 80% of 5 million ordinary shares of shillings 10 each in S Limited, paying shillings 100 million cash. On that date, the fair value of S Limited net asset was shillings 75 million, and the fair value of the company's ordinary shares was shillings 20 each. So what are we required to do? Part A, calculate the goodwill arising on acquisition using Roman 1, partial goodwill method, Roman 2, full goodwill method, and then in part B of that question we are told, assume that the goodwill determined in Roman 2 above, that is the goodwill determined using the full goodwill method, was impaired by 9 million as at the end of the year. Show the allocation of the impairment loss to the parent and also the non-controlling interest goodwill. So this is basically an illustration whereby we are required to compute now the goodwill, and anytime you come across a question for group accounts, the first thing you need to do as a candidate is to come up with a group structure. So basically a group structure is a form of a chart whereby you'll be having now the parent company shareholding in what? In the subsidiary, and also in your group structure, you must incorporate something called the date of acquisition. That is the first thing we need to do here. Remember, this is an illustration regarding computation of goodwill. So the first thing we need to do here is to come up with the group structure. I've said that this is a chart which shows the parent company. April 2024, the company which is called H Limited acquired 80% of the 5 million ordinary shares of shillings 10 each issued by the company which is called S Limited, and this acquisition took place on 30th of April 2024. So basically what that means is that from this group structure, then H Limited here will be the parent company, whereas S Limited will be the subsidiary. Remember what you have said is that IFRS 3, International Financial Reporting Standard number 3, requires that the parent company on the date of acquisition should determine the goodwill arising from the business what? Combination. And actually we have said that that goodwill arising from business combination is always determined on this particular date of acquisition, and it can be determined using either the full goodwill method or the partial goodwill method. So what we are required in part A of that particular question is we calculate, or basically we compute the goodwill arising on the acquisition, and Roman 1, we are required to use the partial goodwill method. We are required to use the partial goodwill method. So under the partial goodwill method, here we have said that we compute the goodwill attributable to the parent entity only. And basically to do this, to compute this, we need to have two columns here. And also the figures which we are given there are in million of shillings. Million of shillings. So always we start with the purchase consideration paid by the parent. Purchase consideration by the parent company. And if we go back to the information which you're given, actually in sentence number 1, you're told on 30th of April 2024, H Limited, which is the parent, acquired 80% of 5 million ordinary shares of shillings 10 each in S Limited, paying shillings 100 million cash. So the amount which was paid by the parent company was 100 million. And then now to this, what do? We less the fair value of net assets acquired by the parent. Net assets acquired by the parent company. or by the parent entity. So remember what we have said in our previous session is that in most of the cases, the examiner will not give you the net assets of the subsidiary company on the date of acquisition. And actually, we have said that if that figure is not provided to you, that is how you compute it. You take the subsidiary company ordinary share capital plus all pre-acquisition reserves of the subsidiary. But if you check on the information given in this particular question, in sentence number 2, we are told on that date, that is on the date of acquisition, the fair value of S limit of the subsidiary company net asset on the date of acquisition, which we are told they had a value of 75 million. But in our case here, what we are interested with, we're interested with the net asset which were acquired by the parent. So in this case, our parent company, that is H Limited, acquired 80% of the shares in the subsidiary, and that also means that our parent company, that is H Limited, acquired 80% of the net asset of S. So therefore, the net asset which were acquired will be 80% of this. And 80% of 75, that will give us 60 million. So we less that from the cost of investment or the purchase consideration. So we get a positive figure here, which is a goodwill, which is goodwill. So remember what you have said is that this particular goodwill, this one is recognized as a non-current asset in the consolidated statement of financial position. So that's how we determine the goodwill using the partial goodwill method. So Roman 2, we are required to determine this particular goodwill arising on acquisition using the full goodwill method. Recall, we say that under this particular method here, we determine the goodwill attributable to both the parent entity and also what? And also the NCI. And also the NCI. So we need to have 2 columns here. Figures and also in million of shillings. In million of shillings. So under the full goodwill method, number 1, we start by taking into account purchase consideration paid by parent entity or parent company, which we already have here, 100 million. And then to this we add the NCI at fair value. So NCI at fair value, I've said in very simple terms, this is the purchase consideration which was paid by the minority shareholders in acquiring their shares. Like in this case, you can see 80% of the shares issued by this subsidiary are held by the parent. What that means is that the remaining 20% of the shares, issued by S, these shares are held by minority shareholders, and we have referred to the interest of the minority shareholders as what? The non-controlling interest. So when the minority shareholders were acquiring 20% of the shares, how much amount did they pay? And that is what we refer as the NCI at fair value. Basically, I've said that in most of the cases, this figure will be given, or the examiner will give you this particular figure. But if you're not given that figure, for example, in this particular question here, we are not given the NCI at fair value. So if you are not given the NCI at fair value, I've said, the first thing we need to do is to determine how many shares are held by the minority shareholders in the subsidiary, and then multiply that with the fair value per share. For example, in this case, as per the first sentence, we know that the shares issued by S Limited were 5 million. The shares issued by S Limited were 5 million. So these are the shares issued by S. So what are we interested with? Shares held by NCI, shares acquired by minority shareholders, which will be 20%. So this will give us the shares acquired by the NCI. And then what we need to do is to multiply those particular shares with their market value or with their fair value on the date of acquisition. And actually, if you go back to the information which you're given, that is on the date of acquisition, the fair value of S Limited net asset was 75 million, and the fair value of the company's ordinary shares was 20 shillings. So basically, it means that on the date of acquisition, the shares of this company were trading at a price of 20. They had a market price of 20. So we multiply that with 20 shillings per share, and basically this gives us what? This gives us now the NCI at fair value, and basically 20% of that will give us 1 million. 1 million times times what? 20, which will give us 20 million. So we add these two figures, which will give us 120. And then now to this, what do we do? To this, we less the fair value of net assets, acquired. In this case, we are interested with the net asset acquired by both the parent company and NCI. So how do we compute this? So remember, in our case, we were told that on the date of acquisition, the fair value of subsidiary company net asset was 75 million. That figure is already given to us. So in our case, what we are interested with are the net asset acquired by the parent, net asset acquired by who? The NCI. And automatically, that should be 100%. That should be 100 what? %. So we get 100% of that, which will give us 75 million. So we less it from the figure which we have up there. This will give us 5, and then 11 minus 7, which will give us what? Which will give us 45. So this 45 million, this one we refer to it as the full goodwill. So the reason why you refer to it as the full goodwill is because this is the goodwill attributable to the parent company. Goodwill here, which we have determined under the partial goodwill method, we have said that this is a goodwill attributable to the parent entity only, or to the parent company only. But this is the goodwill attributable to both the parent company and also the non-controlling interest. So that is it. That's what was required in part A of that particular question. You determine the goodwill arising from acquisition using the partial and also the full goodwill method. And then part B of that particular question, it reads, assumes that the goodwill determined in Roman 2, that is the goodwill determined using the full goodwill method here, was impaired by 9 million at the end of the year. So what you are required to do is to show how that impairment loss will do in part B, is to allocate the impairment loss. So first of all, we have to recall that impairment loss, this is the decrease in the value of a goodwill. So anytime the value of goodwill reduces, because a goodwill is an asset, so that reduction in the value of the goodwill is an impairment what? Loss. Now, what we are told is that we assume that this particular goodwill here, determined using the full goodwill method, was impaired with 9 million. So the impairment loss is equal to 9 million. So how do we allocate this particular impairment loss to both the parent and also NCI goodwill? So the amount now, or the amount of impairment loss, which will be allocated to parent company goodwill, this is equal to the full amount of impairment loss, which is 9 million, times the parent company shareholding in the subsidiary. So recall that the parent company shareholding in the subsidiary is what? 80%. So we get 80% of this, which will give us 7.2 million. That is the amount of impairment loss to be allocated to the parent company goodwill. And then we also show the amount of impairment loss to be allocated to the NCI goodwill. Which will be equal to the full amount of impairment loss, 9 million, times the percentage NCI. Percentage NCI here we are talking of 20%. So this will give us what? This will give us 1.8 million. 1.8 million. So therefore, this basically how we compute the goodwill using both the partial goodwill method and also the full goodwill method. In case there is any impairment loss, which is basically a reduction in the value of goodwill, we have said that that particular impairment loss, number one, it reduces the value of the goodwill. For example, now this particular goodwill, because we are told it was impaired by 9 million, this will be reduced with how much? It will be reduced with 9 million, meaning that at the end of the year, when the parent company is preparing the consolidated statement of financial position, the goodwill will be recorded there at a value of that is 6 million. And then also you have to recall what we said in our previous session, that this particular amount of impairment loss, 9 million, this one is supposed to be recognized as administrative expense in the consolidated statement of profit or loss. In the consolidated statement of profit or of what? In the consolidated statement of profit or loss. So basically that is it. That what was required in that particular illustration. So see you in the next session as we look on another concept of group accounts. Hi candidates, welcome to another session of manifested online classes. So we are still soldiering on with the topic of group accounts. So this is our lesson number 3. So and in this lesson I want us to look on the various forms of purchase consideration and basically how we deal with such purchase consideration specifically in computation of goodwill. Remember what we have said in our previous session is that once the parent company has acquired a majority of the shares in the subsidiary, the parent company must pay the previous owners of those particular shares. So now there are various ways in terms of how the previous owners of the shares acquired by the parent company can be paid. One, they can be paid in cash. Number 2, they can also be paid through something called a share exchange. We're going to look on details what is that. We also have another form of consideration known as the deferred consideration, and also we have another form of consideration which is known as a contingent what? A consideration. So therefore in this case, first of all, we can say that the purchase consideration the purchase consideration paid by parent company to the previous owners, to the previous owners of shares can take the following forms. Can take the following forms. So number 1, we have a cash consideration. Number 2, we have a share exchange consideration. Number 3, we have deferred consideration. And number 4, we have contingent. Therefore, what you are saying is that once the parent company has acquired shares of the subsidiary, because those particular shares automatically were owned by some shareholders who have accepted to sell their shares now to the parent, then you are saying the parent company must compensate them, must pay them for acquiring their shares, or basically for those particular previous owners accepting to sell majority of their shares now to the parent. Now, that consideration, that payment which is to be made now to the previous owners of those shares, then you're saying can take any of this form. We have now the cash consideration, the share exchange consideration, deferred consideration, and the contingent consideration. I want us to start with the first form of consideration, that is the cash consideration. So the cash consideration basically is whereby the parent company, after acquiring shares or majority of the shares in the subsidiary, will compensate the previous owner of those particular shares by paying them some cash, and that particular cash which is to be paid to the previous owner of the shares is paid on the date of acquisition. Is paid on the date of what? Of acquisition. So therefore we can say that this is a consideration in cash, and paid on the date of acquisition. Date of acquisition, remember we abbreviate that as DOA, date of acquisition. So in case the parent company pay the previous owner of the shares in form of cash, and that cash is paid on the date of acquisition, then when it comes to the computation of goodwill, this particular cash consideration do not have any special treatment. Basically, what that means is that that cash consideration is used the way it is given in the computation of what? Of goodwill. So therefore, we can say that this consideration do not have any special treatment. This consideration do not have any special treatment. Any special treatment. And it's also important to know how the parent company account for this particular cash what? Consideration. So once the parent company has paid some cash to the previous owner of the shares in the subsidiary company, so this is how the parent company will account for that. So like maybe we assume that we are told A Limited acquired 80% of the shares issued by B Limited and paid the previous owner of this particular shares acquired a cash of 100 million. A cash of 100 million. So how does this company, that is the parent company, account for this cash consideration? So the parent company debit an account called investment in B Limited with an amount of 100 million, of which this investment in B Limited, this one is recognized as an asset in the statement of financial position of the parent company. So once you go to the statement of financial position of the parent company, specifically under the non-current asset, you'll be able to see something called investment in B Limited, which is now the cash consideration paid by the parent company in acquiring 80% of the shares of what? Of B. And then the parent company will credit the bank account, the bank or even the cash account, with the same amount of money. So in such a case, when computing the goodwill, the purchase consideration which was paid by the parent company will be 100 million. Will be 100 what? A million. So that is known as the share exchange consideration. Number 2, share exchange consideration. And this is very, very common in the exams. So share exchange consideration is whereby the parent company will acquire majority of the shares in the subsidiary, and the parent company agree to compensate the previous owner of those particular shares by issuing its own shares. By issuing its own what? Shares. So mean that if, for example, A Limited here acquires 80% of the shares issued by B, so then those shareholders of B Limited who have accepted to sell their shares to A will not be paid in cash, but rather what the parent company will agree here to do is to issue its own shares to the previous owners of those particular shares in order to compensate them. In order to do what? To compensate them. So therefore, you can say that this is where the parent entity, or basically the parent company, pays the purchase consideration by issuing its own shares. By issuing its own what? Shares. The parent company pay the purchase consideration by issuing its own what? Shares. So here we have a form of a share exchange. So the parent company, for example, will acquire 80% of the shares issued by B Limited, and then those shareholders of B Limited who have accepted to sell their shares now to A, they will be compensated by A, they will be paid by A issuing its own what? Shares to the previous owners of the shares which have been acquired in what? In the subsidiary. Mostly, once the purchase consideration was paid by the parent company through a share exchange, the examiner will tell you two things. Number one, the examiner will tell you that the parent company had not computed the purchase consideration, and number two, the parent company had not accounted for that purchase what? Consideration. So therefore, anytime the purchase consideration has been paid through share exchange, you must be in a position to determine two things. Number one, you must be in a position to compute the purchase consideration paid through share exchange, and number 2, you must be in a position to know how such purchase consideration is accounted for by the parent company. So therefore, how do we determine this share exchange consideration? Share exchange consideration. So this one is computed using this formula. So number 1, of shares, number of shares issued by parent company, number of shares issued by the parent company, and then what we do, we multiply those particular shares with their fair value. We multiply those particular shares with their fair value, and the fair value per share can also be known as the market price per share. So that's how we determine the share exchange consideration. Determine how many shares were issued by the parent company to pay the purchase consideration. Once you have determined those particular shares, multiply those particular shares with their fair value, or basically their market price, on the date of acquisition. The date of what? The date of acquisition. Then once you head for the shares which were issued. So how should the parent company here account for these particular shares issued to pay the purchase consideration? So we can look on the accounting entries. Accounting entries. Assuming it is A Limited. A Limited is a parent, and then B is a subsidiary. So when the parent company is accounting for this share exchange consideration, the parent company will debit an account called investment in B Limited with the full amount of purchase consideration here, consideration by issuing its own shares. So therefore what we do, we credit the parent company ordinary share capital, and the amount credited in this account is always based on the par value per share. Is always based on the par value per share. And then in most of the cases, you have to take into account the shares issued, multiply those particular shares with their fair value or market price. So in most of the cases, the fair value or the market price per share will be more than the par value. So therefore, the amount which is above the par value, that is a share premium. So that one is credited in the share premium account. For example, if at the date of acquisition, if the shares of the parent company were trading in the securities exchange market at a price of what? Of 30, this is now the fair value or the market price per share. But you may be told that the par value per share is something like 10 shillings. Is something like 10 shillings. So the amount which is above 10 shillings, which in our case, the share premium, which is 20 shillings per share, that amount you do what? You credit it in this account, which is called what? The share premium account. So therefore, this is a very, very important concept which you need to understand, that whenever the parent company has acquired majority of the shares in the subsidiary, the parent company can pay for the shares acquired through something called a share exchange consideration. If that is the case, then the examiner will tell you two things: that the parent company had not computed that purchase consideration, and this is how we compute it. And number 2, the examiner equally will tell you that the parent company had not accounted for that purchase consideration. That's basically how we do what? We account for it. So the parent company should debit an account called investment in B. And actually this one now will be used in the computation of goodwill. And then the parent company credit its ordinary share capital with an amount which will be based on the par value. And then still credit an account called the share the share premium. So I want us to look on a small illustration which is here. And the illustration reads, the parent company has acquired 12,000 shillings 1 share in a subsidiary by issuing 5 of its own shares, by issuing 5 of its own shillings 1 share for every 4 shares in the subsidiary. The market value of the parent company shares is shilling 6. So what are we required to do? We are required to compute the share exchange consideration the parent entity will account for it. So let's look on that illustration here. And we are told that the parent entity acquired 12,000 shares in the subsidiary. So the parent company, this one we are told it acquired 12,000 shares in a subsidiary company. And in this case, we are told the parent company paid for these shares which were acquired by issuing 5 of its own shares for every 4 shares acquired in the subsidiary. For every 4 shares acquired in the subsidiary. And then you're told the shares of the parent company had a market price of what? Of shilling 6. So what are we required to do here is to determine the share exchange consideration, and basically show how that will be accounted for by the parent company. So for us to be able to determine this, the first thing we have to recall is the formula. How do we compute the share exchange consideration? This is a formula which you have to remember always, this one. This is a formula which you have to remember for computing now the share exchange what? Consideration. So in this case, we have said number 1, we have to determine number of shares issued by parent company. The parent company issued how many shares, and then multiply those particular shares with their fair value or with their market price on the date of acquisition. Like from the information which are given here, we are told that the parent company acquired 12,000 shares by issuing 5 of its own shares. So that will help us in terms of computing this. So the parent company was to issue 5 shares for every 4 shares in the subsidiary, or in other terms, for every 4 shares acquired in the subsidiary. So in our case, we know that the shares the parent company acquired in the subsidiary were 12,000. So these are the shares now which were acquired. So what do we need to do? We need to determine the shares issued by the parent company. So we cross multiply here and we divide. So we have 5 times 12,000 divided, we divide that with what? With 4. So this will give us 3, so which will give us 15,000 shares. So these are the shares which were issued by the parent company. So having that, we just need to multiply those shares with their fair value or market price on the date of acquisition. 15,000 shares. And then going back to the information which are given in our illustration, they had a market price of 6. So we multiply the 2. So which will give us 90,000. Yes. So this is the purchase consideration. So when computing now the goodwill on acquisition, the purchase consideration will be how much? Will be 90,000. But equally, what we are required to do is to show how the parent company will account for this 90,000. So we can go further and show the accounting entries. Accounting entries. So the parent company, with this particular amount which you have computed here, 90,000, will debit an account called investment in the subsidiary company. So which in our case will be how much? Investment in subsidiary company, an amount of 90,000, and then credit the ordinary share capital. The parent company will credit its ordinary share capital. So what is the par value per share? The par value per share is also known as the nominal value, is also known as the face value per share, and basically this is a value of the share which is stated in the capital clause of the memorandum of association. Is the value of the share stated in the capital clause of the MOA. But on the other hand, when we talk about the fair value or the market price, here are the shares of the company in the securities exchange market. They are trading at a price of what? So that price, we refer to it as the fair value or the market price per share. We are saying the amount to be credited in this account always has to be based on the par value per share. And in our case, we are given that because we are told in the subsidiary by issuing its own shillings 1. So basically what that means is that the shares of this parent company, they have a par value of shillings 1. So therefore, we take the shares issued by the parent company, 15,000, times the par value per share, which is 1. So that will give us 15,000, That is the amount we credit in the ordinary share capital. And then, because the shares were issued at a price of 6, the amount which is above 1 shillings, which is now a share premium, that will be credited in the parent company share premium. So the amount to be credited here will be equal to the shares issued, 15,000, times the share premium. The share premium in this case will be 6 minus now the par value, because the share premium is an amount which is above the par value. So the share premium per share is 5. So which will give us 75,000. So that's how we determine the purchase consideration paid through share exchange, and also how we do what? How we account for that. How we account for what? For that. So that is the second type of purchase consideration. That is the share. Number 3. You have already looked on the first one, the cash consideration, the share exchange consideration, and then number 3, we have a deferred consideration. Deferred consideration. So what is a deferred consideration? As the name suggests, deferred consideration is a consideration to be paid by the parent company on a future date. On a future date. For example, the parent company can acquire the subsidiary company today and actually promises the previous owner of the shares which have been acquired in the subsidiary to pay some cash in the future. And because that cash to be paid in the future still forms part of the, the purchase consideration, and which must be used in the computation of goodwill, and the goodwill has to be computed on the date of on the date of acquisition, that consideration to be paid in future has to be discounted to its present value. Has to be discounted to its present what? Value. So therefore, first of all, we can say that this is a consideration to be paid, or we can just say this is a cash consideration, to be paid in the future, to be paid in the future, to be paid in the future. And then in this case, we have said that it must be discounted. It must be discounted to its present value using the parent company, company cost of capital, using the parent company cost of capital. So I mean that for discounting purpose, the parent company cost of capital here will be the R, So deferred consideration, a cash consideration to be paid in the future. And then we are saying for the purpose of computing the goodwill, what we have to do is to discount it to its present value using the parent company cost of what? Parent company cost of capital. Yes, so I want us to look on an illustration regarding the deferred consideration, how we deal with the deferred consideration. So the illustration reads, the parent acquired 75% of the subsidiary 80 million shillings 1 share on 1st January 2024. It has paid shillings 3.5 per share and agreed to pay a further shillings 108 million on 1st of January 2025. The parent company cost of capital is 8%. So what are we required to do? We are required to compute the total cost of combination and show how it will be accounted for by the parent entity. So we are given an illustration there, and what we are required to do is we compute the total cost of combination. So when we talk about the total cost of combination, we are required to compute the total purchase consideration, because in this particular illustration here we have a consideration which was paid in cash. The other one is to be paid in what? In the future. But basically what we are told is that the parent entity or the parent company, first of all, acquired 75% of the shares of a subsidiary. And actually we are told that the shares issued by this company were 80 million. So mean that this company acquired 75% of that. on 1st of January 2024, 1st of January 2024, that is the date of acquisition, and you're told it paid shillings 3.5 per share in cash. So basically what that means is that we have some consideration which was paid in cash, and I think we can just determine that, which is the cash consideration. Cash consideration. So the cash consideration would be equal to the amount which was paid per share, 3.5, times the shares now which were acquired. So the shares which were acquired by the parent in the subsidiary will be equal to 75% of 80 million. 75% of 80 million. So this will give us now the consideration which was paid in what? In cash. So let's compute this. We see what it will give us. So we have 0.75 times 80 times 80 times 3.5. So this will give us 210 million. So this is now the cash consideration. And then we also told that the parent company promised to pay a further cash of 108 million on 1st of January 2025. So this is now what we have referred to as the deferred what? Consideration. Deferred consideration is basically a cash or additional cash to be paid by the parent company, but in the future. So basically what we have said is that because this consideration of 108 will be paid in future, so for the purpose of computing goodwill, you can't use it as 108. So what you have to do, you have to discount it. You have to get its present value using the parent company cost of what? Capital. And basically, we are told the acquisition took place on this date, 1st January 2024. That is the date of acquisition. Will be paid on which date? It will be paid on 1st of January 2025. Basically, that will be paid after 1 year. So what we need to do, we need to discount it. We need to get its present value. So how do we get the present value of this 108 million? So we multiply this with the present value interest factor at the rate of 8% because we use the parent company cost of capital, and for 1 year. For 1 year. So therefore we take 108 million. 108 million. So how do we compute this? How do we compute this? We take 1 plus R, which is 8%, or basically 1.08, which will be 1.08 raised to power negative 1. Our N will be 1. So this now will give us the present value of that deferred consideration. So we have 1.08 raised to power negative 1 times 108 million. 108 million. Yes, which will give us 100 what? 100 million. Which will give us 100 million. Maybe you can take that off again. Yes, that will give us 100 million. So that is consideration which will be used in the computation of goodwill will be equal to the cash consideration. Remember there was a consideration which was paid in cash, which we have here. Actually, we can split it here. We have the cash consideration. Cash consideration, which is 210 million. And then we also have the deferred consideration. Deferred consideration, which is 100 million. So we get the total, which will be 310 million. So this is now the amount of consideration which will be used by the parent company in determining the goodwill arising from business what? A combination. So therefore, that's how we deal with what we refer as a deferred what? A consideration. Then we have the last consideration here, which is known as the contingent consideration. Contingent consideration. Contingent consideration. So number 4. consideration which is to be paid by the parent company in future upon a fulfillment of certain conditions. So mean that the parent company, for example, can promise to pay the previous owners of the shares which have been acquired in the subsidiary company once certain conditions have been acquired in the subsidiary, that if the subsidiary company profit exceed 100 million or even 200 million, then the parent company will pay an additional what? Consideration. So therefore you can see that this particular consideration here will only be paid upon certain conditions being met. Upon certain conditions being what? Being met. So we can say that this is a consideration. This is a consideration to be paid by parent company in future upon fulfillment of certain conditions. And equally, because this particular consideration will be paid in the future, it is actually treated in the same way, just like the deferred consideration. So in most of the cases, the examiner will give you some information regarding whether these particular conditions are likely to be fulfilled. If the conditions are likely to be fulfilled, then that consideration automatically have to be paid, and therefore, for the purpose of computing the goodwill, it has to be discounted to its present value. So therefore, you can say that this consideration is also discounted to its present value using parent company cost of capital. Using parent company cost of capital. Using parent company cost of what? Of capital. Yes. So that's basically how we deal with what referred as a contingent what? A consideration. Therefore, we can say contingent consideration and deferred consideration are almost the same, but the main difference is that this contingent consideration will only be paid by the parent company on fulfillment of certain what? A condition. But when it comes to deferred consideration, there are no conditions which need to be fulfilled there for the parent company to be able to pay that particular what? Consideration. So therefore, these are the various forms of purchase consideration, and basically the ones which are very, very common in the exam is the share exchange consideration, the deferred consideration, and therefore you must be in a position to know how to deal with those various forms of purchase what? Consideration. So I want us to stop at that particular point. So once we come back in our next session, we're going to look on how we prepare the group account, specifically whereby the parent company has invested in a... Hi candidates, welcome to another session of manifested online classes. So we are still soldiering on with the topic of group accounts. And in this session, I want us to look on how we prepare the group accounts, specifically whereby the parent company has invested in a subsidiary. And basically the preparation of the same is governed by IFRS 10. So mean that IFRS 10 lays down the procedures to be followed by the parent company in preparing the group account, specifically whereby the parent company has invested in what? In a subsidiary. So you have to recall that a subsidiary is basically a company which is controlled by the parent, meaning that the parent company has acquired shares which are more than 50% of the shares issued by the subsidiary. Actually, we have said that anytime a company acquires shares which lies between 51% to 100% of the shares issued by another entity, then the investor company is known as the parent, whereas now the investee company is known as what? The what is known as the subsidiary. So mean that the parent company here, we say that this company has an obligation to prepare the group accounts. And when these group accounts are being prepared by the parent company, then they must be prepared in accordance with what? IFRS 10. So we are saying IFRS 10 lays down the principles, the procedures to be followed by the parent company in preparing now the subsidiary is basically the control. generally we have said that the parent company exercises control, basically do have a control over the subsidiary, whereby the parent company holds shares or has acquired shares which lies between 51% to 100% of the shares issued by what? Issued by the subsidiary. So therefore, the parent company at the end of the year is the one which is required to prepare the group accounts, or to prepare the consolidated financial statements. And according to IFRS 10, this group account should be prepared by the parent company by combining, or in other terms, by adding together an expenses of the two entities here, the parent and also what? The subsidiary, as if now these two entities are a single what? Entity. So therefore, we can say that the parent entity, or basically the parent company should prepare a group account by combining or adding together similar items of assets, liabilities, revenue and expenses, similar items of asset, revenue, that is liabilities, revenue and expenses, those of parent company and the subsidiary. So parent company here and the subsidiary are actually treated as a single entity. They are treated as a single company, and that's why we are saying that their similar items of asset, liabilities, revenue and expenses should be combined, or in other terms, they should be added what? They should be added together. So I want us to look on the procedures to be followed by the parent company in preparing those particular group accounts. And first of all, I want us to look on how to prepare the consolidated statement of financial position. And we start by looking on the consolidation procedures. So the consolidation procedures, these are the steps to be followed by the parent company in preparing the consolidated statement of financial position. Number one is that the group structure, or basically the parent company should come up with a group structure, meaning that anytime you come across a question, you are told the parent company has invested in a subsidiary, you are required to prepare a consolidated statement of financial position. The first thing you need to do is to come up with a group structure. So what is a group structure? A group structure basically is a form of a chart which will be showing the parent company shareholding in the subsidiary. For example, in this case, let's assume that the parent company acquired 80% of the ordinary shares issued by the subsidiary, and also in your group structure you must have the date of acquisition there, the date the parent company acquired the subsidiary. That is the first thing. Come up with a group structure. The number two is that you need then to consider the consolidation adjustments. So these are the adjustment to be made in preparing the group account. So after adding together similar items of asset, liabilities, revenue and expenses, those of the parent and those of the subsidiary, there are some important consolidation adjustments to be made, and actually that is what we are going to discuss next. Some of these consolidation adjustments include adjustment in relation to adjustment relating to an realized profit on inventory, We also have adjustment relating to what we refer as the fair value adjustment, also known as the fair value exercise. We also have adjustment relating to intra group sale of assets, and then we have adjustment relating to something called the goods in transit. The goods in transit, GIT. So this is basically what you're going to discuss next. So once you have determined the consolidation adjustments you need to make, then from there, step number 3, you need to combine. So basically by combining, that means what? That you add together similar items of asset and liabilities. Remember here we are looking on the consolidation procedures for preparing the consolidated statement of financial position. We know in a statement of financial position, what is recorded here are assets, liabilities, and what? Equity or capital. So in this case, we are saying what we combine or what we add together are only items of asset and liabilities. Basically, we don't combine items of what? Of equity. So therefore, in this case, we combine, or in other terms, add together similar items of assets and liabilities, those of the parent and those of the subsidiaries, and eliminate any intragroup balances. Eliminate any intragroup balances. Eliminate any intragroup balances. So when talk about intragroup balances, we talk company or the subsidiary a certain amount of money. That is a good example of intercompany debt. That should be eliminated. And actually, we're going to look on how we eliminate the same. And then from there, step 4 is that for share capital, include that of the parent company only. Include that of a parent company only. Include that of parent company only. So for share capital, we don't combine the share capital of the parent and that of the subsidiary. We only include that of the parent company only. Very, very important. So then number 5 is that you compute something called the group retained earnings, and something called the non-controlling interest. Group retained earnings and the non-controlling interest. So before you look on an illustration regarding the preparation of this, maybe I can just explain something on these two items, how to compute the group retained earnings and what is NCI. Maybe let me start with the non-controlling interest. Non-controlling interest, abbreviated as NCI, non-controlling interest at year end. That when preparing the group account, or basically when preparing the consolidated statement of financial position, then we are saying that we do what? We add together similar items of asset and liabilities, those of the parent and those of the subsidiary. Like maybe assuming here, the parent company acquired 80% position. So what you do, you take 100% of the asset and liabilities of the parent, and to that you add 100% of the asset and liabilities of the subsidiary. But in this case, you can see that the parent company only acquired 80% of the asset and liabilities of this particular subsidiary. But in preparing the consolidated statement of financial position, we are saying we take into account 100% of the asset and liabilities of this particular a subsidiary. So this particular standard here, IFRS 10, requires that the parent company should compute or basically should be able to compute the net asset which are owned by the minority shareholders, because in this subsidiary we have minority shareholders who own 20% of this company. So, and once the parent company compute the net asset in the subsidiary owned by the minority shareholders, and which now will be known as the consolidated statement of financial position, under the equity section. Under the equity what? Section. Now, how do we compute this particular non-controlling interest at the end of the year? But even before we look on the computation of the same, we can say that this is the NCI share of net asset in the subsidiary company. In the subsidiary company, this is the NCI share of the net asset in the subsidiary company. So we can say it is computed as follows. It is computed as follows. So what we do, number one, we take the NCI share of subsidiary company net assets. At the end of the year, and then to this, in case we add what we refer as a NCI goodwill, and then to this we less the NCI share of impairment loss, so whatever you get here is the NCI share of the net asset in the subsidiary company, and what you are saying is that this one should be taken to the consolidated statement of financial position as one of the equity component, or actually should be recorded in the consolidated statement of financial position as an equity component. A component. So basically that's how we compute the non-controlling interest at the end of the year. There is another item here which is called now the group retained earnings. The group retained earnings. So the group retained earnings, in other terms, this is like the parent or the group retained profit at the end of the year. So how do we compute this? So to compute this, we take 100% of the parent company retained earnings plus the group share of a post-acquisition retained earnings. So when we talk about the post-acquisition retained earnings of the subsidiary, so this is the retained earnings of the subsidiary company after it was acquired by the parent. After it was acquired by what? By the parent. And in that case, you will not include the full amount, but you only include the group share. So when talk about the group share, for example, in this case, what you do, you determine the retained earnings of this company after it was acquired by the parent company, and then to get the group share of this, you have to multiply that with 80%, and then to that you add 100% of the parent company retained what? Earnings. And actually, whatever you get here is the group retained earning, and still that one is also recognized in the consolidated statement of financial position equally as a component of what? Of equity. So therefore, these are basically now the procedures to be followed by the parent company, specifically in preparing the consolidated statement of financial position. So I want us to look on an illustration regarding how we prepare this, but an illustration without any of this particular what? Adjustment. We're going to look on this particular adjustment later on. We discuss on them in details, and equally we look on some illustrations regarding how to deal with them. So we have an illustration here, and it reads B Limited acquired a 60% investment in H on 1st January 2020 for shillings 720,000, when the retained earnings of H Limited were shillings 300,000. The statement of financial position of the two entities for the year which ended 31st of December 2023 are presented below. So we are given the statement of financial position of B Limited and also for H Limited. We have the non-current asset, which include the property, plant and equipment, and then we have the investment in the subsidiary, we have the current asset, we have equity, which comprises of share capital, retained earnings, and then we have non-current liabilities, and then current liabilities, and then we have some additional information. We are told an impairment review was conducted on at 31st December 2023, and it was decided that the goodwill on acquisition of H Limited was 10% impaired. And then number 2, we are told it is the group policy to value non-controlling interest at fair value at the date of acquisition. So this is something we discussed in our second session, and basically what we said is that if you come across that particular information, that it is a group policy to value, or in other terms to measure NCI at fair or full value, then it means that when computing the goodwill on acquisition, you compute that goodwill using the full goodwill what method, full goodwill method. And then you're told the fair value of non-controlling interest as at 1st of January 2020, that is now the date of acquisition, was 480,000. So what are we required to do? We're required to prepare the consolidated statement of financial position of B Group as at 31st of December 2023. So basically these are a question for group account, and remember what you have said is that once you come across such a question for group accounts, so what do you do? Which procedures do you follow? Which steps are you supposed to follow? Number 1, come up with a group structure, and then number 2, you need to consider the consolidation adjustment. So in this question, we don't have any adjustment other than the computation of goodwill on acquisition, because you have said that is a requirement under IFRS 3 that anytime the parent company acquires a subsidiary, the parent company has to determine the goodwill on acquisition. So we are going to determine the goodwill on acquisition using now the full goodwill method, and then from there we do what? We are going to proceed and we combine similar items of asset and liabilities, those of the parent and those of the subsidiary. And then for share capital, we have said we only take into account the share capital of the parent, and then later on we are going to do what? We are going to compute these two items. We are going to compute now the group retained earnings and the NCI. So these are the procedures we need to follow. So therefore the first thing we need to do here is we automatically come up with a group structure. That's the first thing we need to do here. So the first thing we need to do is to have the group structure. So where do we have information about the group structure? We have that information in paragraph 1 of the question, where we are told B Limited acquired 60% investment, 60% investment in the company which is called H Limited, H Limited on 1st of January 2020. So meaning that B Limited, this will be our parent company. This will be the parent company, whereas these are our subsidiary. These are subsidiary. And also from this particular information, we can say in this particular subsidiary, the minority shareholders have an interest equal to 40%. The percentage NCI is 40 what? 40%. So we are told the amount of purchase consideration which was paid was 720. That one will be used in the computation of goodwill. And then we are told that the retained earnings of H on the date of acquisition was what? Was 300,000. And then we have some other information there. I think before you proceed and combine similar items of asset and liabilities, because the first thing we have done, we have come up with a group structure. This is a group structure. And the reason why it is important for as a candidate to come up with a group structure is for you to know which is the parent company, which is a subsidiary. So like in our case, we know B Limited is a parent. This is a company which is required to prepare the group accounts by combining similar items of assets and liabilities of the two companies. So this company has the obligation to prepare the group account by adding similar items of asset and liabilities, those of the parent and those of the subsidiary. Also, we have said on the date of acquisition, the parent company has to determine the goodwill on acquisition. So therefore, I think step 2, before we proceed to combine, to add similar items of asset and liabilities, I think we can compute now the goodwill on acquisition. So let's compute the goodwill on acquisition. Goodwill on acquisition. And as per the information which are given in the addition information number, the full goodwill what? Method. Full goodwill method. So let's compute that goodwill here. So we need to have 2 columns, and our figures are given in thousands of shillings. So to compute the goodwill using the full goodwill method, number 1, we take into account purchase consideration. Purchase consideration paid by parent company. That is the first thing we should have. That is given is in paragraph 1, that the parent company paid an amount of 720, and actually this is a cash consideration, because if you go to the statement of financial position of B, specifically at the non-current assets, you can see something called investment in subsidiary, which is 720. This is a cash consideration, and then to this we add something called the NCI at fair value. The NCI at fair value, this one is given in addition information number 2, the last sentence, which is given as a figure of 480. So we add these 2 values here, which will give us 0, 0, 11, 12, 11, 12. So to this then, what we need to do, we need to proceed and we less the net asset acquired by both the parent and also what? The NCI. This amount which we have here, we need to proceed and we less the fair value of the net asset acquired by the parent and also NCI. But mostly what we said is that that is a figure which the examiner will not give you, and therefore you have to recall how we compute the subsidiary company net asset at the date of acquisition. And actually we said we compute that by adding the ordinary share capital of the subsidiary plus now the reserves of that subsidiary on the date of acquisition. So therefore to this, what we need to do, we need to less fair value of net asset acquired, less fair value of net asset acquired, net asset acquired. And because you're not given this one, we have to compute it. How do we compute this? We compute this by taking the subsidiary company ordinary share capital. The ordinary share capital of the subsidiary from its statement of financial position is 500. And then to this we add pre-acquisition reserves. Pre-acquisition reserves, these are the reserves which the subsidiary company had at the date of acquisition. The reserves include share premium. If you go back to the statement of financial position of the subsidiary, you'll be able to see that that company do not have any share premium. If we had any share premium, also include it there. And the only reserve which is there is the retained earnings. But in that case, we take the retained earnings of the subsidiary on the date of acquisition. On the date of acquisition, and this one is given as part of the or is given in paragraph 1. If you go back to paragraph 1 of that particular question, you are told the retained earnings of H Limited on the date of acquisition was 300,000. So this is now the pre-acquisition retained earnings. So this company do not have any other pre-acquisition reserve. So we get the total here, which is 800. And because we are using the full goodwill method, we're interested with the net asset acquired by the parent and the NCI. So therefore what we do, we take 100% of this. 100% of that will be 800, and we less that from the figure which we have here. We less that from the figure of 1200, and we get now a goodwill here of 400. And remember, this is a full goodwill. Why do we refer to it as a full goodwill? Is because it is a goodwill attributable to the parent and the goodwill attributable to NCI. Then we are also told in the addition information number 1 that an impairment review was conducted at the end of the year, and it was decided that this particular goodwill was impaired by 10%. So being impaired means that the value of the goodwill P group, that is B group. Group, remember, is the parent company and the subsidiary. So the B limited and H limited is a group. So B group, a consolidated statement of financial position as at 31st of December 2023. 31st of December 2023. 31st of December 2023. So we just need to have a single column here, and our figures are in thousands of shillings. So what we start with are the non-current assets, statement of financial position. Then we have said that what we do is that we add similar items of asset and liabilities of the two companies within the group. Two companies within the group. So under the non-current asset, we have the property, plant, and equipment. So we take the property, plant, and equipment of the parent, 2,300, plus that of the subsidiary, which is 1,900. And then below that we have investment in the subsidiary. So the investment in the subsidiary is the purchase consideration paid by the parent company in acquiring the shares of what? The subsidiary. That amount we don't include it here because we have used that in computing the goodwill. Instead, what we include here is the goodwill arising from the acquisition. So that goodwill is an amount of how much? Is an amount of 360. That is now what we include here. We don't include that investment in the subsidiary. What about the PP? PP here will give us what? We need to add those two figures. We have 2,300 plus 19, which will give us 4,200. Do we have any other item of an non-current asset? No. So we add the two figures here, and they'll give us a total of 4,560. And then below this we have the current assets. So for current asset, equally we take those of the parent, which is 340, plus those of the subsidiary, 1,790. So we add the two, we have 340 plus 1,790, which will give us 5,130. 5,130, and then we get the total assets. So the total assets plus 4,560, which will give us 9690. Then from there we proceed and record items of equity. We proceed and record items of equity here. So for equity, we start with to record here. We don't combine items of equity. Actually, for share capital, we only include the share capital of the parent company only. We only include the share capital of the parent company only. The reason why we don't combine the share capital, anything which has been used in the computation of goodwill, we don't include it here, including the share capital of the subsidiary. That's why we are saying for share capital, or include that of the parent company only, which is 1,000. Then from there, we have the retained earnings. The retained earnings. So for the retained earnings, this one has to be computed. We don't combine that of the parent and that of the subsidiary, but this one is quite simple. So what we do here to compute the retained earnings to be included here, which is now the group retained earnings. Group retained earnings. Remember, I've given you the formula for computing this, whereby we said we take what? 100% of the parent company retained earnings, plus, in this case, we are going to take 60% of post-acquisition retained earnings of what? Of the subsidiary, plus 60% of a post-acquisition retained earnings of our subsidiary, which is H Limited. That is how we compute the group retained earnings. So therefore, what we do, we need to have two columns here, two columns here for the parent and for the subsidiary. Our parent is B Limited. Our subsidiary is what? Is H. This is basically the format you should use. So first of all, have the retained earnings of these two companies at the end of the year. And where do you get this? You get this from the statement of financial position, specifically at equity. We are given the retained earnings of the two companies at the end of the year. For this one is 3430. For subsidiary is given as 18. But now you have to remember what we consider as far as the subsidiary company is concerned. For subsidiary, we are only interested with post-acquisition. These are the retained earnings of the subsidiary company after it was acquired. So therefore, for you to get that, what you do, you come here and you less the pre-acquisition retained earnings. So these are the retained earnings the subsidiary company was having before it was acquired, or basically as at the date it was acquired. And basically, that is the figure which we use here in computing the goodwill. So these retained earnings of the subsidiary at the date of acquisition is what we refer as a pre-acquisition retained earnings. We rest it there. Such that what we shall be left with here is the retained earnings of B Limited after it was acquired by who? By the parent. Yes, that's what we have. And then there is something also which we come and adjust here, and that is the impairment loss. The impairment loss. So remember this particular goodwill which you have computed here, we are told it was 10% impaired. So what we do, we compute the impairment loss which is to be allocated to the parent company goodwill. The impairment loss to be allocated to the parent company goodwill will be equal to the full amount of impairment loss times the parent company shareholding in what? In the subsidiary. The parent company shareholding in the subsidiary, which is 60%. So this will give us 24. So that one, we less it from the parent company retained earnings. And then you have now to recall that the remaining impairment loss, which will be 40% of this, is an impairment loss to be allocated to the NCI what? Goodwill. Basically, I will show you where we are going to take into account that particular amount. So we have 1500 here. And what do we have here? We have 3430 minus 24, which will give us 3406. And then finally we do what? We take the group share of this. So the group share of this will be 100%. The group share of this will be 60%. So with 100% of that is 3406. 60% of 1500 is 900. And then what we need to do, we add these two figures plus 3406, which will give us 4306. So this is the amount now which we come and include here as the group what? Retained earnings. The group retained earnings. Actually, you can refer to that as working 3. Because goodwill was in working 2 here. Yes. So this is from working 3. Yes. So we add these two figures, which will give us 5306. There is something else we also need to. So the non-controlling interest, basically we have said that this refers to the minority shareholders' share of the net asset in the subsidiary, because in preparing this particular consolidated statement of financial position, you can see we are taking 100% of the asset and liabilities of this subsidiary, But in our case, we know that the parent company only owns 60% of those what? Asset and liability. So what we have said is that in preparing the consolidated statement of financial position, we have to compute the net asset in the subsidiary company, which are owned by the minority shareholders, and then we include that here in the consolidated statement of financial position as one of the component of equity. One of the component of what? Equity. And actually, we have also looked on how we compute what? We compute this. So therefore, NCI at the year end, NCI at year end. So we compute the NCI. Remember, you're saying NCI is what? Is the minority shareholders' share of the net asset in the subsidiary. In the subsidiary. In the subsidiary. Our subsidiary is what? Is H Limited. So what we do, we take the net assets of this subsidiary at the end of the year. So the net asset, this is the difference between assets and liabilities. You can take asset minus liabilities, or you can just take equity. Equity be equal to equity, share capital and reserves. So what is the share capital and reserve? What is the total share capital and reserves of H at the end of the year? It is an amount of 2,300. An amount of 23 what? 2,300. So what we are interested with is the NCI share of this. NCI share of this. NCI what? Share. So of which now the NCI share of this will be equal to 40%. Will be equal to 40%. 40%. So what will be 40% of this? Which will give us 9 what? 920. 920. Then to this there is some, that is the NCI goodwill. NCI goodwill, and also we less the impairment loss allocated to the NCI goodwill. So, and I think first of all we can compute this. So the impairment loss to be allocated to the NCI goodwill will be, share of this will be 40%. 40% of that. So 40% of 40 will give us 16. So that one is to be deducted here. What about the NCI goodwill? NCI goodwill is computed by taking the NCI at fair value. NCI at fair value, NCI share of these net assets. NCI share of this net asset, we take 800 times the percentage NCI. Percentage NCI is 40%, so which will give us 320. 320. So we have 480 minus 320 minus, yes, which will give us 160. So this is how we compute the NCI at the end of what? Of the year. So we have 920 plus 160 minus 16, which will give us 10,640. 10,640. So 10,640 is the NCI share of the net assets in that particular subsidiary. And actually, we have said that should be equity as a component of what? Equity. Actually, in any question for group account, these are two items which are a little bit tricky to majority of the students when dealing with these particular questions coming from the topic of what? Group account. How to compute the group retained earnings, and I hope you have understood how we have computed the same, and also how to compute the non-controlling interest. So actually we can refer to that as working for. Working for. So once you have computed that, finally what we need to do is to record non-current liabilities. Non-current liabilities. So for the non-current liabilities, this one we just add. We just add the non-current liabilities of the parent of 350 plus 290 plus 290. Is that correct? Yes. That will give us a total of 640. A total of 640. And finally, we have the current liabilities. The current liabilities. Also for current liabilities, we add those of the parent, 1580, plus those of the subsidiary, that is 1100. That is 1100. That is 1580 plus 1100. So which will give us 2680. Yes, and then from there, what do we need to do here? We need to get the total equity and liabilities. Total equity and liability. So we already have our total equity there, which is 5306. This one plus this plus 1064 plus 640 plus 2680, which will give us 9690. That should be the same with the total assets. Yes, is actually the same. That will be the same with the total what? The total assets. So therefore, that basically what was required as far as that illustration is concerned. But you can see that illustration actually only one consolidation adjustment which was captured there, the issue to do with the goodwill. But in an exam situation, once you come across a question for group account, basically that question would be having a number of what? Adjustment. Therefore, once we come back in our next session, we are going to look on some of the consolidation adjustment which are supposed to be made. We have looked on some of those particular consolidation adjustments which we are going to discuss in our next session. So therefore, we need to stop at that particular point. See you in the next session.
If statement, that is if and statement, and if or statement are used for analyzing data, or how the advanced formulas for if statement, let's say if and statement, and also if or statement are used for data analysis in Microsoft Excel. Hello and welcome. My name is Nicholas Sikali. So with me here, I have a student's grade sheet that is prepared so that we can be able to use it in applying this formula or putting this formula into practice. Now, the if and statement is an Excel formula that analyzes the contents of different cells or analyze. It then compares the contents of those analyzed cells against several given conditions. If the conditions are met, that is, if all the conditions are met, now that you're speaking about if and, if all the conditions are met, will be brought by this particular formula. But if any of the condition is not met, then a false value or statement will be brought by this formula. For a true value or statement to be brought by this formula, then all the conditions must be met. So all the conditions must be met for a true value or statement to be brought by this formula. That is if and statement. So let's put that into practice and see how the if and statement is to be applied. So all the formulas in Excel are preceded with an equal sign. So we are going to start with an equal sign. Double click on the if. Then we bring on board and. You can see checks whether all arguments are true and returns are true if all arguments are true. Of course, so double click on the and once we have and, that is if and, then the first cell that you're analyzing is age. So you click on the age, that is B4. So if B4 is greater than or equal, so if B4 is greater than or equal, the condition here is 20. So if somebody's age is greater than 20, if somebody's age is greater than 20, comma, if in financial accounting, you click on, that is C4. If C4 is greater than 70, the condition here is 70. That is greater than or equal to 70. Greater than or equal to 70, comma. If MA, that is D4, so you click on D4, is greater than or equal to 72. Greater than or equal to 72, comma. If this is now the last one, tax. E4 is greater than or equal to 75. The conditions are here, 75. Can see 20 through to 75. Then if all those conditions are met, so you close the bracket, then comma, then if all those conditions are met, then the formula should return a price. And that price will be your age multiplied times 100. It will be your age multiplied times 100. So which means that we'll have to click back on age, then we multiply that with 100. We multiply that with 100. Otherwise, if you don't meet the condition that have been stipulated, if you don't meet any of them, then the formula should return no price. The formula should return no price. So you write no price in those quotations, then you close the bracket to finish it up. So that is how the if and statement is applied. So if all the conditions stipulated are met, the formula should return the student's price as the student's age multiplied times 100. Otherwise, the formula will return no price. Let us see. If you hit enter, there is no price for this particular person because maybe there is a condition that this person did not meet. So looking at that, age Kent met the age but never met this one here, that is financial accounting was to be above 70, so he's not getting the prize. MA he surpassed, tax he also surpassed, so he's not getting the prize because of the mark that is scored in financial accounting. He did not meet the way it is written here, if, and all those arguments that have been put in place. If it's to be copied down, let us see what do you get if it is to be copied down. So surprisingly, only one person is getting the prize. This is Julie Jael, who surpassed all the conditions that have been set here. So it's only one person that is going to get the prize here. Anyway, a few can be adjusted, like this one is missing the prize only on the basis of age. So we can adjust the age of Gary to around more than 20, that is 21. If you adjust here from what was there to 21, then it brings now a price of 2,100. That can be seen there. Another person that was closer to getting the prize, is this Paul Henry. So for Paul Henry, it's only because of FA got 58 instead of the required 70. Kent Lewis missed only because of FA, so we can adjust Kent marks to just about there, 71, so that he also gets the prize. The formula changes to now a person getting the prize. There is one here who is not getting the prize because of so many reasons. Maybe Chris Hope. Chris Hope met everything except age and tax. Age and tax here. So for Chris Hope, we can adjust the age to 20. Then you adjust the tax here to 76, so that it brings a prize here. So there are those who are getting prizes and there are those who are not getting prizes out of what we've just done in this formula here. So that's how you analyze using the if and statement. Now, what about the tour? So we want to say that if you meet all the conditions, the formula should return granted. But if you don't meet any, the formula should return denied. So if you meet, it will be granted. If you don't meet any, it will be denied. So again, we want to enter the arguments, equal sign, if, double click on the if, you bring in the and, you double click on the and. So if this is greater than or equal to 20, the condition is 20, comma, if this is greater than as 70, comma, if this is greater than, there's something I missed here, is greater than or equal to 72. So I'll be coming back to this place here. It should be greater than or equal to before we proceed. So if this D4 is greater than or equal to 72, comma, if this tax is greater than or equal to 75, then you close the bracket. Then if you meet all the conditions, the formula should return granted. The formula should return granted. Anyway, failure to meet a condition, the formula should return denied. The formula should return denied. Then we close the bracket, and that one there is now denied. So if all these things happen, this granted and this denied. Then you punch enter. You can review how the formula look like. There. Then you enter. Now this one is granted. All the others, let's see what happens to them. You can see granted, denied, denied, granted, denied, denied, granted, and all that. So all those that have been granted also got a prize, and all those that have been denied also did not get a prize. So there is one here, Paul Henry. There is Philip Tan. Let's see why Philip Tan missed. There are those who missed narrowly. Maybe those ones can be, you can just adjust a few things and see what happens here. Like so many people here were denied, like Philip Tan. Tonet Meg, we can allow Tonet Meg. Age is tick. FA, we can say 72 or 3. Then tax, you can say that you're adjusting this to around 8. Then also Tonet will be granted. So it changes immediately as you adjust in your formulas. So prizes, people that are getting prizes, that is 1, 2, 3, 4, and 5. And people that are missing, also the ones that are written no prize are missing to get this. So that is the if statement formula in Excel. What about if or statement? There is also if or statement that you want to use to do the same thing. The difference between if and if or is that for if and, all the conditions must be stipulated for a true value or statement to be brought. But for if or, if you meet any of the conditions stipulated, then a true value or statement will be brought. So if you meet any condition now here, any, you don't have to meet all, then a true value or statement will be brought. Let us see how the if or statement works here. So equal sign, then if, then now instead of and, you write or, all the rest will remain the same. So if this is greater than or equal to 20, greater than or equal to 20, and if this is greater than or equal to 70, you can see the conditions are still here, comma, if this is greater than or equal to 72, you can see 72 here, comma, if this is greater than or equal to 75, then let us see what happens. If you meet all those conditions, the formula should return the price. We are talking about the price as your age. So you click in age multiplied times 100. As your age multiplied times 100. Otherwise, the formula should return no price. So the formula should return no price if you don't meet the conditions stipulated. Then of course you close the bracket and you punch enter. The formula has a problem, so we are going to see where the formula has a problem, and it is here. So if E4 is greater than or equal to, oh yeah, there is a problem here. So if E4 if for, there's no if here. So if for greater than or equal to 75, then we've adjusted the formula, and after that you hit enter. So the first one is getting a price of 3,400, that's just like the other one. And what if we copy down? Let us see what happens for if or. Now most people are getting, you can see almost everybody is now getting, because at least they have met a condition. It's not like the other one where not all conditions were met. In this case, if you just meet any of the condition, then a true value or statement will be brought by the formula there. Now we can just copy this. You can just copy the formula. So you are copying the formula, then bring it here, then you are pasting the same formula, or back. So you copy the formula, then you enter, then you come here, then you paste the formula so that it comes here. Then you change a few things. This was, now this case is tour, granted or denied. So you do away with this, and you just write something else now, which is granted. And you close that. The other one will be denied, granted and denied. Then you punch enter, then you'll have your other solutions. Then you copy down. What we have are the results for the other guy. So here, for if or, it's more lenient. If you just meet any of the conditions stipulated, a true value or statement will be brought. And in this case, only one person is not meeting the condition that was stipulated, and therefore that is why we have no price here. Now, let us see those who are going, but just by, like David. If you reduce the age to 15 because he's surviving because of age, he's now being denied and it's no price. And look at another one here, Janet Tor is going because of MA, got 89. If he scores 67, that one now is also being no price or denied. Another one that went is 78 with only surpassing tax. If you reduce this from 78 to 75, then that one is also just being denied. 75? No, 74. That one will also be denied here as no price or denied. That one is also no price or denied in that particular case of the student. Then there is also, let's say, Philip Tan. This one we can also reduce the tax marks to 72. And we see that this one is also 72, Philip Tan. Now the age, 19. And you can see it's adjusting across the formulas, no price or denied. So in this case, if you just meet any of the condition, a true value or statement will be brought. Like we can see this person, Gary Hall, is 15 years, did not meet the age. 70 for FA was met, the other one was met. There is also a person who did not meet something here but granted. Paul Henry only scored 58 but was granted because he has met at least a condition. So even if somebody is scoring zero in those other things, but at least met the age condition here, still is granted because the condition of age has been stipulated. Or let's say this person here is underage, that is 5 years, but also did not do well in FA, so scored 17. Also did not do well in MA, only scored 23, but scored 19 in tax. This person will still be granted on the virtue that he has made it in tax other than those others. So that is how the if and if or statement formulas or Excel formulas are used for analyzing data in an Excel spreadsheet. Thank you, and I hope your assignments and other things that will enable you to improve your skills and knowledge on the if statements. Hello, and welcome to this session of Advanced Excel Formulas. In this session, we are going to cover formulas that are related to the if statements. If statements are advanced formulas that are normally used when you want to analyze your data and come up with formulas that will give you certain criteria. And with me here, I have created a workbook that will enable us to go through a variety of if statement formulas that are in use here. The first one that we are going to tackle will be the if statement formula. Now, if statement is a formula in Excel that helps in analyzing the contents of a single cell, and it analyzes the contents of a single cell and compares it against a condition that you've specified or a condition that you've stipulated. If the contents of the cell that you are analyzing surpasses the condition that you've set, then the formula will give you a true value, a true statement, or a true formula. But if the contents that you are analyzing don't meet or don't surpass the condition that you stipulated, then the formula will give you a false value or statement. So let us go straight to how the if statement is applied so that we can be able to see what happens if we use the if statement formula. So with me, I have come up with data that we are going to use. This is the student's grade sheet. It has column A through to column E. There is student name, there is the age of students, the exam score, there is age status, and there is grade. So we have a grade here. And first, we are going to look at the age status. And you can see the age status, we've stipulated a condition. There are conditions that have been stipulated here. Now for age, if the content or the cell that we're analyzing surpasses 20 as the condition, then the formula will give back youth. But if it is less than 20, the formula will give us teen. So if it is greater than, we can use greater than or equal to 20, the formula will return youth. But if it is less than 20, the formula will return teen. So let us see how that is to be done using the if statement formula. First, we are going to precede every formula with an equal sign. So every formula is preceded with an equal sign. Then we type if, then double click on, you can see if checks whether a condition is met and returns one value if true and another value if false. So I'll double click on the if. Then you click on the value that you are testing, the logical test, the value that you are testing here, which is 34. So B4, where there is age, so 34. We are analyzing 34. We are analyzing 34. So if that cell, which is B4, and it represents 34, is greater than, so we are going to look at a condition that you've stipulated. If that is greater than or equal, now the condition is 20, we type 20. Now if B4 is greater than or equal to 20, comma, then the formula should give you youth. So the youth is going to be put in bracket in quotations. So full quotation, youth. Then you close the quotation. But if that is not met, then the formula should return teen. So the formula should return teen, and we are going to have the teen there. So if before the cell that you are analyzing is greater than or equal to 20, the formula will return youth. Otherwise, if that condition is not met, the formula will return teen. So teen is going to be there. You close the bracket, and after closing the bracket, you hit enter, and it returns that this person is a youth. You can see the person is a youth because the age is 34. 34 is greater than 20, and therefore the formula returns youth. Once that has been done, you copy your formula down up to where Tonet Meg is, and the rest will be pre-filled. Now, Lewis is a youth. David Jack is a youth. Cheryl is a teen. Of course, the age is 18. Gary Hall is 15 years. That one is a teen. We have another youth here. Of course, everything has been brought by your formula or the formula that we entered. So if the age is greater than 20, the formula returns youth. But if the age is less than 20, the formula returns teen, as it has been seen in the if statement formula. Now again, we also have exam score, and we are going to analyze the exam score using the condition that have been stipulated here. Now, the condition is that if somebody scores greater than or equal to 60, the formula will return pass. But if somebody scores less than, this one should be less than. If somebody scores less than 60, the formula should return fail. So how is that particular formula applicable? So equal sign, then if, then you double click on the if. You click on the cell that you're analyzing. The cell that you're analyzing, in this case, you're analyzing 80. 80 is C4. C4. So instead of typing, instead of clicking, you can just write C4. That is if you know the cell that you're analyzing, comma. If C4 is greater than, if C4 is greater than or equal to 60, the condition is 60 here, 60, comma, then the formula will return pass. So pass should be in quotation. The formula should return pass. You close the quotation. Otherwise, the formula should return fail. So if the condition above on the left is not met, the formula should return fail. And fail should also be in quotation. So fail should also be in quotation like that. So after that, you hit enter, and the formula, of course, has some error. So we see where the error is. So if C4 is greater than or equal to 60, comma, the formula should return a pass. Otherwise, the formula should return fail. So let us see where the error in the formula is. And okay, so the formula is going to be redone. So if C4 is greater than or equal to 60, comma, then the formula should return pass. You close that, comma. If not, that is not the case, the formula should return fail. So the formula should return fail. Then we close the bracket and we punch enter. Let us see where the error is. C4 greater than or equal to, okay, so the comma was there after C4, then enter. Now it comes back. So we were putting the formula in just after C4, which was wrong. So if you miss a quotation, if you miss a comma, or if you miss where to place anything, the formula will give you errors, which is what we've encountered in our just concluded errors that happened there. So if you punch enter, then pass. That means if you score 80, the formula will return pass. Let us copy the formula down using the autofill here. So you click on the bottom right side of the formula, then drag it down all the way to Tonet Meg. So the rest, everybody who scored above 60, the formula returns pass. Anybody above 60, the formula returns pass. Anything below that, fail. Like a Cheryl failed, got 50. Gary 40, that one failed, all the way to 72 here. That is Vim, who scored 72, and that is a pass. So that is how the if statement is applicable in analyzing whatever data that you have in terms of what we've seen here. So the formula can be applied in a variety of ways. You can use it to be able to determine whether your sales were high or they were low sales, or whichever any other analysis that you want to come up with. So that is the if statement. We now want to move to the second analysis, which is nested if. So on our other sheet, we have nested if, which we want to go to and analyze how different things can be done now using the nested if statement. Now, nested if statement, just like the if statement, it analyzes the contents of a single cell. It analyzes the contents of a single cell and compares it against a given condition, and compares it against given conditions. So it analyzes the contents of a single cell, but compares it against given conditions, compares it against given set of conditions, and it returns a true value or statement if the tested condition is met. Otherwise, it will be returning a false value or statement if the tested conditions are not met. So the nested if statement, it analyzes the contents of a single cell and compares the contents against several given conditions, so that it returns a single value statement or formula if one of the condition is met. Otherwise, if no condition is met, then it returns a single false value statement or formula. That is the nested statement here. So in this case, we want to analyze the grades of students on this student's grade sheet. And with me here, I have the students' names. There is Cat 1, there is Cat 2, there is Assignment 1, there is Assignment 2, there is presentation that was done, there is an exam that was also done, then there is total, then there is analysis for grade 1, and also analysis for grade 2 in that particular order. So first, we want to get the total. Remember, for you to get the total, it has to be the summation all the way from Cat 1 to exam. And the best formula that we can use here is AutoSum. You can see AutoSum. So you just click on sum and it predicts that indeed you want to sum everything on the left. So that is AutoSum. Then you punch enter. Or you can say sum. Then you double click on the sum. Then you just highlight what you want to sum up to exam. Then you close your bracket. Then you punch enter. That is the same thing. Anyway, I want to drag the formula down so that the rest of the answers can be pre-filled. Then I want to reduce this to 1 decimal place. 1 decimal place, which means I'll decrease the decimals here. You decrease the decimal so that it's 1 decimal place. Then there is grade 1, there is grade 2, and there is the conditions that we want to follow here. So you can either come up with A, B, C, D, E, or from distinction through fail. If a student scores above 75 or equals to 75, the formula should return grade A or distinction. If a student scores 60 or above, the formula should return either B or credit. If a student scores 40 or above, the student should return C or pass. If a student scores 30 or above, the formula should return D or refer. If a student scores 30, less than 30, if a student scores now less than 30, if a student scores less than 30, that one is to be changed, then that should be an E or fail. So we'll start A through E for grade 1, then distinction through fail for grade 2 here, using the nested if statement. The only difference between nested if statement and the if statement is that for if statement, there is only one condition. But for nested if statement, you'll be comparing the contents of your cell against several given conditions. So straight to the formula, you precede your formula with an equal sign. Then if double click on the if. So if the cell that you are analyzing is where the totals are, if that is 23 here, H4, which is 23, is greater than or equal, the condition is 75, so greater than or equal to 75. If H4 is greater than or equal to 75, then comma, this formula should give you A. So you type A, then close it in the quotation marks, then comma. Again, if, again you double click on the if, the same H4, which is 23, is greater than or equal to, the other condition was 60, greater than or equal to 60, comma, then the formula should give you credit. So the next one there was credit. Then that one is also enclosed in the closing bracket, then comma. If the same cell, H4, formula is missing an opening here. So if, then you double click on the if, H4, the same cell, is greater than or equal to 40, greater than or equal to 40, then the formula should give us C. So we're going to type C in quotation. So that will be C. Then you close the C like that. I missed here. So this ought to have been D. So I'm going to correct this to D. There is A, not B, but B. A, B, C. Then now we move. Again, if H4 is greater than or equal to 30, comma, the formula should return or give us a D. So that one is a D there. We close. Then now we are on the last one. We have A, we have B, we have C, we have D. Now for the last one, there is no need of starting with if again. You just come up with the comma, then you bring the quotation. Of course, it assumes that whatever has been said already is not met. Then whatever follows will be E. That is what, if what is on the left is not met, then the formula should just give you E straight away. So if you don't meet to be in the category of A, B, C, or D, then you'd be in the category of E. Then you close the brackets depending on the number of brackets that are open. So how many brackets are open? 1, 2, 3, 4 brackets are open. You're going to close ours with, again, 4 brackets. So 1, 2, 3, 4. After that, you hit enter and it will give you that the first person indeed scored an E. So you can see our formula here, the way it has been typed on the formula bar, and that is what is expected of us to do. So you copy it down and the rest will just appear. A few people have gotten E's, others have gotten A, like 80 is an A, 43 is a C, 62 is a B, 39 is a D, all the way to 24 being an E, 85 is a, we have C's, and we also have other D's there. So this is the score after analyzing these particular grades using the if statement formula. Again, we want to analyze the same thing, but now where there was an A or E or D or C, we are going to replace with distinction, credit, pass, refer, and fail in that order. This was 75. This was 75. Let me see if that was 75. It is correctly put. So again, we want to now replace with the distinction through to fail using the same formula. So equal sign, if, then you double click on the if. If the cell that you're analyzing is this 23 where there is total, that is E4, if that is greater than or equal to 75, comma, then the formula should give us distinction. the formula should give us distinction. The formula should give us distinction. Comma. If, again double click on the if, the same cell is greater than or equal to 60, comma, then the formula should give us credit. The formula should give us credit. So you enclose, comma, then again, if the same cell is greater than or equal to 40, then the formula should give us that was if it's greater than, that was pass, comma, then again, if the same cell is greater than or equal to 30, comma, the formula should give us refer. The formula should give us refer. You close the bracket, then the last one automatically, comma, then you bring in, the other one is fail. The other one is fail. Then you close with the number of brackets that are open. 1, 2, 3, 1, 2, 3, 4. That is 1, 2, 3, 4. So you're going to close with the 4 brackets. 1, 2, 3, 4. I hope all the brackets have been presented, and that one is a fail for that particular student. So this one had everything. There was 30, there was 40, yeah. So once that is pre-filled, you copy your formula down again, and let us see if it is corresponding to the way we needed. So you can see E is fail, A is distinction, C is pass, B is credit, C is pass, B is credit, D is refer, E is fail, A is distinction again. So this is how you analyze your data using if statement and also using nested if statement. So that is if statement and nested if statement.
Hi candidates, welcome to another session of manifested online classes. So we are still continuing with the topic of public sector accounting, and in this particular session I want us to look on IPSAS 26, which deals with the impairment of cash generating asset. Now the first important point for you to note here is that IPSAS 26 is drawn primarily, or is written primarily from IS 36. So meaning that in terms of how we determine the impairment loss under the two standards, IS 36, International Accounting Standard number 36, and IPSAS 21, IPSAS 26, the same approach is used. And if you can be able to recall what we said under IS 36, or in the topic of determining the impairment loss under IS 36, we said impairment loss of those particular assets which are owned by the private owned entities or the profit oriented entities is equal to the carrying amount minus the recoverable amount. The recoverable amount we were determining that as the higher of two values, the net realizable value or the fair value less cost to sell, and the value in use. And the value in use we were determining that as the present value of the estimated what? Cash flow. So that is the same approach which is used under this particular standard what here. But maybe first of all we can say that IPSAS 26 is drawn primarily from IS 36. IS 36. So basically this means that the two standards are the same, are the same, and therefore impairment loss under the two standards, the two standards we are talking of IS 36 and IPSAS 26 is the same. Impairment loss under the two standards is determined in the same way. determined in the same way. Let's look on how we determine this particular impairment loss under the two standards. So the impairment loss in this case is always equal to the carrying amount of an asset, or basically the cash generating assets, and then to this we lay something called the recoverable amount. So we don't use the word recoverable service amount as we were using under IPSAS 21, but here we talk of recoverable amount. So the carrying amount or the net book value, this is determined in the same way. We take the cost minus what? The accumulated depreciation. But what about the recoverable amount? The recoverable amount. So the recoverable amount, this is defined as the higher of two values. So basically we can say that this is the higher of cash generating assets. Number one, net realizable value, or the fair value less cost to sell. Selling the asset currently minus the cost which will be incurred in selling that particular asset. We take the higher of that, all over 2, something we refer to as the value in use. The value in what? In use. The value in use. So basically in this case, when we talk about the value in use of cash generating asset, this is equal to the present value of the expected cash flows, expected to be generated, continued use of assets, and from its disposal. So that is how we define the value in use of a cash generating unit. Recall what we said in our previous session. To determine the value, or basically the value in use of a non-cash generating asset, we define that as the present value of the remaining service potentials of a non-cash generating asset. So therefore, you can see the definition of this particular term here. The value in use under IPSAS 21, IPSAS 26 is different. That is something which is important for you to be able to do what? To note. You may come across a question whereby the examiner is requiring you to define the value in use under IPSAS 21 or under IPSAS 26. You can see the definition is what? Is the same. So I think we can look on additional definitions here, which equally you may be required to define in an exam. The first term maybe we can start by defining here is a cash generating unit, abbreviated as CGU. So when talk about the cash generating unit, basically we say this is a group of, or actually the smallest group of identifiable assets which are owned by an entity, or which are held by an entity with an objective, with a primary objective of generating some cash flows, which are largely independent from cash flows generated by other assets. So therefore you can say that this is the smallest identifiable group of assets held by an entity with a primary objective of generating commercial returns, or basically cash flows that are largely independent from cash flows, or basically from other or from commercial returns, cash flows or commercial returns generated by other assets or group of assets, or group of what? Of assets, or group of assets. So that is how we define a cash generating unit. A group of what? Asset, which are held with a primary objective of generating cash flows, which are independent from cash flows, which will be generated by other what? Assets. So the other term we also need to define here is maybe we can define the value in use, although I think we have briefly mentioned that here. So we generating a cash generating asset. And we have said that this value in use of a cash generating unit is quite different from the value in use of a non-cash generating unit, because you have said that this is basically equal to the present value of expected what? Cash flows, which will be generated from the continued use of the asset and also from its disposal. Disposal. So these are basically some of the terms which the examiner, or which you may be required to define in an exam. One of it is the recoverable amount, and in this case we are talking of the recoverable amount of assets. You may also be required to define this other term here, which is a cash generating unit, and also what you refer as the value in what? In use. But basically what you have said is that IPSAS 26 and also IS 36 basically are the same, meaning that how we determine the impairment loss at the two standards is actually the same. And actually we don't have any question which has been tested from this particular standard here, whereby the examiner was requiring a candidate or candidates to compute now the impairment loss at the IPSAS what? 26. So the questions which are usually tested are questions at the IAS what? 36. So most of the questions which come from this particular standard here, they require you to define a number of what? Of terms. Like you can be required to define the cash generating unit, the what you refer as the value in use of cash generating asset, or maybe the recoverable service what? Amount. So that basically is the end of that particular small subtopic regarding a determination of impairment loss of the cash generating assets in accordance with the reference to IPSAS 26, impairment of cash generating asset. Explain the following terms. Number 1, value in use. Number 2, recoverable amount. And number 3, a cash generating unit. So that is today's assignment. See you in the next session. Hi candidates, welcome to another session of Manifested Online Classes. So we are still continuing with the topic number 6 of Advanced Financial Reporting and Analysis. In this particular session, I want us to look on one of the subtopic in that particular topic, which is a topic on integrated reporting. And when talk about integrated reporting, is basically a form of reporting by an organization, whereby the organization will basically report now to the various stakeholders about its strategy, about the governance process, and also its performance in context of the external environment, how it is in a position to do what? To create wealth in short, medium, and also what? Long term. This particular information is very, very important regarding how the organization is able to create wealth, because for example, the shareholders of the organization, or basically the shareholders in a company, will be in a position to assess the ability of the organization, the ability of the entity to do what? To create what? Wealth. So therefore, you can say that integrated report is a concise is a concise communication about organization's strategy, about the organization's governance, and its prospects, So basically here when talk about the prospect, we are talking of how the organization is likely to do what, to perform in the future in context, internal, external environment leads to creation of wealth, in a short, medium and long term. So therefore, in this case, we are saying integrated report is basically that concise communication about how the organization's strategy, performance, and also governance. Governance, in this case, this is a process through which now the organization affairs are directed and also what? Controlled. And also in context of the external environment leads now to the creation of wealth. So how is the organization, or how are all these particular factors make the organization to do what? To create wealth. Remember, in this particular case, we have said that the primary objective of an integrated report is to provide information or basically to explain to the providers of capital, e.g. the shareholders and maybe the creditors, how the organization create wealth over time, or basically how the organization create wealth in short, medium, and also what? Long term. And basically we are saying that this particular report therefore will contain, therefore you can say that the primary objective of integrated report is to provide information to the interested stakeholders, to provide information to interested stakeholders, or basically you can talk of providers of capital, about the entity's ability to create wealth over time. So basically the primary objective of the integrated report, we are saying, is to provide information to the providers of capital. And in this case, we are saying that we talk about the providers of capital here. We are talking of parties such as the shareholders who provide capital by buying shares. We are also talking of the creditors, for example, the debenture holders, the suppliers. So this particular report explained to them the ability of the organization, the ability of the company to do what? To create wealth over time. Over time. And also on the other hand, what you are saying is that this particular integrated report basically will benefit now the stakeholders interested in the organization about now that particular ability of the organization to do what? To create wealth over time. And the various stakeholders who are usually interested with this particular report include the shareholders of the shareholders, include the employees, include the customers, include the suppliers, and also include other business partners. So therefore, in this case, we can say that integrated report, abbreviated as IR, benefits the various stakeholders, e.g. shareholders, customers, we also have the potential investors, we also have the creditors, We also have the creditors. We have partners. About the entity's ability. About the entity's ability to do what? To create wealth. To create what? To create wealth, including shareholders, the creditors, including the employees, about now that entity's ability to do what? To create wealth. To create what? Wealth. Then in this case, we can proceed and look on some of the principles which underpin, or basically some of the principles which underlie the presentation and also the preparation of the integrated report. So whenever this particular report is to be prepared, so which principles underlie or basically guide the organizations in terms of the information to be included in this particular report, and also how should that particular report be prepared. So therefore, let's look on guiding principles. Guiding principles, and we say that the following principles, and in this case, when we talk about the principles, these are is actually the same with the rules. The following principles, or basically rules, we can say underpin, or in other terms, underlie the preparation and also presentation of the integrated report, underpins, or basically underlie the preparation of what you refer as, that is preparation, and also what? The presentation of what? Of the integrated report, and the contents and its content and preparation, or maybe you can just talk of its content. So therefore, we have a number of rules, or basically a number of principles which underlie, or basically which underpin the preparation of the integrated report. So basically what that means is that anytime an organization is preparing an integrated report, which will be providing information about how the organization is in a position to create wealth, then we have a number of principles which underpin, or basically which underlie the preparation of this particular report. So one of the principles is something we refer to as the strategic focus and future orientation. So number one, you can talk of the strategic focus and future orientation. And future what? Orientation. So in this case, when we talk about this particular principle here, that is a strategic focus and future orientation, we say that an integrated report which is to be prepared by an organization should provide insight about the organization's strategy and how it relates, or basically how the organization's strategy reads, or basically relates to the organization's ability to do what? To create value. To create what? Value, or basically to create what? To create wealth. So therefore, we can say that integrated report should provide insight about organizations strategy, about the organization's strategy, and how it is related, to organization's ability to create value or wealth. How it is related to organization's ability to create value. Or in other terms, to create what? wealth. So therefore, that integrated report which is to be prepared, we are saying should provide information, should provide insight about the organization's strategy and how those particular strategies which have been put in place by the management of the company are related to the organization's ability to do what? To create value in short term, medium term, and also what? Long term, and also long term. So the other guiding principle which underlie or basically underpin the presentation of the integrated report is something to do with connectivity of the information. Number two, we have connectivity of information. Connectivity of information. So basically this is the other and also the presentation of the integrated report. Now in this case, when we talk about the connectivity of the information, we say that the integrated report should show a holistic picture of the combination of that is combination and the relationship between what we refer as create wealth. So we are saying integrated report should actually do what? Contain a holistic, or basically should show holistic picture of the combination and also what? The relationship of the factors that affect the abilities what? Organization to do what? To create wealth. So integrated report should show a holistic picture of combination and a relationship of factors that affects organization's ability to create wealth, or in other terms, to do what? To create value. Connectivity of the information. Connectivity. So how the factors, or basically that is the combination and the relationship of the factors which now affect the organization's ability to do what? To create value, to create wealth in a short, medium, and also what? Long term. So the other principle, which is number 3, which underpin the preparation and also the presentation, that is preparation and presentation of this particular report, is something called this, the stakeholders relationship. Stakeholders relationship. Number 3, we can talk of stakeholders relationship. So basically in this case, when we talk about the stakeholders, we are talking of parties having some interest in the organization. And actually in this case, when we talk about stakeholders, we are talking of parties such as the shareholders, the customers, the potential investors, the creditors, the business partners, and also the employees. So therefore, the integrated report which is prepared by an organization should provide insight into the nature and quality of the organization's relationship with the key stakeholders. With the key stakeholders. So therefore, you can say that should do what? Show the organization's relationship with key stakeholders, and how it affects organization's ability to create wealth. Or to create value. To create what? Value. So we are saying here, that is now the nature, the quality of the relationship between the organization and the key stakeholders, and basically how it affects the abilities organization to do what? To create wealth or to create a value. To create what? Value. So the other principle which also underpins the preparation of this particular report is something to do with the materiality. Materiality. So basically when we talk about materiality, this comes from the word material, and actually when we talk about materiality, we can say is like the significance is like the importance of certain information as far as the decision making process is what is concerned. In this case, we say that an integrated report should disclose information, or basically should disclose matters that affect the organization's ability to do what? To create value. So the integrated report should disclose that particular factors, those particular matters which do what? Which affect the organization's ability to do what? To create wealth. Integrated report should all factors that affect organization's ability to create value. Basically what that means is that according to this particular principle of materiality, those particular factors or those particular matters which by the end of the day do not affect the abilities or the ability of the organization to create wealth or to create value in short, medium and long term, they do not need to be included in this particular what? They do not need to be included in this particular what? Report. So let's proceed and look on the other principle which underpins the preparation and presentation of the integrated report. So that is principle number 4. Number 4. That is number 5. So when talk about or basically number 5 here, we talk of conciseness. We talk of conciseness. So when talk about conciseness, remember from our definition, we have said that integrated report is a concise communication. Is a concise what? A communication. Basically what that means is that the integrated report which is prepared by any organization must be concise. Must be what? A concise. So mean that it must include sufficient information which will help now the various stakeholders to understand the organization's strategy, governance, performance, and prospect without being burdened with less relevant what? Information. So therefore, in this case, we can say that integrated report must be concise. Must be what? Concise. In other terms, it should not contain irrelevant information. It should not contain irrelevant information. It should only contain interested stakeholders to do what? To understand the organization's strategy, performance, and also governance, and how that enable the organization to do what? To create wealth. To create what? Wealth. Then we can talk of the other principle, which is principle number 6, and that is a principle of reliability. The principle of reliability and completeness. Reliability and completeness. Reliability and completeness. So basically, when we talk about this principle of reliability and completeness, it basically means that the integrated report which is prepared by an organization must contain matters which are positive and also what? Negative, in a balanced way and without any material what? Error. So that means that the integrated report must be complete. Must be complete means that it must contain all material matters. All material matters. When we talk about material matters, these are those particular matters which will help the various stakeholders and say integrated report must do what? Must be complete. must be complete, complete and reliable. Reliable means that it should not contain errors. And reliable, or basically we can say, must be complete and should not contain material errors. Should not contain material errors. Otherwise, if the integrated report which is prepared contains some material errors, then we can say that it is not reliable. It is not reliable. You cannot rely on a report which is containing some what? Some material errors. And then we have the last principle, the last rule which underlies the preparation, the presentation of this particular report, and that is something called the consistency and comparability. Consistency and comparability. Consistency and comparability. Consistency and comparability. So basically the word means is that the integrated report which is prepared by the organization should be prepared in the same way, in different years, in different what? Years. So the company should not keep on changing the manner or is being prepared. So it must be prepared in the same way. So this will basically help now the various stakeholders like the shareholders, the customers, the employees, in terms of maybe comparing the ability of the organization to create wealth in the integrated report must be prepared in the same way, of a different, or maybe, and in this case we are saying that this now will help the various stakeholders like the shareholders, the employees, to do what? To compare the ability of the organization to create wealth equally in different what? In different years. So therefore we have those as the 7 principles which underpins the preparation of the integrated report. That is strategic focus and future orientation, connectivity of information, shareholders relationship, materiality, which is number 4, conciseness, whereby we have said integrated report should be concise, should only contain information which is relevant. And then the other principle is reliability and completeness, and the other one is consistency and comparability. So finally, let's look on the content of this particular report. So which information should be contained in the integrated report? So we look on the contents of integrated reports, and from our definition we can be able to come up with a number of contents, because we defined an integrated report as a concise word communication about how the organization's strategy, performance, governance, prospect, and in context of the external environment lead to the creation of wealth. Lead to the creation of what? Of wealth. And therefore this particular report, from our definition number 1, we can say it includes information about governance. Governance, we are talking of how the affairs of the company are controlled and managed. Information about the composition of the board of directors, information about the organization structure. All this particular information will be included in the integrated report, and basically how the governance process of the organization help the organization in terms of creating what? In terms of creating wealth. So the other content of integrated report is the business model. The business what? Model. The business model, how the company operates. So the other information is something to do with the outlook of the organization, outlook of the organization, how the various stakeholders are able to view the organization. Are they viewing the organization in a positive or basically in a negative way? So this particular report here will also contain information about the performance. Maybe how the company is performing, and this is purely information about the financial performance, performance. So the other information which also need to be included here are the risks and opportunities. So some of the risks which the company is likely to face in the market, and some of the opportunities which are equally available in what? In the market. Available in the market. So the other information or the other content of this particular report here is something called the organization overview and external environment. Organization overview, and external environment. Organization overview and external environment. Basically, when we talk about the external environment here, we are talking of some of the external factors, or we are talking of the macroeconomic factors which are likely to affect the entity's ability to do what? To create wealth. Wealth. So equally here, or the other content, we can talk of the strategy. Is something we can get from our definition, strategy. So those particular strategies which are put in place by the management, and something to do with the resource allocation. Allocation of the resources. And finally, we have information about the basis of the preparation and presentation of the preparation and presentation of integrated report, of which in this case, when talk about the basis or the basis of preparation and presentation, the management of the company here will be explaining to the stakeholders that they prepared the integrated report based on these particular principles. Remember, here we have talked about 7 principles which underline out the preparation of what we refer to as integrated report. So therefore, we have those as some of the elements, or actually some of the contents. Actually, these can also be referred to as the elements of the integrated report. Anytime an organization prepare an integrated report, then that particular report should contain those particular element or content. That what need to be covered as far as the integrated report is concerned. So, and therefore, here you need to be in a position to define what is an integrated report, and also to know what is the significance of this particular report in an organization. What are some of the principles which underpin the preparation of this particular report, and which information need to be contained in that particular report. So before we wind up, I want to give an assignment here. So we have 3 questions. Question number 2, explain the guiding principles which underpins the preparation and presentation of integrated report. Question number 3, explain 8 contents or elements of an integrated. And so we stop at that particular point. See you in the next session. Hi candidate, welcome to another session of manifested online classes. So in this session, I want us we continue with this particular subtopic here, or presentation, or basically preparation of interim financial statements, and that is basically governed by IS 34. So interim financial statements are those particular financial statements mostly prepared by companies, whether listed or not, for a period less than 1 financial year. Like generally what we know is that any listed company mostly prepare financial statement on quarterly basis. Those financial statements can be complete or they can be condensed. And therefore, what IS 34 do is basically to prescribe, to give the minimum content of those particular financial statements prepared by listed companies or other companies for a period less than one what? Financial statements are financial reports. Financial reports prepared by companies less than 1 year, for a period less than 1 year, e.g. a quarterly basis, a quarterly basis, or half year basis, or half a year, half year. So meaning prepared, or the company is preparing financial statements after every 6 months. Those particular financial statements, we refer to them as what? Interim financial statement. Now, this particular standard here, that is IS 34, we have said it prescribes the minimum content of the interim financial statement. So these financial statements which are prepared on quarterly basis or basically on half-year basis, what should be contained in those particular financial reports or financial statements? So we can say IS 34 prescribes the minimum content of interim financial statements. Interim financial statements. And equally, we can proceed and look on those particular content, what should be contained in this particular interim financial statements. So we can say that they include the following. We have around 5 content of interim financial statement. Number one, we have the condensed statement of comprehensive income. So we also have the condensed statement of financial position, or basically condensed balance sheet. Then we have condensed statement of changes in equity. And then we also have condensed statement of cash flows. And finally, number 5, we have the selected notes. To financial statement. So therefore, a complete set of the interim financial statement prepared by the company either on quarterly basis or half-yearly basis should comprise of those particular 5 content. So then finally, I think we can define some few terms which are defined at this particular standard here. Definition of terms. So we have two main terms we need to define here. The first term is something called the interim period. Interim period, basically, I've said, is a financial reporting period less than 1 year or less than 1 financial year, e.g. 6 months, e.g. A quarter, or basically a period of what? A period of interim period. And we can say that this is a financial reporting period. Financial reporting period of less than 1 year, e.g. a half year. In this case, we are talking of a period of 6 months, or a quarter. Quarter of an year, here we are talking of a period of 3 months. So therefore, interim period is any financial reporting period of less than 1 year, e.g. half a year, a quarter, and so on. So then from there we have the other term which we need to define here, and that is interim financial report. Interim financial report. So when talk about the interim financial report, maybe from what we know, basically financial statements, which now will be prepared by an entity or even by a company for a period of less than 1 financial year. So therefore, you can say that these are financial reports, or even financial statements, containing condensed or complete financial statements for a period less than 1 year. For a period less than 1 year. So therefore, that basically how we define the interim financial report. So basically, those are some of the terms you should be in a position to define, and also in this case, you should be able to remember what is the provided for under this particular standard here, that is IS 34. And basically, I've said this standard basically applies whereby a company is preparing the financial statement for interim period. Interim period, we have said, is a period which is less than 1 financial year, e.g. a quarter, e.g. half a year, and so on. So when a company is preparing the financial statement for such a period, how should they be prepared? What should be contained in a complete set of interim financial statements? Some assignment I want to give here. We have 2 questions. So the first question reads, in context of International Accounting Standard number 34, interim financial report period. The other term, number 2, is interim financial statements. So define those 2 terms. And then the other question, which is question number 2, explain 5 contents of an interim financial report, and also in accordance with what? IAS 34 or International Accounting Standard number 34. So make sure you attempt those particular questions, and basically that brings us now to the end of that particular subtopic. See you in the next session. Hi candidates, welcome to another session of Manifested Online Classes. We are still soldiering on with the topic number 6, and in this particular session, I want us to look on one of the subtopic from that topic number 6, which is on materiality guidelines for financial reporting. So when talk about the materiality, basically we are talking of the significance, or basically we are talking of the importance making is concerned. So mean that if an item is important, if an item is significant as far as the decision making by the users is concerned, then in that particular case we can say such an item or such information is material. Such information is material, and therefore materiality guidelines for financial, those items which are material and which must be included in the financial statement to be prepared, because by the end of the day, if they are not included in those particular financial statement, automatically they will affect and the decisions now which are to be made by who? By the users of the financial statement. So therefore, first of all, we can say that materiality guidelines helps entities in determining the to be included in the financial statements, to be included in the financial statement. So materiality guideline will help the entities to determine the items, or basically the information which is to be included in the financial report, or basically the financial statement, because if that particular information is not included there, then you're saying that that may adversely affect the decision which will be made by users of those financial reports or the users of those particular financial statements. And also recall here we have said that when we talk about the materiality, we have said that this is the significance or the importance of financial information, the significance or basically importance of financial information in decision making. So if an item in this case we have said is material and therefore is likely to influence, is likely to affect the decision which will be made by the users of the financial report or the users of the financial information, then basically you have said such information is said to be material. But on the other hand, if information will not affect the decision to be made by the users of the financial statement, then we say such information is immaterial, and therefore such information do not necessarily need to be included in the financial report or basically the financial statement to be prepared by an entity, because by the end of the day it will not influence, it will not affect the decision now to be made by the users of who? The users of the financial statement, the users of who? Of the financial statement. Maybe we can further proceed and we define the materiality concept in details. Let's look on the definition of materiality concept. Definition of materiality. Definition of materiality concept. Of materiality concept. So already we have said that materiality comes from the word material, and basically you have said materiality is what? Is the significance, or basically is the importance of a financial information as far as decision making is what? Is a concern. So therefore we can say that materiality can be defined to be what? Materiality can be defined materiality can be defined to be the significance or the importance of financial information in decision making process. And therefore we can proceed and we say that financial information which is likely to influence the user's decision is material, and as such it must be included in the financial statements, or basically it must be included there. So therefore that information which is likely to influence, or basically which is likely to affect the decision which will be made by the user, we are saying that information is material. So anytime the company is preparing the financial statement, that information must be included there. Otherwise, if the company prepare a financial statement and such information which is material is omitted, then we can say that this particular financial report, this particular financial statement which are prepared, then they are misleading because they do not contain information which is basically material. Which is what? Which is material. Now, in this case, the number of factors which determines whether an item is material or not. In determining whether a financial information is material or not, the number of factors which may determine that. So therefore, we can look on the factors influencing the materiality, factors influencing materiality of financial information or financial information. So which are some of the factors which determines whether a financial information is material or not? So number one, we have the nature and the magnitude, the nature and magnitude of the transaction. The nature and the magnitude of what? Of the transaction, or basically we can talk of nature and the magnitude of the item. So when we talk about the nature and the magnitude, we are referring to the amount which involved in a certain transaction. The amount involved in a certain transaction. Generally, large transactions, or basically those transactions which involve huge amount of money, then we say that they are material. They are material because if they are omitted in the financial statements which will be prepared, then we can say that those particular financial statements are misleading because they affected by the fact that there is a huge transaction, or basically there is a transaction which involves huge amount of money which was omitted from those particular financial statements. So therefore, here when talk about the nature and the magnitude, we are talking of the amount involved. We are talking of the transaction involving shillings 200. Then we can say that this transaction is material. It involves huge amount of money. So if it's omitted from the financial statement, then the financial statement, we can say that they will be what? They will be misleading. They will be what? Misleading. But if this particular transaction, for example, is omitted, then the decision which will be made by the user may not be affected, because you can see this is an insignificant amount. Insignificant what? Amount. So the other factor which determines whether financial information is material or not is something called the legal and regulatory requirements. The legal and regulatory requirements. Legal and regulatory requirements. So when we talk about the legal and regulatory requirement, there are those particular transactions which are supposed to be disclosed by companies in their financial statements, irrespective of the amount involved. For example, in accordance with the International Accounting Standard number 24, which deals with the related party disclosures, any transaction between an entity involved, irrespective of the amount involved. So therefore, all the related party disclosures, irrespective of the amount, we say that they are material. They are what? Material. Because if the company do not disclose those particular transactions, then we can say that the financial statements prepared do not comply with these particular standards, because the related party transactions were not what? Were not disclosed. So therefore, the other factor which determines whether an item is material, whether financial information is material, is the legal and also the regulatory requirement. Any financial information which need to be disclosed by a certain accounting standard, by the regulatory requirement, we say is material irrespective of the amount. Irrespective of what? Of the amount. Now, the other factor which also determines whether an item is material or not is what we refer as the user's need and expectation. the user's need and what? The expectation. We can talk of the user's needs and what? And the expectation. The user's need and the expectation. So when talk about the user's need, we are talking of what the users of the financial statements are interested in the financial statements, are interested in the financial statements. So therefore, the user's need and expectation determines the materiality of an item. So if, for example, maybe there is some information to see in the financial statement, and that information has not been disclosed, irrespective of the amount involved, then we can say that that item is material because the shareholder, the potential investor, has not been able to see that item he was expecting to see from the financial report. So therefore, the decision which he will make will be affected by the fact that that item has not been what? Disclosed, has not been disclosed. So the other factor which also determines the materiality is something called the entity's specific consideration. The entity's specific consideration. Entities specific consideration. Entities specific what? Consideration. So in this case, when we talk about the entities specific consideration, we say that each entity should consider its unique circumstance. Its unique circumstance, what we refer as the industry norm and the reporting practice. And the reporting what? Practice. So it means that there are those particular financial information which must be disclosed by certain companies operating in certain what? Industries. And therefore, if such items are not disclosed, irrespective of the amount involved, then we say that those financial statements which were prepared by such a company are misleading, and therefore they are likely to affect the decision which will be made by the users of those particular financial what? Statements. So therefore, in this case, we have this as actually some of the factors which determines whether an item is material or not. And therefore, in this case, we are saying if an item which is already considered to be material is not disclosed in the financial statement, then those financial statements we are saying may be deemed to be misleading because they will negatively affect, they will influence the decision which will be made by who? Which will be made by the users. So materiality concept. So let's look on the application of the materiality concept. Application of materiality concept. So in this case, materiality, here we look on the effect. We look on the effect, or basically the impact of financial information on the user's decision. On the user's what? Decision. So in that case, we are saying if an item or financial information will affect the user's decision is material. If it will not affect the user's decision, then we say it is immaterial. So the other way in terms of how this concept is applied, we can talk of quantitative materiality. And basically in this case, when we talk about the quantitative materiality, it entails expressing items in financial statement as a percentage of a certain key financial metric. As a percentage of a certain key financial metric. For example, an expense can be expressed as a percentage of the profit. May have decided that if the percentage gotten is 5% or more, 5% or more, then such an expense is said to be material. But if the percentage gotten, say, is less than 5%, then that expense may be deemed to be what? To be material. So therefore, when talk about the quantitative materiality, this basically entails determining the materiality of an item or basically financial information by expressing. So therefore, these are basically various concepts which are used by entities to determine whether an item is material or not. And actually we are saying which information must be included in the financial what? In the financial report, or which must be included in the financial what? Statement based on their impact on the decisions which will be made by the various who? By the various users. So basically that brings us to the end of that particular subtopic. But before we wind up, I want to give some assignment. I give an assignment here. So the first question, explain the concept of materiality. Number one, explain materiality concept. Materiality concept in financial reporting. In financial reporting. Financial reporting. Number two, discuss the factors that determines whether an item within financial statements is material or not. Is material or not. So therefore we have those two questions from this particular topic, or basically regarding what we have been able to discuss on materiality guidelines on financial reporting. So basically that brings us to the end of that particular subtopic. See you in the next session.
Hi there and welcome to the lesson. We continue with the topic management of public enterprises. Today we delve into the state market debate, and this debate revolves around the appropriate role of government in the economy. Revolves around the appropriate level of government involvement in the economy. The state market debate revolves around the appropriate level of government involvement in the economy, particularly concerning the ownership and management of enterprises. All right? That is what the state market debate is all about. What is the appropriate level of government in the economy? What is the appropriate role of the government or the state versus the market in managing economic activities? Of thought around this debate. That is what we are going to discuss briefly in our today's lesson. But let us first begin by outlining the key arguments in the debate. Arguments for state intervention. Arguments for state intervention. Arguments for state intervention. Remember, candidates, there are those who argue for state intervention, and some schools of thought argue for the market solutions. So what are the arguments for the state intervention in the economy, particularly when it comes to the ownership and management of enterprises? The first argument for state intervention, one, market failure. Market failure. Now, markets often fail to allocate resources efficiently, leading to externalities like pollution, public goods under provision, and information asymmetries. So state intervention can correct such failures. That is the first argument. The second argument is equity and distribution. Two, equity and distribution. Now, markets can create vast inequalities. So the state intervention can provide what we call social safety nets, ensuring basic needs are met and ensuring that resources are distributed more equitably. That's why there is the argument for the state intervention in economic activities. The next argument is based on developments. In less developed economies, state intervention may be necessary to build infrastructure to foster industrialization and protect infant industries That is an argument for state intervention. Less developed economies may need state intervention for the purposes of protecting infant industries and also building infrastructure and fostering industrialization. The fourth argument, stability, is on stability. Governments can use fiscal and monetary policies to stabilize the economy, preventing economic busts, economic recessions, and so on. So these are four arguments for the state intervention. Let us now highlight the arguments for market-based solutions. Arguments for market-based solutions. What are the arguments for market-based solutions? The first argument is in regard to efficiency. Efficiency. Now, markets are generally considered to be more efficient at allocating resources than governments due to competition and price signals. So markets are considered to be more efficient when it comes to allocation of resources. Another factor here is innovation. Innovation has been used as an argument for market-based solutions. Competition in markets fosters innovation and technological advancements. That's why the proponents of the market-based solutions prefer that there should be minimal or no state intervention in economic activities. 3, freedom and choice is a third point. Markets allow for greater individual freedom and choice compared to centralized planning, and that is one solution to market-based. That is one way in which it can be argued that the market allows for greater individual freedom. It allows for freedom for individuals to choose the products they want, and when choosing the products they want, the resources can now be allocated to a central body that plans on what should be produced and how much should be consumed. Markets can regulate itself in terms of what should be consumed and what should be produced because of freedom and choice. 4. How is limited government an argument? Now, excessive government or excessive intervention by government can lead to bureaucracy, can lead to corruption, can lead to inefficiency. And that's why the proponents for market-based solutions argue that there. So these are 4 arguments for market-based solutions and 4 arguments for the state intervention. Now, there are different perspectives based on what we've just discussed, different perspectives. We are going to be brief on these perspectives. Just to summarize, candidates, there are different economic schools of thought that are varying on this debate. There are different schools of thought that have varying perspectives on the state market debate. The first school of thought is classical economics. 1. Classical economics. Classical economics. Advocates for minimal government intervention believe that markets naturally self-regulate to achieve optimal outcomes. Now, the classical economics are basically what we call the laissez-faire. 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 The laissez-faire. That is the classical economics. Then we have the Keynesian economics. Keynesian economics. Keynesian economics supports a more active role for the state in managing the economy, especially during downturns through fiscal and monetary policy and so on. Keynesian economists argue for more active role of the state in managing the economy. Then we have the neoliberalism, the liberals, neoliberalism, the neoliberalism, the neoliberalism. The liberalism emphasizes deregulation, privatization, emphasizes free trade. You understand? With limited role for the state in economic affairs. From the word liberal, neoliberalism. Neoliberalism. It argues for free trade, privatization, and minimal or no involvement of government in economic affairs. That is the third school of thought, or the third perspective on the state market debate. Then we have the developmental state school of thought. The developmental state is also a school of thought or a model that is often associated with the East Asian economies, and it involves strong state intervention to guide industrialization and economic growth. So that is the debate. Candidates, these are arguments for the debate. These are arguments for market, arguments for the state intervention, arguments for the market-based solutions, and these are the 4 different schools of thought. But it's important for us to appreciate that in reality, most economies operate as mixed economies with a combination of state and market mechanisms. And the optimal balance between the two depends on various factors, including the nature of goods and services. Right? We are talking about balancing state and market. Balancing state and market. Balancing state and market. I've just said that in reality, most economies operate as mixed economies where there is a balance between the state intervention and market-based solutions. So the optimal balance depends on various factors. All right. So these are the factors. The first one is the nature of goods and services. One, nature of goods and services. The balancing of state and market solutions depends on various factors. Which some goods like national defense are inherently public and require state provision. All right, national defense, while others are better suited for market provision. Goods like bread, right? Services like education, products like electronics. Those are best suited, are better offered by the market. But there are some goods and services which are inherently public, like infrastructure, roads, street lighting. Those can be handled by the state. So do you understand? I've said that there is a balance between state and market, because in reality, economies have a mix, and the optimal balance or mix between state and market depends on various factors, one being the nature of goods or services. Then there is the level of economic development. Level of economic development. The level of economic development. Developing countries may require more state intervention to build, that is developing. The ones that are developing, like Kenya, may require more state intervention to build infrastructure, to build institutions, and so on. But the developed countries may not require much state intervention because they're already developed. They have the infrastructure, they have institutions, they have structures, they have politically developed, so they may not require much state intervention. Another factor is political and social context. Political and social context. Now, the political system and the social values of a country may influence the acceptable level of state involvement in the economy. We have those political systems that are highly democratic, others are socialistic, others are communist. So depending on the political system, all right, and the social values of a country, that could be a factor that will determine whether a country will have minimal or no state intervention in economic activities. 4. ETC. ETC means end of thinking capacity. So candidates, these are 3 factors: the level of government involvement in the market. Now, in the Kenyan context, Kenya has grappled with state market debate throughout its history. just like many developing countries. And after independence or post-independence, the government adopted a state-led development model with significant state involvement in the economy. But in the recent decades, we've seen a lot of privatization and liberalization of various sectors. So the current approach in Kenya emphasizes a mixed economic model, with the state playing a role in providing essential public services, regulating markets, and also promoting social equity, while at the same time encouraging private sector participation in the economy. But it's also important to note that the state market debate is an ongoing process. It is ongoing, and there is no single universally accepted answer. The most effective approach is often a pragmatic one that recognizes the strengths, recognizes the limitations of both the state and the market, and seeks to strike a balance between the state and the market. So that's all we can say as far as this debate is concerned. We began this lesson by defining the state market debate. We say that this is a debate that revolves around the appropriate level of government intervention in the economy. To what extent should the government get involved or intervene in the market? Or arguments for the state intervention. Then we have arguments for market-based solutions. We've briefly described the different schools of thought: the classical economics, that is the laissez-faire, the Keynesian economics, neoliberalism, and developmental state. Then we've also stated that there is, in reality, there is a mix. Most countries have a mix or a balance of state and market engagement, and we say that there are various factors that determine the level of the state's intervention or involvement in the market. One is the nature of goods and services. We say that there are some goods and services that are inherently public, thereby forcing the government to provide such goods or services. We also mentioned the level of economic development. Depending on the level of economic development of a country, that will determine the degree of government's intervention in economic activities of a country, with the less developed countries having more government intervention as compared to those that are highly developed. There is also the aspect of political and social context. The political and social context are factors that will determine the level of government. We bring this lesson to an end, but here is your today's assignment. 1. What are the key arguments for and against state intervention in the economy, and how do different economic schools of thought view this debate? 2. In what circumstances might state intervention be justified to address market failures or promote development? Provide specific examples. 3. What are the potential risks and drawbacks of excessive government intervention in the economy, and how can this be mitigated? 4. How can a country strike an optimal balance between state and market roles to achieve economic growth, social equity, and public enterprises? Bye. Hello and welcome to the introduction of a new chapter in Public Sector Governance, Policy and Administration. The chapter is Management of Public Enterprises. This chapter has 10 subtopics. 1. Theoretical foundations of public enterprises. 2. state market debate. 3, typology of public enterprises. 4, organization and governance structure. 5, regulatory and legal framework of public enterprises. 6, public investment appraisal. 7, relationship between government agencies and private firms in the marketplace. 8, performance of public enterprises across sectors and countries. 9, reform of public enterprises including privatization and divestiture. And lastly, public-private partnerships. Today we begin with the theoretical foundations of public enterprises. Theoretical foundations of public enterprises. In this lesson, we are going to study the rationale of public-owned enterprises, and we will also outline the theoretical models justifying public enterprises intervention. So by the end of this lesson, you'll be able to achieve the two objectives. 1, to highlight the rationale of public ownership of enterprises. Number 2, the theoretical models justifying public enterprises intervention. But let's begin by defining public enterprises. What are public enterprises? Now, public enterprises are also known as state-owned enterprises, the SOEs, state-owned enterprises, and they are businesses that are owned and operated by the government. They play a significant role in many economies, particularly in developing countries, and the theoretical foundations for their existence and operation are rooted in various economic and social considerations. That's why our first subtopic in studying the theoretical foundations of public enterprises is to analyze the rationale for ownership of public enterprises. Rationale for public ownership of enterprises. Rationale for ownership of public enterprises. Now, one rationale is market failure. One, market failure. Now, public enterprises are often established to address market failures or situations where the private sector fails to provide essential goods or services efficiently and equitably. And that can occur due to that may arise as a result of national monopolies. This is where there is high fixed costs or economies of scale that make it inefficient to have multiple providers like utilities, like railway, and so on. Another reason is public goods. Public goods. Public goods. These are goods that are non-excludable and non-ralvirous. All right, these are goods that are non-excludable, meaning that once provided, it's difficult to exclude anyone from using them. Public goods. And one person's use does not diminish another's use, like street lighting, like defense, All right, now excludable. All right, you understand? One person's use does not diminish another person's use. So the market may fail, or the private sector may fail to provide such goods to public enterprises. There is also the issue of externalities. Externalities. Now, when the production or consumption of a good or service affects third parties that are not involved in the transaction, e.g., pollution or from a factory, then we say that is an example of an externality. And because of externalities, then we have the rationale for ownership of public enterprises. And social welfare. Equity and social welfare. Now, public enterprises can be used to promote social welfare and equity by providing essential services at affordable prices, ensuring universal access, and addressing distribution concerns. That's why the government may want to own some enterprises in order to cater for social welfare and provide for goods equitably. 3, another rationale is strategic industries. Strategic industries. Governments may establish public enterprises in strategic sectors like energy, like telecommunications. Those are strategic industries. Transportation, and so on, in order to ensure national security and also control over critical resources, or even to promote industrial development. In order to promote industrial development. That is another rationale for government ownership of these public enterprises. The fourth rationale, economic development. Economic development. Now, public enterprises can play a crucial role in promoting economic development by investing in infrastructure, by creating jobs, and also fostering technological innovation. So these are 4 reasons why the government may want to take ownership of certain, what we are calling public enterprises. So let's move on to the other aspect of this lesson, which is the theoretical model justifying public enterprise intervention. Theoretical models justifying public enterprise intervention. Now, the first model is the welfare economics. 1, welfare economics. Now, this theory emphasizes the role of government in correcting market failures and maximizing social welfare. And public enterprises are seen as a tool to achieve this goal, social welfare. 2 is public choice theory. Public choice theory. The public choice theory examines the behavior of government actors for public enterprises to be influenced by political interests and rent-seeking behavior. Public choice theory examines the behavior of government actors like the politicians and how they make decisions. The theory highlights the potential for public enterprises to be influenced by political interests and rent-seeking behavior. 3, we have the property rights theory. The property rights theory focuses on the importance of well-defined property rights for efficient resource allocation. And public enterprises can be justified when private property rights are difficult to establish or enforce, such as the case of the natural resources. Another theoretical model or theory is the development state model. Development state model. The development state model. This model emphasizes the role of the state in actively promoting economic development through strategic interventions, including the establishment of public enterprises in key areas. So these are some of the theoretical models justifying public enterprise intervention: welfare economics, public choice theory, property rights theory, and development state model or theory. Now, I have some questions for your homework. Question 1. What are the main economic theories that justify the existence and operation of public enterprises? And how do they explain the role of the state in the economy? 2. How does the concept of market failure relate to the establishment of public enterprises? Provide examples of market failures that public enterprises might address. 3. What are the potential advantages and disadvantages of public ownership enterprises compared to private ownership? Consider factors like efficiency, equity, and accountability. 4. How can the performance of public enterprises be effectively measured and evaluated to ensure they are fulfilling their intended objectives? Thank you for the state market debate. Bye. Hello and welcome back to the lesson is about the management of public enterprises. That is the chapter. Today we are moving on to the typology of public enterprises. Typology of public enterprises. Typology of public enterprises, which are also known as state-owned enterprises. State-owned enterprises. State-owned enterprises. Today we want to study the typology of state-owned enterprises. But first of all, what is the meaning of typology of state-owned enterprises? A typology of public enterprises refers to the classification system that categorizes different types of organizations owned and operated by the government. You understand? Typology means classification. It is a classification system that categorizes different types of organizations that are owned by the government, the state-owned enterprises. And this in the society. So public enterprises, also known as state-owned enterprises, can be categorized based on various criteria, including their legal status, their ownership structure, the function, the sector, and so on. That's what we intend to do in our today's lesson. The first category is the legal status. State-owned enterprises can be categorized by their legal status. Legal status. Legal status. They can be categorized, number one, by their legal status. Legal status. They can be categorized by one, their legal status. Now, under categorization of legal status, we may have the departmental undertakings, we may have state corporations, and government companies. All right? Departmental undertakings. We may have departmental undertakings. Departmental. We have departmental undertakings. Departmental undertakings. That's the first category. Then we may also have statutory corporations. And government companies. That is categorization by legal status. Categorization by legal status. Categorization by legal status. Now, departmental undertakings are public enterprises that are directly managed and controlled by a government department. They are funded through the government budget, and the employees are typically civil and so on. Then we have the statutory corporations or public corporations. These are established by an act of parliament or legislature, and they have a separate legal entity from the government and are governed by their own boards. They enjoy more autonomy than the departmental undertakings, but are still subject to government oversight. Examples include the central bank, the development banks, the public broadcasters, and so on. These are statutory corporations. Then we have government companies. Now, government companies are registered under the Companies Act and are owned by the government through shareholding. They operate like private companies but have a major government ownership stake. Examples would include the airlines, the telecommunication companies, and so on. Undertakings, statutory corporations, and government companies. Another categorization is by ownership structure. Ownership structure. Ownership structure. Ownership structure. Ownership structure. Now, under ownership structure, we have the wholly owned, majority owned, and minority owned. Right? Under ownership structure, we have wholly owned, majority owned, and minority owned. Wholly owned, majority owned, and minority owned. Now, under the wholly owned, the government owns 100% of the shares of the government owns more than 50% of the shares, whereas minority owned enterprises, the government owns less than 50% of the shares, but still has significant influence over the enterprise. Typology or categorization by ownership structure. Another category is by function. By function. Categorization by function. Categorization by function. Categorization by function. Now, as for function, we have service providers, commercial enterprises, development enterprises, financial institutions, and so on. So this one, the functions include, the functions here include, by function, I've mentioned some of the functions. Service providers, providing service is a function. Service providers, that is one service or function, that's one function. Service providers. Commercial enterprises, we have commercial enterprises, commercial enterprises, development enterprises, development enterprises, service providers, commercial enterprises, development enterprises, financial institutions, financial institutions, and so on. That is categorization by function. Service providers. Service providers, these are enterprises that provide essential services to the public, such as healthcare, education, water, sanitation, and so on. Commercial enterprises, on the other hand, operate in competitive markets, and they aim to generate profits, such as airlines, oil, gas company. There is no monopoly. Then the third function is development enterprises. These are established to promote economic development in specific sectors or regions, such as industrial development corporations, agricultural development banks, and so on. Then we have financial institutions, which are basically public banks, insurance companies, and other financial intermediaries that provide financial services to the public. So this is categorization by function. Another categorization is by sector. Categorization by sector. Categorization by sector. Categorization by sector. Categorization by sector. Here you may have different sectors. Categorization by sector, you may have different sectors like agriculture, energy, Agriculture is a sector. Energy is a sector. We have other sectors like transportation, manufacturing, communication, telecommunication, and so on. Telecommunication, and so on. That is categorization of state-owned enterprises by the sector. By the sector. Now, agricultural development corporations are examples, marketing boards are examples, irrigation authorities are examples under the agricultural sector. Under energy sector, we may have electricity generation and distribution companies, we may have oil and gas companies, and so on. As for the manufacturing, we could be having fertilizer plants, industrial enterprises, etc. Transportation, we could have railways, airlines, shipping companies, public transport authorities, and so on. So, you understand? Under sector, you can also even have sectors like service. Service, that's an important one. Let me put it down. Service. Service. Service can be categorized under sector. The services sector, like healthcare, like educational institutions, water and sanitation utilities. So this is the typology of the state-owned enterprises. Typology of state-owned enterprises. We began by saying that the typology of state-owned enterprises is just the way state-owned enterprises are classified, and we say that they can be classified on different bases, or like the legal status, the ownership structure, the function, the sector, though we may also have some hybrids, but these are the key typology of state-owned enterprises. Now I will give you some questions for your revision. 1. What are the different ways to classify public enterprises based on their? Provide examples of public enterprises in Kenya and explain how they fit into the different typologies. How do the governance and management challenges vary across different types of public enterprises? 4. What are the potential advantages and disadvantages of different ownership structures for public enterprises, such as wholly owned, majority owned, and minority owned? Bye. Welcome to the lesson. In today's class, we will discuss the subtopic communicating in virtual groups. Communicating in virtual groups and team groups. And under this lesson, we are going to consider 3 groups. That is the group's email, number 1. Number 2, the WhatsApp groups and social media. 3 things. Let us define virtual communication. What is virtual communication? Virtual communication. Now, virtual communication, candidates, is defined as a mode of communication like video or audio to communicate with people who are not physically present. Now, when you communicate with someone through the use of technology, someone who is not with you, then we say that is virtual communication. Like what I'm doing today. I'm talking to you, you are not in this room, yet you can hear me. I can talk to you. You can hear what I'm saying, you can understand what I'm saying, you can write what I'm writing, you can do the assignments I'm giving. That is virtual communication. It's a mode of communication that includes the use of technology. So when you talk of virtual communication, there has to be an element of technology, either audio or video, to communicate with people who are not physically present. You can communicate to a person virtually in the next room, or it could be the next floor, it could be in the neighborhood, or you can communicate with someone virtually miles away. And candidates today, virtual communication has been very common in almost every area of work. People communicate virtually within the family, between friends. We also have people communicating in the office, virtually, just to name a few areas. And those of you who witnessed the outbreak of the coronavirus or corona pandemic, you must have realized that during the pandemic, face-to-face business was reduced, and people opted for virtual communication tools. Students studied from home. Businesses were run from homes. People bought goods and services online because of the pandemic, coronavirus pandemic, virtual communication. Now, the syllabus allows us to study 3 areas under virtual. Group emails. Now group emails is a collection of email accounts to which you can send emails. And when a group owner sends an email to an email group, then all the email contacts in that group label will receive the same email. I can decide to form a group email, so that I have contacts within that group. Could say, let me say, an accounts department. The head of the accounts department can have a contact of all the members within that department. Could be 50 or 100. So that when this finance director sends the email to the group, then all the members in the group that's what we refer to as group email. So creating groups in email, for example, in Gmail, is one of the quickest ways to send multiple mails. Instead of sending an email to each person at a time, you can create a contact group, then you send emails to the group. Instead of manually adding multiple recipients, using group emails becomes easier to send mails. Group email. So what are the advantages? What are the advantages of having a group email? What are the advantages? Let me put down the advantages. Group emails. Advantages of group emails. Advantage number 1 is that one of tracking capabilities. Because candidates, a group email list service, and it's possible to track what's being delivered and what is not being delivered. So that if there is any things that are not being delivered, the group administrators can be informed. All right? Tracking capabilities. This is one. Then two, single point of contact. Single point. It might be tricky to find the best angle to contact such a person. But driving emails towards a group inbox can make it easier to stay on top of things, and also for people trying to reach out could be easier or more effective, and it makes it possible to ensure conversations are always directed towards the best possible person inside of the company. So that's an advantage, single point of contact. Then there is also the advantage of transparency. Transparency among the group. Group emails promote transparency among the group. Group emails promote transparency among the group. How does that happen? Candidates, group email promotes transparency. These are a great benefit of group email. It promotes transparency. Because if you are sending emails or sharing emails, then all the information that you have will be available to anyone on the list. Because when you send one email, the email hits all the members on the group list. So there is transparency, so that again no one says that I received a different email, I received a wrong email, the information was all the same. There is always transparency because all members receive the same message at the same time. And transparency is also enhanced, especially when there is a new member who is introduced to the group. And maybe the new member needs to get up to speed with what has been happening. Becomes easier if such a member is transparency among the group members is enhanced or promoted. Another advantage is that of management, easy to manage. It is easy to manage group emails. Now, a good group email provider, a good one, a good email list, for example, will also allow members to sign up directly to the list via the website. And a dedicated link can then be distributed to a wide group of people who can decide to join the group or not. And that becomes very easy to manage the group. So these are some of the advantages of group emails. Let's now have a look at the limitations. What are the limitations of group emails? Viruses. Now, candidates, email is one of the commonest ways for viruses to travel and infect devices. Why? Because the email might come with a virus, or the virus might be in an attached document. And infection normally occurs when the recipient clicks a link or opens the infected attachment. And candidates' infected emails may come from an anonymous source or appear to come from a trusted friend or a contact. So that's one of the limitations of group emails, viruses. Time consuming. The second limitation, time consuming. Why? Now, reading, writing, responding to emails can take up a vast amount of time as well as energy. And many modern workers spend most, if not all their days, just dealing with emails. If you have a large amount of emails to respond to, you find that you may spend a lot of time reading emails, understanding the emails, responding to emails, and so on. And that work can be dull, and sometimes it feels like there is responding to emails. It's time consuming, can be tedious, and so on. The third limitation, group emails are insecure. Insecure. Now, emails are a common target for hackers who may seek sensitive information, such as the financial information, personal messages, and confidential documents. And there have been many high-profile cases that show how vulnerable emails are, okay, to data theft. So it's also they could fly around a lot in large organizations that it can be difficult to know who has what information and so on. So there is that risk of insecurity. Malicious use is another limitation. Malicious use, from the word malice. Emails, candidates can be sent anonymously, which means that they are sometimes used maliciously, either to bully or to upset people. Likewise, they can be used to spread gossip or even false information in a business. 5, misunderstanding. That's another limitation of group emails, misunderstandings. It is easy, candidates, for misunderstanding to occur with email. Why? Because there could be only text and no tone of voice or even body language to provide the context. And that's why sometimes when using emails, jokes can be taken seriously. And a well-meaning but quickly typed email can come across as rude or even aggressive. So the email, due to the shortcoming of the fact that emails, you cannot hear the tone of the one communicating, you cannot read the body language. Short descriptions and abbreviations also can easily be misinterpreted. So that is, there are high chances that emails can be misunderstood because of the fact that you don't see the one communicating, you don't hear the voice, it's just text. And sometimes text can cause misunderstandings. Then lastly, another disadvantage of emails is information overload. Information overload. Now, candidates, in part, because emails are so easy to send to multiple people, especially in group emails, they can create informed or relevant or not. Emails require constant organization and upkeep, but in the modern workplace that may not be the case. So there may be information overload because of the fact that an email can easily be sent. Then you may have very many emails, information that is not organized, and information that is not updated, and so on. So these are some of the limitations of group emails, 6 of them. So candidates, we have discussed group emails. Remember I told you that under virtual communication, we are discussing group emails. We also discuss WhatsApp groups, number 2. WhatsApp groups. Now, WhatsApp groups can miss images, audios, and videos. When I say free, I mean you don't have to buy the application. You can download it freely. As long as you have internet, you can download it freely. As long as you have internet, you can send messages. As long as you have internet, you can send images, you can send videos, you can send audios, and so on. That service, the WhatsApp service, is similar to the text messaging services. Text messaging, the one we text on the phone, text messaging. However, because WhatsApp uses the internet to send messages, and the cost of using WhatsApp is significantly less compared to sending messages, compared to texting. It should be noted that you can also use WhatsApp on a desktop. You can use it on mobile phones and so on. And WhatsApp has become a popular mobile messaging application which dominates today's mobile communication. And that's why it has found its way in your syllabus. You see, we are discussing WhatsApp in your syllabus. Why? Because it has become a popular mobile messaging application which has dominated today's mobile communication. Almost everyone is on WhatsApp. As long as you have a phone, you are likely to install the application for communication. Especially, we have the feature of group chats, because we are discussing groups, virtual groups. There is that feature on group chats. You can form a group, can come together as a group, and you chat as a group on WhatsApp. The feature of group chats contributes to its success, and it has changed the way people communicate. WhatsApp is very simple to start because, number one, I said it's just free. You download it. It's not complex. No complex registration is required. And the application automatically identifies users by their phone numbers. And those contacts saved on the smartphone that are also users on WhatsApp will automatically be added to the application's contact list. It combines one-to-one, one-to-many, and group communication. That means I can communicate with you one-on-one. I can communicate in a group. All right? So those are some of the features. You can have group communication by offering private chats, broadcasts, group chats, and so on. And candidate, to start a new group, one has just to open the menu on WhatsApp and choose new group. Then the subject of the group, which is just a free text, can be used to define the group and even the group icon. You can upload an icon for the group. Then afterwards, you can add contacts to the group. You can invite people, send people a link to join the group. And the one who creates the group, the creator of the group, has administrative privileges on WhatsApp. You can add members in the group, you can remove members from the group at any time, and also can promote other group members to become administrators. So candidates, we are talking about sharing on WhatsApp. And when you share or when you send a post, where each post of a member of the group is represented, can be represented by a speech bubble. Okay, bubble, speech bubble. And apart from the exchange of text messages, WhatsApp allows the members to send photos, to send videos, to send audio files, to send contact data, as well as even the current location of the user. It's possible to know the current location of the user. So what I've been describing, candidates, it's not something that's not new to you if you have a smartphone and you are on WhatsApp. Those are some of the features that you find on WhatsApp. WhatsApp application. WhatsApp. Are you on WhatsApp? Most likely, most likely, most likely. All right? WhatsApp is very common, very popular a way of communicating informally. Businesses have also embraced WhatsApp, especially when it comes to forming of groups. We have, if it's a department, you may have all the department members forming a group so that they can share information. They can share videos, they can share audios for the work. And in WhatsApp, candidates, in a conversation, every type of message is seamlessly integrated into a single view, such that every user of WhatsApp will be notified as soon as a new post arrives, whether it is in a group or in a private chat. And the notification can be a sound, it can be an icon, or even a pop-up window. And it's important to note that WhatsApp group has a limit. If you are forming a group, WhatsApp may have a limit number of people whom you can add to the group. The common WhatsApp group you add at most 250 people in a single group or chat. So one can create a WhatsApp group for clients. You can create another WhatsApp group for the department. You can create a WhatsApp group for a committee. A WhatsApp group can be created for employees in different departments, and so on. You can have WhatsApp group for the marketing campaign team. If there is a campaign team going out, you can have a WhatsApp group such that the members can post messages, they can post clips, photos, audios on the group's wall for other group members to see or to view. And that can be done anytime. People can view it anytime. People can send information on the WhatsApp wall anytime. And the admin of the group, the administrator of the group, is the one who is responsible for controlling the chatting in the group. So that is the second virtual group. The first virtual group we discuss is the Gmail. The second one is WhatsApp group. Then we can, in closing, talk about the social media. There are groups that can also formed on social media. Now, candidly, social media is a computer-based technology that facilitates the sharing of ideas, thoughts, and information through the building of virtual networks and communities. All right? And the largest social media networks today, as I'm speaking, include the Facebook, Instagram, Twitter, YouTube, TikTok, and many others. All right? So social media typically features user-generated content and personalized profiles. And candidate social media is any digital tool that allows users to quickly create and share content with the public. That's social media. It does what? Social media is a digital tool that does what? That allows users to do what? To quickly create and share content with the public. And social media encompasses a wide range of websites, a wide range of applications, some like Twitter, specializing in sharing links and short written messages, others like Instagram and TikTok, which are built to optimize the sharing of photos and videos. You may have a TikTok and so on. You have LinkedIn and so on. So anyone with internet access can sign up on a social media account. They can use that account to share whatever in the content they choose to, and the content they share reaches anyone who visits their page or profile or their group. Social media is a digital tool. Is a digital tool that allows what? Allows the users to create content and share it to the public. Social media. All right? Social media. All right? So I've mentioned the social media accounts, the Facebook, we have even blogs. Blogs is also another platform. Is a platform for, blogs is just a platform for casual dialogue and discussions on special topics or opinions. Facebook, today as I'm speaking, is the largest social media network with billions of active users. The users create personal profile on Facebook. They add other users as friends. They exchange messages on Facebook, including status updates. We've seen also brands creating pages, and Facebook users can like brands' pages and so on. On Facebook, again, you can have a Facebook group, which may more or less work just like a WhatsApp group, where members can of the group have certain privileges, and the group is controlled and managed by an administrator. Okay? We've had other platforms like LinkedIn. LinkedIn is a place where groups of professionals with similar areas of interest can share information and participate in conversations. So all these are media platforms that companies can use. They have certain features that may be of help to a company, especially when it comes to communicating in virtual groups. Do you understand? Yes, you do. Are you on Facebook? You may not be on Facebook, or you are on Facebook. So I advise you, if you are not in some of these social media platforms, make an effort of at least visiting the social media platforms and see how they operate, so that you can also be in a position to verify what I'm telling you right now. All right? Just for the sake of knowledge, it's important for you to make an effort and see what are the features of some of these social media platforms. Like we have YouTube, we have Vimeo, there is Flickr, and so on. Platforms, candidates like YouTube, they do what we call video hosting. It's a video hosting and watching website. All right, we have platform like Instagram. We have free and video sharing. Is a free and video sharing app that allows users to apply digital filters, frames, and other special effects to their photos. And then they can share them to a variety of social networking sites. Now, as we close, let us take some time and discuss the benefits of virtual communication. Benefits of virtual communication. I said as we began that virtual communication is just communicating to people who are not present with you physically. When you communicate with someone who is not with you physically using technology, then that is virtual communication. The first benefit of virtual communication is that one of convenience. Convenience. People or employees can interact with each other from wherever they are, virtually. They do not have to meet in person. And that reduces frustration, especially when people are busy or are caught up in traffic, or they are busy elsewhere. You can communicate without necessarily traveling to meet. Convenience. Time saving. Time what? Saving. There is no need for a physical meeting to communicate. When you are communicating virtually, there is no need to do what? To have a physical meeting, and that saves time. You can use different virtual communication software which can allow you to pass across whatever information that you may have from wherever you are, and that eventually saves time. Benefit number 3, saves money. Saves money. That's another common advantage of virtual communication. Is an advantage, saving money, cutting costs. Why? Because you are able to reduce transport expenses, and companies cut on operational costs of employees, thereby saving money to be used on other functions. I know companies that allowed employees to work from home, and that you cut costs because you don't need to have a lot of space in the office, because employees can work from their they can work from their homes. So you cut costs in terms of the traveling expenses and even the rent and so on. 4, speed. Speed. Or you can say it's fast. Speed. Virtual communication takes no time to connect with the other person. It's just a click away, and you get to convey what you want to communicate. A click. For example, if you are writing a message on WhatsApp, Just drop the message, then you click it. The message is sent and received instantly. It's fast, speed. Fast. Virtual communication is fast. Then we can say it also enables organization to harness talent. To harness talent. Enables organizations to harness talent from anywhere. If people do not have to meet physically, then it means they can work from homes, remotely, in any continent. And that way, organizations are able to amass the best people for the job, thereby increasing productivity. If you are in Kenya, then you don't need to apply to give work to the people only in Kenya. You can get access to labor globally. You can go online and maybe make an advert, seek for employees online. You can tap talent from anywhere in the world because people will work from wherever they are. They don't need to travel to Kenya. No. So virtual communication allows organizations to harness talent from anywhere. 6, promotes flexibility. Promotes flexibility. And candidates, this is essential for busy people who are struggling with work and life balance. Work and life balance. For example, mothers who are working. So balancing work and family can be tricky. That is where virtual communication helps them work from wherever they are. Because they can communicate very fast, they can work very fast and submit their work virtually. So these are 6 benefits. There are many benefits, candidates. There are many benefits of virtual communication. But with benefits, there are also limitations. So we can not just discuss benefits and fail to discuss the limitations. Limitations of virtual communication. What are the disadvantages? The first obvious one is technical problems. Technical problems. Virtual communication relies on software. It relies on machines, relies on internet technology, which can malfunction at any time. And that may affect ongoing and scheduled virtual communication. It's prone to technical problems. Difficult to organize. Limitation number 2, difficult to do what? To organize. Now, for facilitators, candidates, virtual meetings can prove difficult to manage, as you can't rely on everyone having access to the same meeting, okay, as compared to having a physical meeting. When you are facilitating a meeting virtually, it's not easy to organize. People who are not physically present. All right? Difficult to organize. The third limitation, interactions between participants is difficult. The interactions between participants, the participants in a virtual meeting, is not easy it's more challenging for all attendees to take an active role when the meeting is virtual, particularly when groups are large. But we know in person, it's possible to talk over each other to some extent, creating a back and forth conversation if it's physical. But in virtual meetings, it's difficult to hear if more than one person is speaking, and that can lead to difficulties in communication. The fourth limitation of virtual meetings is that one of difference in time difference among the participants. Time difference among the participants. Time difference among the participants. Candidates, virtual meetings are scheduled at a specific time, and not all members can be free at that particular time. That's a challenge. So these are 4 challenges or limitations of virtual meetings or virtual communication. We've completed or come to the end of today's lesson, where we sought to study communicating in virtual groups. We defined virtual communication. We defined group emails and how they are formed. We've discussed the advantages and disadvantages of group emails. We went further to discuss the second type of virtual group, which is WhatsApp groups. We explained how they are formed. We've gone further to discuss social media. We've outlined the various social media platforms like Facebook, YouTube, LinkedIn, and so on. Then we've discussed the advantages and disadvantages of virtual communication. Disadvantages of virtual communication. As it is our custom, you will take home this assignment. Your assignment number 1, define virtual communication. Number 2, highlight 4 benefits and 4 limitations of group emails. Number 3, outline the benefits and the limitations of virtual communication. That is your today's assignment. Thank you for attending the lesson. God bless you. Bye-bye.
Hi candidates, welcome to another session of Manifested Online classes. My name is CPA Joseph Kimani, your lecturer for financial reporting and advanced financial reporting. So in this session, I want us to look on topic number 6 of advanced financial reporting and analysis. And as far as this topic is concerned, we're going to look on other reports which companies are expected to prepare other than the financial reports, and also some of the emerging issues as far as the financial reporting is concerned, whereby we are going to look on emerging issues such as the conceptual framework for financial reporting, the process of developing what we refer as the international financial reporting standards, and also other emerging issues. And therefore, some of the topics or some of the subtopics we are going to cover under this topic number 6 include number 1, a conceptual framework for financial reporting and the process of developing a new accounting standard. Here we are going to look on 2 main aspects. Number 1, we are going to discuss what is conceptual framework for financial reporting, and also the process or the procedures which are followed by the International Accounting Standard Board when coming up with a new international financial reporting standard, that is IFRS. Then subtopic number 2 is a proposal to revise or basically update existing standard and recommendation to issue a new standard. So basically here we are going to look on the process which is followed whenever we have a proposal which is to be forwarded to the International Accounting Standard Board to revise an existing accounting standard, or even to issue an accounting standard, maybe to address an accounting matter or an accounting issue which is not yet addressed by the existing standard. We're going to look on the procedure to be followed there. In subtopic number 3, we're going to look on something to do with the management commentary, also known as management discussion and analysis. And actually we're going to see that these are basically the comments which are made by the management of the company regarding some of the events which occurred during the current financial year, both positive and also negative, and how they affected the operation of the company. And actually we're going to look on some of the issues which are included in such a commentary by the management of the companies. In subtopic number 4, we are going to look on something to do with the Capital Market Authority corporate governance reporting framework. So here we're going to look on what the entities are required to inform their shareholders, and specifically here we are referring to the listed companies, what they need to inform their shareholders and also the members of the public whenever the company shares have been listed, or whenever the company shares are trading in the securities exchange market. Then from there we have subtopic number 5, which is about the Global Reporting Initiative guidelines and something called the sustainability reporting. So basically these are some of the emerging issues as far as the financial reporting is concerned. We're also going to look on something to do with integrated reporting, whereby you're going to look on a report which need to be compiled by the company and which addresses a number of issues other than the financial performance and the financial position of the company. Then in subtopic number 7, we have materiality guidelines for financial reporting, and subtopic number 8, which is the last one, we're going to look on the legal and ethical issues in financial reporting. So therefore these are 8 subtopics which we are expected to cover here as far as topic number 6 is concerned. So to start with, I want us to start by looking on the first subtopic, which is on the conceptual framework for financial reporting and also the process of developing, or basically the process of coming up with a new international financial reporting standard, of which, as we are going to see, it is the responsibility of a body which is known as the International Accounting Standard Board to develop and also issue a new international financial reporting standards. But let's start with what we refer as the conceptual framework here. We start by looking on the conceptual framework for financial reporting. Remember, in this case, I've said here we have two main concepts we are going to discuss. The process of developing a new IFRS and also what we refer as the conceptual framework. So when we talk about the conceptual framework for financial reporting, this we can say is basically fundamental concepts which are developed by the International Accounting Standard Board. Number one, to help that body, that is to help the International Accounting Standard Board in terms of developing a new accounting standards. And also this particular fundamental concept, they help entities in selecting accounting policies to be applied in preparation of financial statements, because it is upon the entity to be able to select the accounting policies which will be used in preparation of the financial statement. For example, is upon the entity to decide how to depreciate the asset, whether to depreciate the asset using straight line method, reducing balance method. That is an accounting policy. Is upon the management of the company to do what? To select the accounting policy to be used in preparation of the financial statement. And therefore, you can say that this set out the fundamental concept for financial reporting, that guide international accounting standard board, International Accounting Standard Board, which is abbreviated as IASB, in developing a new IFRS, or in developing new IFRSs. So, meaning that the conceptual framework for financial reporting, we are saying it set out the fundamental concepts. Concepts are the same with the principles. Concepts are the same with what? The principles. So therefore, you can say the conceptual framework for financial reporting basically lays out, or it basically set out the fundamental principles or concepts for financial reporting, and which are supposed to guide this particular body in developing what you refer as a new international financial reporting standard. Also remember what you have said is that this particular conceptual framework for financial reporting also helps the entities in terms of selecting the accounting policies to be used in the preparation of the financial statement. So therefore, you can also say here that the conceptual framework also helps the entities, or basically companies in selecting, or basically in developing, or basically coming up in developing accounting policies to be used in preparation of financial statement, to be used in preparation of financial statement. So whenever an entity is to come up with an accounting policy, for example, how to depreciate the asset, the method to be used in depreciating the asset, whether straight line, whether reducing balance method, the entity is supposed to be guided by this particular framework in selecting the accounting policy which will be adopted, which will be used by such an entity in preparation of what? In preparation of financial statement. So we can further say that the conceptual framework basically set out a number of issues, or basically it includes a number of concepts, because that's what we have said. It set out a number of concepts. So which are some of the concepts, which are some of the principles which are included in this particular conceptual framework? So therefore, you can say it set out the following. The following. Number one, the objective of the general financial statement. Objectives of general financial statement. So mean that the conceptual framework basically has given the objectives of preparing the financial statement, of which, according to this particular concept, whenever an entity is preparing its financial statement, that is the income statement and the statement of financial position, then they are supposed to be prepared to communicate now to the users the information about the performance of such an entity and the information about the financial position. That is the objectives of the financial statement. So the other issue which is also set out in the conceptual framework are the qualitative are the qualitative characteristics of a good financial information, information. So the characteristics, or basically the qualitative characteristics of a good financial information, they are also clearly highlighted at this particular concept, at this particular framework here. And according to this particular framework, for any financial information to be deemed to be of high quality, then that information must possess certain qualities, or basically certain attributes, which are broadly classified into two. This is something definitely you covered in the lower level. So we have the what we refer as the fundamental qualitative characteristics, which include faithful representation and also something called relevance. Something called what? Relevance. And then from there we have enhancing qualitative characteristics, which include understandability, which include timeliness, which include what we refer as a comparability, and so on. So those particular qualitative characteristics of a good financial information, they are also included, or basically mentioned under what we refer as a conceptual framework. So also the conceptual framework set out the issues to do with the definition, or basically it defines various elements of the financial statements. So it set out the definition of assets, liabilities, revenue, expenses, and equity. So basically what that means, that the conceptual framework actually define all these elements of financial statement. For example, assets are defined under conceptual framework as those particular resources which are controlled by the entity, and basically which are expected to generate some commercial returns, or basically which are expected to generate some cash flow. So therefore, all these particular elements of financial statements, they are clearly defined under the conceptual framework for financial reporting. So number 4 is that the conceptual framework for financial reporting also talk of the issues to do with the description of an entity, and its boundaries, number 5 is the issue to do with the recognition and derecognition of asset and liabilities in the financial statement. So when talk about recognition, is basically the process of recording an asset or even a liability in the statement of financial position. When talk about the recognition of an asset or liability in the financial statement, is the process of removal of an asset or liability from the statement of financial position. So therefore, what the conceptual framework for financial reporting has done, it has actually given the criteria for recognizing a financial or basically asset and liability, and the criteria for recognizing or basically removing an asset or basically a liability from the financial statement of what? Of an entity. So basically these are some of the issues which have been addressed, or which are actually addressed by this particular conceptual framework for financial reporting. So then from there we can look on the other issue here, and that is the process of developing IFRS. So we can look on the process of developing developing a new IFRS. So first of all, when we talk about IFRS, we are talking of International Financial Reporting Standard. And basically in this case, it is first of all important to note that it is the responsibility of the International Accounting Standard Board International Accounting Standard Board, basically to develop or to come up with new accounting standards. So, and currently that body issue new accounting standards, which are known as the International Financial Reporting Standards. So far, we have 18 IFRSs, 18 International Financial Reporting standards, which have been issued by this particular But maybe first of all, we can say that IASB, International Accounting Standard Board, develop and issue new IFRSs, International Financial Reporting standards. And in this case, for this particular body here to be able to issue a new, or basically to be able to come up with a new standard, a new International Financial Reporting standard, basically that will involve a due process. Some research will have to be done for this particular body to be convinced that a new standard need to be issued, maybe to address some issues, some accounting matters, some accounting issues which are not yet addressed by the existing standards. And once that particular research has been done and ISB is actually satisfied that a new standard need to be issued, then there will be a consultation across the world. And basically this particular consultation will involve accountants, will involve financial analysts, and also will involve other players in the financial market sector, basically for this particular body to be able to know the standard to be developed, and maybe some of the issues to be addressed by that particular standard, So, and therefore you can say that IFRSs, are developed through a formal system of due process and a broad international consultation, which will be involving various parties, which will be involving now the accountants, the financial analysts, and so on, involving accountants, the financial analyst, other users, and the regulatory bodies. Bodies here, we are talking of regulatory bodies such as ISPAC, such as maybe CMA, and so on, and other regulatory bodies from across the world. So therefore it is important here to note that for this particular body here to develop a new standard, then we are saying that that will involve some formal system of due process. Due process means that a lot of investigation, a lot of research has to be done for this particular body to be satisfied that a new standard need to be issued, and some of the issues which that particular standard need to address, some of the accounting issues which need to be addressed. And once that research has been done, then there will be a broad international consultation which involve accountants, the financial analysts, other users of the financial statement, and some of the regulatory bodies around there or across the world, such that before this particular body can start that project of coming up with a new standard, then it will be satisfied that there is a need for the standard to be issued, and also the body will be having some information, ISB will be having some information regarding some of the accounting issues, some of the accounting matters which that particular standard need to do what? To address. So then from there we can look on the due process. So which is the process which is followed by this body in coming up with a new standard. So we can look on the due process, and actually the due process here we are talking of the steps which are involved in coming up with a new IFRS, and therefore we can say that the process of developing a new IFRS, involves the following steps. So here we have around 4 steps which are involved. We can talk of step 1. Step 1. So when talk about step 1 here, this body, that is International Accounting Standard Board, first of all, it will form something called advisory committee. So this particular advisory committee is supposed to advise the International Accounting Standard Board on the new standard which is to be developed, the matters which are to be addressed by that particular word standard. So that is the first step. So, and therefore we can say step 1 involves establishing now the advisory committee. So we can say the International Accounting Standard Board establishes an advisory committee to advise on the matters arising from the project. So in this case, when we talk about the project, we are talking of the project of developing a new standard. So anytime the International Accounting Standard Board is developing a new standard, that is like a project which is basically undertaken by this body. So therefore, it will first of all establish advisory committee which will be able to advise it on the matters arising from that particular project. So then we have step 2. Step 2, and once this advisory committee has been set up, and then it has been able to advise this particular body on the new standard to be developed. So what happened is that this body will come up with something called an exposure draft. An exposure draft is like the original draft of the new standard. And once that exposure draft has been drafted, then it will be given to the various stakeholders, like accountants, like financial analysts, like the users of the financial statement. They try to look on it and basically give their views. They give their views, their comment on maybe the new exposure draft, the areas which need to be amended, the new or maybe the changes which can be made as far as that exposure draft is concerned. So therefore, you can say step 2, IASB, International Accounting Standard Board, will do what? Will publish an exposure, that is, will develop and publish an that is a discussion paper for comment from the members of the public, So it will develop now that particular discussion paper, which then will be subjected to public discussion, and then that particular body will be aiming to receive some comments from the members of the public, including other stakeholders, So then we have step 3. So step 3, this one will involve reviewing the comments which have been received from the members of the public and then issuing something called an exposure draft. An exposure draft, we have said, is like a draft of the standard which is to be developed. So therefore, you can say after the receipt and review of a comment from members of public and other stakeholders IASB, International Accounting Standard Board, then issues an exposure draft. An exposure draft equally for public comment. For public comment. That is step number 3 for public comment. And then from there we have step number 4, which is actually the last one. So we have step 4. And step 4 now basically involves issuing the final international financial reporting standard. And therefore you can say that after the receipt and review of after the receipt and review of a comment from the members of the public and basically other stakeholders, IASB then issues the final IFRS. So therefore, these are basically the 4 steps which are basically involved in developing a new international financial reporting standard. So we have said step 1 will entail forming an advisory committee to advise this body on the project, the issues to be addressed, and so on. Then from there, this particular body will basically develop and publish a discussion paper for comment from the members of the public. And then from there, step 3, after receiving those particular comments from the members of the public, ISB will do what? Will look on them and basically from there issue something called an exposure draft. An exposure draft, which you have said is just like a draft standard. A draft standard which will also be subjected to public comment. And then once those particular comments have been received from the members of the public, this particular body then will come up with a final standard. Will come up with a final standard, and actually after coming up with a final standard, it will then publish it and also set the date for the commencement. Like in this case, there is a new standard which has already been issued, IFRS 18, and it was issued in April of 2024. And actually, the International Accounting Standard Board has set the date for commencement to be 1st January of 2027. So therefore, that basically what happens once the International Accounting Standard Board has issued a new IFRS, it will publish it, basically inform the members of the public about the new standard, and also set the date forward for the commencement. So therefore, those are basically the steps or basically the procedures which are followed by the International Accounting Standard Board in developing or basically in coming up with a new IFRS. So here is today's assignment. Question 1, discuss the reasons why it is important for ISB, International Accounting Standard Board, to develop conceptual framework for financial reporting. Question 2, discuss the procedure for developing a new IFRS. Question number 3, highlight the content of a conceptual framework for financial reporting. For the time being, we stop at that particular point. So see you in the next session as we look on the other subtopic. Hi candidate, welcome to another session of manifested online classes. So in this session, I want us to continue with more illustrations on the topic of deferred tax. And specifically, I want us to look on another question for deferred tax, which equally incorporate the concept of group accounts. And the question is for September 2021, specifically question number 3, Roman 1, and also Roman 2. So we start with Roman 1, which was a theory. It reads, with reference to deferred tax, differentiate between permanent difference and the temporary differences. So what the examiner was requiring, you differentiate two terms there, two terms. That is what you refer as the permanent, differences and the temporary differences. So basically, to differentiate, you just define what is permanent difference and what is the temporary difference. First of all, when we talk about the permanent difference, we say that these are difference which give rise to a difference between accounting profit and taxable profit. And that particular difference arises as a result of taking into account items of incomes and expenses in computing the accounting profit, but those particular items are not taken into account in computing the taxable profit. Now, good examples of such items include something like depreciation. We know depreciation is an expense in computing the accounting profit, but depreciation is not considered as a allowable expense in computing the taxable profit. Another good example of such an item is fines and penalties. Fines and penalties are accounted for by the company as an expense in computing the accounting profit, but those particular items are not treated as a allowable expense in computing the taxable what? Profit. So that is a kind, or those are the items which give rise now to what refer as the permanent what? Difference. So we can say that a permanent difference is the difference between accounting profit which is also known as profit before tax, and the taxable profit which arises as a result of taking into account certain items of incomes and expenses in computing accounting profit and not in computation of taxable profit. And I've given good examples of such items of incomes or expenses which will only be considered in computing the accounting profit, but not considered in computing the taxable profit. So such items include depreciation. We also have the fines and penalties, etc. And therefore, what we say is that this particular difference here, that is the permanent difference, is basically a difference between accounting profit and taxable profit, which only arises in a certain accounting period, but that difference do not reverse in the future. And therefore, this difference between accounting profit and taxable profit is totally ignored for the purpose of computing the deferred tax. In other terms, this particular difference here do not give rise now to the deferred what? Tax. So that is the first thing which a candidate was expected here. Explain what is permanent difference, and then from there we need to explain what is temporary difference. Temporary difference, this one is very simple because this is just the difference between the carrying amount and the tax base of asset and liabilities. So we can say that the temporary difference, which is abbreviated as TD, is the difference between carrying amount and tax base of assets and liabilities. The difference between the carrying amount and the tax base of what? Asset and liabilities. And also in this case, we have two types of this. We have two types of temporary difference. First of all, we have something called the taxable temporary difference and deductible temporary difference. Taxable temporary differences arises whereby the carrying amount of various items of asset and liabilities is more than tax base, but a temporary difference will be deductible if the carrying amount of various items of asset and liabilities is less than the tax base, base. So that is it, that what was required in Roman 1 of that particular question. So basically, by the candidate doing that, a candidate was supposed to get 4 marks automatically for explaining a permanent difference, 2 marks there, and for explaining what is a temporary difference, equal to marks there. Okay, so then we have Roman 2 of that particular question. That was Roman 1. So Roman 2, let's go through that information. You see what was being required. We are told Huruma Limited, a public limited company, has a portfolio of investment, including various subsidiaries, and also undertakes various projects varying from debt factoring to investing in property and commodities. The following information was extracted from the group financial statement relating to the deferred tax provision for the year which ended 31st of March 2021. So we have that information, number 1, basically up to note number 6. We are going to go through that as we see what the examiner was requiring. So what we are required is to determine the amount of deferred tax asset or deferred tax liability of Huruma Group as at 31st of March 2021 in conformity with International Accounting Standard number 12. So what we are required to do here is to compute the amount of deferred tax asset or deferred tax liability, and automatically for us to do that, we have now to determine whether at the end of this particular financial year, was there a net taxable temporary difference or was there a net deductible temporary difference. For us to do that, it is obvious that we have to prepare something called the schedule of temporary difference. We compute the temporary difference of each of the item which is given there from note 1 up to note 6, actually to note 5, and then from there we determine the net amount of a temporary difference, which will either be a net taxable or net deductible temporary difference. But what the examiner here was requiring is for the candidates to determine the amount of deferred tax, the deferred tax asset or liability, stroke liability at the end of the year, which ended 31st of March 2021. So in this case, I've said for us to do that, to do this, we need first of all to determine the temporary difference of those items, and then at the end of the year, or basically by the end of the day, we determine whether we have a net taxable or deductible temporary difference. So we do that by preparing something called a schedule of temporary differences. So in our schedule here, we need to have various columns. The first column here will be for the various items of assets and liabilities as provided there, which is in million of shillings. So then we have the other column here, which should be for temporary difference, for tax base, abbreviated as TB, tax base. And the last column here is for TD, temporary difference, and equally these will be in million of shillings. So we need to go through the items we are given from note 1 up to note 5 so that we can be able to compute their temporary difference, and then by the end of the day we get the net amount. So what you're given or we are told in note 1 is that Huruma Limited acquired a controlling interest in a subsidiary Shukari Limited on 1st of July 2020, that is within the current year. The fair value of the asset and liabilities acquired were considered to be equal to their carrying amount, with an exception of freehold property, which had a fair value of 256 million and a tax base of 248. So I think that one is straightforward because we are given an item of freehold property, and for that item we are given its fair value. The fair value, this is the amount at which this item will be recorded in the statement of financial position, meaning that is the carrying amount. And then also we are given the tax base, which is 248. So no problem with that because the two values are provided. We are told the directors have no intention of selling the property, meaning that it will be accounted for as an asset, as a non-current asset, that is. So we get the difference, 256 minus 248, 248, that will give us a difference of 8 million, which is a positive, and therefore that is a taxable temporary difference. So we move to number 2. We are told during the year which ended 31st of March 2021, Huruma Limited sold goods at a price of 48 million to another subsidiary, which is called Wingu Limited, and made a profit of 16 million on the transaction. And then you're told 40% of these goods were held in the inventory of Wingu Limited as at 31st. So in such a case, what you just need to do is to determine the goods which were not yet sold at the end of the year. You determine their cost, which will be the carrying amount, and then the selling price will be the tax base. So therefore, we have inventories. And for these particular inventories, we need to determine their value. And basically in this case, we are told the goods which were sold by the parent to the subsidiary had a value of 48 million. And then we are told in the last sentence, the goods which were not yet sold at the end of the year, they had a value of, or basically they were 40%. So what we need to do is we get 40% of 48, 40% of 48, which will give us 19.2. So remember 19.2, and this is basically now the cost. This is the cost now to the buying company, and therefore when buying company is preparing its income statement, this what it will consider. This what it will take as the cost of the goods which were purchased. In other terms, this is the tax base. So the tax base in our case is 19.2. What about now the carrying amount? So this particular inventory will be taken to the group statement of financial position at this value here, that is 19.2, but minus the unrealized profit. So how do we compute the unrealized profit? The unrealized profit in this case is equal to the profit which was reported by the selling company, which you're told was 16 million. And because 40% of these goods were not yet sold, meaning that the profit not yet realized will be 40% of that profit, 40% of 16 million, which will give us 6.4. So therefore, to get the carrying amount, or the amount at which this inventory will be recorded in the group statement of financial position, we take 19.2 minus the unrealized profit of 6.4. 6.4. So this will give us what? Okay, so we have 19.2 minus 6.4. Yes, so that will give us 12.8. So this is the carrying amount of that particular inventory. So we get the difference, which is this value 12.8 minus 19.2, and that will give us a 6.4 million, which is basically a negative figure, and therefore this is deductible temporary difference. So let's move to the other point there, point number 3. So we are told the Huruma Limited has a portfolio of financial assets comprising readily marketable government securities, which are held as current asset for financial trading purpose. This investment are stated at fair value in the statement of financial position, with any gain or loss taken to profit or loss, and we are told the gain or losses are taxed when the investment are sold. Currently, the investment have a market value of 412 million and accumulated unrealized gain of what? 64. So basically what here given there is financial assets which are held by the company for trading purpose. And financial assets which are held by the company for trading purpose, they are known as financial asset at fair value through profit and loss. That is abbreviated as FVTPL. In full, financial asset at fair value through profit and loss. Now, this particular financial asset at fair value through profit and loss, in the company statement of financial position, they are stated there, they are recorded there at their current market value, at their current fair value, which you're told is 412. But now the tax base is always equal to the cost. Now, what you're told is that this particular fair value or market value of 412 million is arrived at after the company has added total accumulated gains over 64 million. So therefore, in terms of how we get the cost, which is the tax base, we take the fair value minus the accumulated revaluation gains. So this will give us now the cost, and which you are saying is what is the tax base. So this will give us 348 million. So therefore, that is the tax base here, 348 million. So let's get the difference. Here. The difference will be what? The difference here will be 64, which is a positive figure, meaning that it is a taxable temporary difference. So we are done with that particular point. Let's move to point number 4. And you're told Huruma Limited loan assets had a carrying amount of 168 after allowance for credit losses of 32 million based on 12-month expected credit losses. Tax relief is only allowable when the specific loan is written off. Specific loan is what? Is written off. So we have something called the loan assets. So when talk about the loan assets, these are like the loans this company has given to its customers. So the loans given to its customers. So we are told these loan assets, they have a carrying amount. That carrying amount is already given of 168, but we are told this 168 was arrived at. This was arrived at after the company had made a provision of 32 million. 32 what? Million, which you are told generally is allowance for credit losses. What is allowance for credit losses? The company from these loans it has given, the company expects loans equal to 32 million will not be paid. Therefore, what the company has done is to create a provision to set aside an amount of 32 million to cater for those particular loans which will not be paid. But we are told that tax relief is only given to this particular company once specific loan is written off. So because this is just a general provision, so what we need to do for us to be able to get the tax base, we need to take the carrying amount and then we add back this amount which had been what? Deducted. That will give us 200 million. Which now will be our tax what? Base. So we take this minus that, which will give us 32 and basically a negative, and that is deductible temporary difference. Okay, so then let's move to the other point, which is point number 5. And you're told Huruma Limited has unrelieved trading losses of 20 million as at 31st of March 2021. So these are like losses which were reported by this company during the current year. And the reason why they are known as unrelieved trading losses is because once a company has reported losses, those losses should be carried forward to the next financial year and offset against the profit which will be made in the following financial year. So because they have not been offset against now the profit reported in the previous years, that's why it is known as unrelieved trading losses. So we are told these unused tax losses arose from a one-off restructuring exercise carried out during the financial year, and which is highly expected that taxable profit will be available in the future. So meaning that this particular amount of 20 million will be carried forward and will have now to be offset against the future trading profit. The future trading what? Profit. So we also need to take into account that here, and basically we can just refer to that as what? As the unused tax losses. Unused tax losses. So these unused tax losses, are they taken to, or are they recorded in the company statement of financial position as an asset or liability? No. And therefore, the carrying amount for this is equal to 0. Once the company reports losses, those losses are not taken to the balance sheet as an asset or as a liability. So mean that the carrying amount is 0, because the carrying amount is a value at which an asset or even a liability is recorded in the balance sheet. But we know that this particular amount of 20 million will have now to be carried forward by the company, and it will have to be offset against now the future taxable profit. So therefore, the tax base of this is 20 million. Is 20 million. So we take this minus that, which will give us negative 20, and which is still deductible temporary difference. Yes, I think we are done, because what you're given in note number 6 is about the tax rate, and also we are told to assume that the deferred tax account had nil balance at the start of what? Of the year. So what we need to do here is we get the net amount. So we have 8 minus 6.4 plus 64 minus 32 minus 20, which will give us 13.6, and which is a positive figure. 13.6 million, and take into account is a positive figure that will be known as the net taxable temporary difference. And therefore, because this is a net taxable temporary difference, it will give rise to something called a deferred tax liability, and that is basically what the examiner was requiring us we compute what here. So therefore, the deferred tax liability at the end of the year, that is on 31st of March 2021, this one will be equal to the net taxable temporary difference, what we have here, times the tax rate. So our net taxable temporary difference is 13.6 million times the tax rate. So in our case, if we go back to the information we are given in note number 6, we are told to assume the tax rate or the corporate tax rate applicable to this company, 30%. So we get 30% of that figure. 30%, 0.3 times 13.6, which will give us 4.08 million. So this is now the amount of what? Of the deferred tax liability at the end of the year. At the end of what? Of the end. Basically, the marks or the items now which are marked in such a question are these figures which you have here, and also computing that particular what? Amount of deferred tax liability at the end of the year. Basically, a candidate who was able to do that, such a candidate scored all the 8 what? Marks which were allocated in that particular question. Basically, that is it. That what is required as far as that particular question is concerned. A very good question on deferred tax, which incorporate a lot of concept or a lot of group accounting concept. So we stop at that point. See you in the next session as we still look on another illustration.
I greet you all candidates and also welcome you to the lesson. The subject is communication skills. In our today's session, we are going to study the documents that are used in meetings. The documents that are used in meetings. So by the end of this lesson, you should be able to identify the documents that are used in meetings. You should be able to explain their role in meetings, why it's important to have the documents, and so on. Now, an official meeting, by now candidates, you know, should be supported by several written documents. And for the smooth functioning of a meeting, supporting documents must be prepared carefully. And usually, they are prepared by the secretary in consultation with the chairman. And in small business units, such documents are prepared by the office manager himself or herself. In this lesson, we are going to study the most essential documents that are needed to be prepared in connection with the meeting. And the first document is notice. Document number 1, notices or notice. Another document is known as agenda. There has to be a document that outlines the agenda of a meeting. Then the third obvious document, minutes. Minutes. All right? Let's start by notice. Now, candidates, when a meeting is to be conducted, a notice is required to be sent to all the members who are expected to attend the meeting. It is just an intimation about the meeting, the conducting of the meeting. And generally, it is typed or printed on the organization's letterhead and issued under proper authority. And the notice of a meeting must include, number 1, the name, must include the name, that is the name of the organization, The notice, I've said, firstly, it must be printed on the letterhead. Then it has to include the name of the organization, the day, date, and time that the meeting is expected to be held. The day, the date, and the time. Another important element is a place. Where will the meeting be held? Within that notice, it has to be clear location of the meeting, the place of the meeting. That is the address and the specific room or hall where the meeting will be held. Number 4 is the purpose. What is the purpose of the meeting? The purpose of the meeting has to be indicated within a notice, the purpose of the meeting, and if possible, the agenda. If possible, the agenda of the meeting. If the agenda is known, then it's important to include the agenda in the meeting. Another important aspect is the circulation, the date of circulation, and the secretary's signature. In this notice, there ought to be the secretary's signature. The secretary's signature. And candidates, the public companies and many registered organizations, they may be required to use a legal form of notice for the general body meetings. Legal form, which may include some of these items: the name of the organization, the day, date, time, the place of the meeting, the purpose and agenda of the meeting, and the secretary's signature. All right? I've said if it's public companies, the law may require that when writing a notice, that such a notice must be done using a legal form of notice for the meetings. And candidates, the notice has to be accompanied by an agenda for the present meeting and the minutes of the previous meeting. The minutes of the previous meeting. I'm saying the notice has to be accompanied by the agenda for the present meeting and the minutes for the previous meetings. The notice, candidates, of the meeting must also be sent well in advance. Under normal circumstances, could be around, say, 7 days. Notice should be given to all members attending the meeting. And if it is located far away, the far away distance, it is important to give a longer duration, around, say, 21 days and so forth. There are also certain meetings that the law stipulates the time or the days. The law may stipulate or may clearly indicate that the meeting, for example, has to be held. The notice must be sent, say, 21 days before the meeting is held. So notice is one of the documents that is used in meetings. Before a meeting is held, a notice has to be issued to the members. So these are some of the contents. These are contents that you'll find in a notice of a meeting. All right? Contents. The second document is the agenda. Agenda number 2. The agenda. Now, agenda means things to be done. It is also called business order or order of business to be discussed during the meeting. And agenda refers to the program schedule of the meeting and is prepared by the convener or the secretary in consultation with the chairman and his approval. And it's also sent along with the notice of the meeting in order to enable the members to do what? To come well prepared for discussions during the meeting. Agenda. An agenda, candidates, begins with the call to order. That is call to order a meeting, and ends with the postponement of the last meeting. So an agenda is an order of business to be discussed during the meeting. And it's important, candidates, to have an agenda for a meeting. It's very important so that people come when they are well prepared for the meeting. Okay? It should cover things like in the agenda, you should cover things like reading and approval of minutes of the last meeting. An agenda can cover items like matters arising out of previous meetings, minutes, An agenda can also have maybe apologies from absent members. An agenda can also indicate urgent and non-controversial items. An agenda can include matters requiring close discussion and debates, as well as any new or on-the-spot items which may need approval of the chairman. So it's important to have an agenda, because a well-structured meeting agenda is a valuable tool for ensuring that meetings achieve the desired results within the time allocated. Because the outline of activities to be carried out, as well as the list of specific topics to be discussed, should aim at guiding the participants through the meeting. And therefore, an agenda plays a significant role in ensuring that the meeting is productive. Agenda. It's a second document that is used in meetings. And you can be asked a question like, what are the purposes of an agenda in a meeting? Why is it important that the secretary prepares a document outlining the agenda of a meeting? In answer to that question, you can say, one, an agenda gives what we call advance communication. Advance communication. Candidates, an agenda ensures that pertinent information concerning the issues to be discussed is passed to the participants in advance. As a result, it will give participants ample time to do their research and carry out consultations, since the agenda contains a list of topics or issues to be tackled or to be discussed in the meeting. Additionally, participants will also know whether they are scheduled to talk or to make presentations, and so on. So all the members invited for the meeting know what to expect in the meeting. Advanced communication. That is one reason why it's important to give an agenda before the meeting. The second reason, focus. Focus. Now, an agenda is significant in keeping the participants focused on the topic at hand. And that is because it contains a list of the goals of the meeting, as well as the major issues that are essential in keeping the discussion centered on the meeting's purpose. Alternatively, it can be achieved by informing the participants' priorities or giving consideration to all issues. So an agenda helps the members to keep focus on the objectives of the meeting. Focus on the objectives of the meeting. The third reason why it's important to give an agenda to a meeting is in relation to engaging the members. Engaging. Engaging members. Now, in addition to emphasizing the objective or the purpose of the meeting, a brief verbal preview of the agenda at the beginning of the meeting helps set the pace of the meeting. It also gives participants an opportunity to identify a standpoint regarding an issue, as well as where to fall back when the meeting gets off topic. And as a result, participants get to understand the flow. They get to understand what? They get to understand the flow of the meeting. The flow of the meeting. They get to understand the flow of the meeting, and to adequately engage themselves in the discussions. So agenda will help the members to engage themselves in the discussion. An agenda, lastly, I can say is a time management tool. Time management tool. An agenda is a time management tool. An agenda provides step-by-step framework for having an effective and efficient meeting. It helps to ensure effective use of participants' time, especially if the agenda includes a time that will be allowed for each item on the agenda. So sticking to the time allotments helps participants stay focused on the important issues and items on the agenda. So when asked what is the purpose of an agenda, you can give these points here. Agenda. The second document. The third important document is minutes. Minutes. Now, candidates' minutes refers to the record of the decisions taken at the meeting. It's just a record of the decisions, a record of what was discussed at the meeting. And all companies, all statutory bodies, all social organizations, associations, and committees have to maintain a record of meetings. Why? Because meetings are the official record of work done and decisions taken at the meeting. So the minutes must be precise and clear. And once minutes are approved and signed, it can be even be accepted by a court of law as evidence of the proceedings of meetings that are held. And the main objective of meeting is to record concisely and accurately the essential work done at a meeting. And the minutes of companies, together with statutory bodies, are written in a formal style. Other organizations may write minutes in informal style, but companies, registered companies, must do so, must write minutes in a formal style. And minutes must contain contents. Let's discuss briefly the contents of minutes. Minutes must contain the name of the organization, minutes must also contain the day, date, and time. Day, date, and time when the meeting is held, together with even place. Let me put there and place. Day, date, time, and place. When you write minutes, make sure the minute is dated. The minutes are dated. There is time. There is the date and the day. Number 2, minutes should indicate the number of members present. Number of members present in that meeting. Number of members present at the meeting. Minutes should indicate the name of the chairman. The name of the chairman, the one who chaired the meeting, and the secretary. The name of the chairman, the name of the secretary is important to also be included in the meeting. Minutes should also have, this is number 5, minutes should have names of members present. Names of members present. Here we have number of members present. If there are 30, you need to indicate 30 members are present. Then you should also have their names written in the minutes, the names of members present, and sometimes the members have to sign that they are present at the meeting. Names of members present. The names of members absent, names of members absent. For example, if it's a committee of, say, 12 members or 11 members, and only 9 members were present. So the committee members should be distinguished. There should be distinction between those who attended the meeting and those who did not attend the meeting. Names of members present at the meeting, and also the names of members absent during the meeting. Then we also have attendees by special invitation. If there are certain persons who are invited to a meeting, maybe a specialist who was to train or give maybe consultation to the committee or in the meeting, then the name of such an attendee has to be included in the meeting. You may also have members like auditors in a meeting. The name of the auditor should be included. You may have, say, bankers and so on. Then we have also a record of transactions. Record of transactions. What business was transacted in the meeting? The name of the record of transactions. Record of transactions. What actually took place? What agenda was discussed? What was discussed at the meeting? There has to be a record of everything that was discussed at the meeting. Signature of the secretary. Included in the minutes, you need to have signature of the secretary. It is the secretary who writes the minutes, and therefore there has to be the secretary's signature. So signature of secretary is important, and that signature is supposed to be, the secretary ought to sign the minutes after approval of minutes by the chairman. Signature of the secretary after approval by the chairman. That means it has to be clear in the minutes that the chairman approved the minutes, then the secretary signed. Approval of the chairman and signature of the secretary. So these are some of the contents of minutes, which is a very important document when preparing or writing minutes of a meeting. And the candidates' minutes, I've said, mean a record of proceedings in a meeting. In other words, minutes mean a record of proceedings in a meeting. Minutes, candidates, is just a type of a report and should therefore be made in what we call past tense or reported speech. Minutes may be handwritten, may be in form of a memorandum. Minutes could also be typed. And candidates, it's important to note that the primary function of minutes is to place on record the proceedings of what took place in a meeting. The primary function of minutes is to place on record the proceedings of a meeting as a basis for subsequent action. In a company, candidates, when meetings are held, is for the purposes of deliberating on certain matters, which may need action after the meeting. People don't meet for the sake of meeting. No, there has to be an objective for a meeting. It could be solving a problem. Now, when people meet, when employees meet or when managers meet, the purpose is to solve a certain problem. So minutes will contain a record of the proceedings of what took place. The function of minutes is to place on record the proceedings of a meeting, and the proceedings is a basis for subsequent action or decision. Minutes. And we can even say that minutes constitute the authorization for actions that are taken. There are certain actions before they are taken, there has to be a meeting. Because remember, candidates, we live in a world of what we call democracy. Before decisions are made, people have to sit and decide. There are certain decisions that cannot be made unilaterally. No, there has to be a meeting of people sitting together, deliberating, and then they come up with a decision. So the minutes constitute the authorization for such decisions. And they constitute a true and an impartial record of the events. When the secretary writes the minutes, then the secretary is supposed to write down exactly what took place. Exactly took place. It's supposed to be impartial. It is an impartial record of events that took place in a meeting. And that brings the lesson to an end. We effectively stop on that note. Our today's discussion was on documents that are used in meetings. We identified 3 documents: notices, we have the agenda, then there is minutes. In this lesson, we outline the contents of a notice. We say that a notice must bear the name of the organization. It also has to be printed on a company's letterhead. A notice should indicate the day, date, and time of the meeting, plus the place. Number 4, we have the purpose or the agenda of the meeting, if possible. Then the notice has to be signed by the secretary. The second item is the agenda. We identify the importance of having an agenda. 1, 2, 3, 4. Then we finally discussed the third document, minutes. We said that the minute should contain the name of the organization, the day, date, time, and place of the organization, or where the meeting is to be held, the address, the physical address where the meeting is to be held. Number 3, there is number of members present. There should also be the total number of members present. The minutes should also contain the name of the chairman and the secretary, the names of members present, names of members absent, attendees by special invitation, like auditors, like bankers, and consultants. Their names should be indicated in minutes. Then there is the record of what transpired at the meeting, what business was conducted at the meeting, what was discussed at the meeting. There has to be a record of everything that was said at the meeting. Then lastly, there is a signature of the secretary after the approval of the chairman. The minutes should be signed by the secretary after approval by the chairman. So thank you for attending the lesson. I will give you today's assignment here. So here is your assignment. Question 1, define the following terms. 1, notice. 2, agenda. 3. Minutes. Number 2, give 5 reasons why an agenda should be sent to committee members prior to a meeting. 3. Outline 7 contents of minutes of a meeting. Make sure the assignment is done before we meet in our next session. God bless you. Bye-bye.
Hi candidate, welcome to another session of Manifested Earning Crisis. So in this session, I want us to look on an illustration question regarding the computation of diluted earnings per share. So this is our lesson number 4 of this particular topic. So in the first session, we defined what is earnings per share and basically the importance, the significance of the same. In the other session, that is lesson 2, we looked on the computation of basic earnings per share, and in our lesson number 3, we did an illustration question regarding the computation of earnings per share. And in this particular session, I want us to look on how do we compute the diluted earnings per per share. And specifically, I want us to look on a question which was tested in this sitting here. That is the sitting of April 2022. Specifically, this is question number 3C. So we read the question and it reads, R Limited, a publicly traded company, has 9 million ordinary shares of shillings 1 par value and 1 million 7% redeemable preference shares of shillings 10 par value each on 1st of October 2020. As at that date, R Limited had also in issue 2.5 million stock option. These options are exercisable at shillings 1.5 per share. The average fair value per ordinary share during the year which ended 30th September 2021 was 2 shillings. R Limited, profit for the year which ended 30th September 2021 from continuing operations was 14,575,000, and the profit for the year which ended 30th September 2020 was 15,100,000. So the following transactions took place during the year ended 30th September 2021. 1. On 1st January 2021, the company issued 1.8 million ordinary shares for 1, that is in 1-for-5 right issue at a price of 2 when the market price per share on cum right basis was 5. 2. On 1st April 2021, R Limited issued 1 million ordinary shares at full market value. 3. On 1st July 2021, the company issued shillings 5 million convertible bonds with effective interest rate of 12%. The bond is convertible into ordinary shares at the holder's option on the basis of 60 shares per 100 bonds. None of the bonds were converted during the year ended 30th September 2021. So number 4, the income tax rate applicable to R Limited is 30%. So what are we required? Number 1 is basic earnings per share for the year which ended 30th September 2021. Roman 2, restated earnings per share for the year which ended 30th September 2020. And Roman 3, we are required to compute the diluted earnings per share for the year which ended 30th September 2021. So we start with Roman 1, whereby we are required to compute the basic earnings per share for the year which ended 30th September 2021. BEPS for the year ended 30th September 2021. So the first thing we need to recall here is the formula for computing the basic earnings per share. And basic earnings per share is computed by taking the profit attributable to ordinary shareholders, abbreviated by PATOS. We divide that with WANOS, weighted average number of ordinary shares. So therefore, we need to compute these two items. So let's start by determining the PATOS. And we know that the PATOS, this one is equal to the profit after tax, or the profit for the year, and actually from the continuing operations. And then we less the preference dividends, we also less any profit attributable to NCI. So if you go back to the information we have in in paragraph number 3 of that question, we are told our limited profit for the year ended 30 September 2021 from the continuing operation was 14,575,000. It is important to note that in computing the diluted and also the basic earnings per share, the company should use the profit for the year from the continuing operations. So mean that any profit or loss from a discontinued operation should be excluded. Basically, a discontinued operation is a component of an entity which has been sold, like a subsidiary which has been sold, or maybe a branch which has been what? Closed down. So any profit or loss from such discontinued operation should not be taken into account in computing the basic earnings per share and also diluted earnings per share. So therefore, what you are given here is the profit for the year. The profit for the year, in which case we are told this exclude, or this is basically the profit for the year from the continuing operations, and that is given as a figure of 14,575,000. So to this, what do we need to do? We need to less preference dividends, and also we less profit attributable to NCI, in case this is or in case we are computing the profit or the basic earnings per share for a group of companies, we less the profit attributable to non-controlling interest. But basically in this case here, we are computing now the earnings per share for a single company, R Limited. This is not a parent company, so we don't have the profit attributable to NCI. What about the preference dividends? Are we given any information about the preference shares issued by this company? Yes, in first paragraph, where we are told this company had 9 million ordinary shares of shillings 1 par value, and also the company had issued 7% redeemable preference shares. There is something we said in our first lesson when we were looking on the introduction to the computation of basic earnings per share, whereby we said if the preference shares issued by the company are redeemable, one, we say that these are preference shares issued, the company is supposed to redeem them, to buy them back after a given period of time. To the company, we said this is a component of non-current liability, and equally we said the dividends which the company pay as far as these preference shares which are redeemable are concerned, those dividends are classified as part of finance cost. And basically we know finance cost, this is an expense. So in arriving at the profit for the year, this particular finance cost will have been deducted. So therefore, any preference dividends on preference shares which are redeemable, we don't less those particular dividends here because they have already been deducted in arriving at this particular profit as part of what? Finance cost. That is very, very important, and that's why you can see the examiner here had tricked you by giving you preference shares which are redeemable. Don't less their preference dividends here because they have already been deducted in arriving at that particular profit there as part of the finance cost. So mean that our PATOS here is therefore or remain the same amount of 14,575,000. So having that, we proceed and we determine the one-off weighted average number of ordinary shares. So how do we compute this? We compute this by taking into account the ordinary shares issued and fully paid at the start of the year, plus the other shares which were issued by the company during the current year. So we can see this year was ending on 30th of September 2021. It means that this year started on 1st of October 2020. So we need to determine how many ordinary shares were issued at the start of the year, 1st of October 2020. So, and we have that particular information in the first paragraph, first paragraph, and we are told this company at the start of the year had 9 million ordinary shares. So mean that the ordinary shares issued by the company at the start of the year were 9 million. In this case, we said you have to be very careful, check whether the whatever you're given there, that is the value of the shares or the number. Anytime you don't have the word shillings before 9 million, it means that automatically the number of what? Of shares. And actually you can see that is on 1st of October. So to this, what we need to do is we add the other shares which were issued by the company during the current year. So can we go to the where we have the transactions which occurred during the current year. So we go specifically to note number 1, and you are told on 1st January 2021, this company issued 1.5 million ordinary shares in 1-for-5 right issue at a price of 2 when the market price on the CAM right basis was 5. So what are we given there? This is a right issue. Remember, you say this is a very common concept. Anytime you come across a question for a right issue, mostly this concept is tested. So sorry, anytime you come across a question for earnings per share, this concept is always tested. So we are told on this date there was a right issue. There was a right issue. So what we said is that during a right issue, the company issues shares to the existing shareholders of the company at a price below the market price. So what we do is that the shares issued, we have to split them into two. Shares issued at full market price and the shares issued free of charge. But for us to do that, we need to compute 2 items. One, how many shares were issued by the company during the right issue? In our case, we are already given the shares which were issued, which we are told they were 1.8. That is already given to us. So the other thing we need to compute is something called the theoretical X-right price. Theoretical X-right what? Price. Basically, this is the market price per what? Per share after the right issue. And basically, in terms of how we compute this, is basically very, very simple. We said here, we say that before the right issue, if a shareholder held 5 shares, because we are told during the right issue, the company made a right issue of 1-for-5 shares. It means that 1-for-5. It means that during the right issue, the company was to issue 1 share for every 5 shares which were held. So if therefore before the right issue you held 5 shares, and each share before the right issue was trading at 5, then during the right issue, as a shareholder of this company, during the right issue, you are to be issued with 1 share, but at a price of what? At a price of 2. At a price of 2. And I think having that, we can proceed. We determine the theoretical X-right price. So we take this plus times that, which will give us 25, this times this, which will give us 2. And basically that means that a shareholder who held 5 shares before, after the right issue, he'll be holding 6 shares. And the total market price of those 6 shares is what? Is 27. So what will be the market price of 1 share after the right issue? So we take 27, which is the price of 6 shares, divide that with what? With 6. So this will give us now the market price of 1 share after the right issue. 27 divided by 6, and this will give us 4.5. 4.5. So that is a theoretical X-right price. So having that, let's come back here. We do our split. We start by determining the issue at full market price, which is equal to amount received by the company from the right issue, which is equal to the shares issued 1.8 times the issue price. The shares were to be issued at a price of 2 shillings per share. Then divide that with theoretical X-right price 4.5. And then these particular shares should always be weighted on time basis. For the period they were held. So these shares were held from 1st of January 2021, and we know the year was ending 30th September 2021. So these shares were held for 9 months, 9 all over 12. Then from there we determined the bonus shares. The shares issued free of charge, which is equal to the total shares which were issued, 1.8 minus the shares issued at full market price. What we have here, not the final answer you get here, but these are the shares issued at full market price. 1.8 times 2 all over 4.5. And these particular shares here, we said they should not be weighted on time basis. So let's determine the shares issued at full market price, which will give us 600,000. And then we determine here the bonus element, which will give us 800,000. We less that from 800, 1.8, and this will give us 1.1 million. So 1 million, these are the shares which were issued free of charge. So that's how we deal with the concept of the right what issue. So let's move to point number 2, and you're told on 1st of April 2021, the company issued 1 million ordinary shares at full market price. So on 1st of April 2021, we say there was issue at a full market price. So how many shares were issued? 1 million. 1 million. So what we just need to do to these shares issued at full market price, we weigh them on time basis for the period they were held. We multiply them with the proportion of time they were held. They were held from April of 21st April 2021 to 30th September 2021. Automatically, those are 6 months. So we have April, May, June, July, August, September. So those are 6 months. So we multiply that with 6 all over 12, and basically that will give us half, which is 500,000. So that's what we have. And then in note number 3, we are given information about convertible bonds which were issued by the company, which were issued on 1st July 2021. And in the last sentence, we are told none of the bonds were converted during the year. So remember, we consider such convertible securities in computing one-offs if some of them were converted into ordinary shares during the current year. So therefore, these will not be applied here. We are not going to use that here, but that will be used in computing what? The diluted earnings per share. What you're given in note number 4 is about the income tax rate. So basically what that means that we don't have other shares which were issued during the current financial year. So what we need to do, let's add all this. So we have 9 million plus 600,000 plus 1 million plus 500,000. So which will give us 11 million 100,000. Yes, having that, what do we need to do finally? We need to compute now. Remember, this is our weighted average number of ordinary shares. So we need to compute now the basic earnings per share, because we have the 2 items we require. So we have the PATOS there, and then we also have the one-offs there. So the basic earnings per share is equal to PATOS 14,575,000. Divide that with the one-offs, which is 11,100,000, and we get the final answer, which is 14,575. Divide that with answer, which will give us shillings 1.313 shillings per share. Shillings per share. So that is it. That is what was required as far as Roman 1 of that question is concerned. So let's move to Roman 2. In Roman 2, we are required to compute the restated earnings per share of the year which ended 30th of September 2020. 2020 is basically the previous year. So this is, in other terms, what we refer as adjusted earnings per share. And the earnings per share of a previous year is adjusted if during the current year, the current year we can say is the year 2021. If during the current year, there were some shares which were issued as bonus shares or free of charge. So, and therefore, in terms of how we compute these restated earnings per share, we take the PATOS for this year, which is 2020, divide that with the one-offs for 2020, and then now to the one-offs, what do? You add the bonus shares, which were issued in the preceding year, the year 2021. So in our case, we already have the PATOS in in paragraph number 3, where we have the profit for the year 2020, which is 15.1. Remember, the profit for the year, just like what we have said in this year, the profit for the year, or the profit after tax, is the same with what? With the PATOS, because we don't have preference dividends. So therefore, the PATOS for that year, 15.1 million, 0.1, divided that with one-offs for the previous year. As far as the previous year is concerned, 2020, we only know the shares which were issued and fully paid at the end of 2020, which were the same with the shares issued and fully paid at the start of the current year. And therefore, if we are just given the shares issued and fully paid at the end of the year by the examiner has not given you the shares which were issued during that year, then you assume those were the shares which were outstanding for the whole what year, and therefore that will be your one-offs. So therefore the one-offs for 2020 will be 9 million. Will be 9 million, and then now to this we add the bonus shares which were issued during the current year. So during the current year, do we have bonus shares? Yes, we have this 1 million bonus shares, 1 million. So therefore that will be 15.1, or basically 15 million divided by 10 million, So this will be 15,100 divided by 10 million. That will go. So this will be shillings 1.51 shillings per share. So this is the restated earnings per share for the year 2020. So then from there we proceed to Roman 3, and I hope you can see the marks which were located in that particular question. There were 2 marks. Generally, what is marked in such a case are those items. By doing that, you get 2 marks. In Roman 1, what was the marks are located there? 4. So what is marked there is the PATOS, profits attributable to ordinary shareholders, and basically were you able to deal with these different types of shares which were issued during the current year. So by doing that, you get now the 4 marks which were located there. So let's move to Roman 3, whereby the examiner was requiring the candidate to compute the diluted earnings per share, DEPS, diluted earnings per share for the year which ended 30th of September 2021. So in computing these diluted earnings per share, basically here you need to follow like 3 steps, 3 simple steps. The first thing, one, you go through the information which you are given there, and you identify the potential ordinary shares the company had during that year. Potential ordinary shares here, you'll be looking for things like convertible securities. Which convertible security had the company issued? And 2, you check, had the company, or whether this company had granted the employee stock options which are to be exercised in the future. That is the first thing. Identify the potential ordinary shares of the company in the year under consideration. Once you do that, step 2 is you compute increase in earnings, increase in number of shares for each potential ordinary shares. And for you to do that, you have to assume that those particular convertible preference shares or those particular potential ordinary shares were converted into ordinary shares. And actually, in our previous session, we looked on how we determine the increase in earnings, the increase in number of shares for different types of potential ordinary shares. That is something you have to recall. And then once you do that, step 3 is you compute the diluted earnings per share. I gave you the formula for that equal in the previous session. So those are the 3 simple basic steps you need to follow in computing the diluted earnings per share. So therefore, what we need to do first of all is we go back to the information which is provided here, and we check which potential ordinary shares this company had, or the potential ordinary shares, or potential ordinary share or shares of R Limited in the year 2021. I've said here you check for convertible securities which the company may have issued, and stock options which may have been granted to the employees and which are to be exercised in the future. Now, number 1, from the information we have in paragraph 2, we are told this company had granted the employee stock options. And take into account these stock options are to be exercised in the future, they automatically qualify to be potential ordinary shares. Also, if you go back to the information, or you go to the information given in note number 3, so we are told this company also issued convertible, that is 12% convertible boats. 12% convertible boats. So therefore, in our case, these are the two potential ordinary shares which R Limited had in the year 2021. Having done that, we go to step 2. we compute the increase in earnings, increase in number of ordinary shares, or increase in number of shares for each, on the assumption that these potential ordinary shares were converted into ordinary shares during the current year. So let's start with the stock options. Stock options. And now you have to recall what we discussed in our previous session as far as the computation of increase in earnings and increase in number of shares is concerned. We said increase in earnings for stock options always is zero. As a result of the employees of the company exercising their stock option during the current year, that do not result to any form of savings by the company. There is no savings the company will make. So the increase in earnings is equal to zero. So what about the increase in number of shares? Increase in number of shares, we said that this is equal to the bonus element. What we consider here are the shares which would have been issued to the employees of this company free of charge. You have to recall the formula. How do we compute these bonus shares? You take the total shares which would have been issued to the employees, assuming they exercise the stock option during the current year, and then to this deduct the issue at full market price. So how many shares would have been issued to them at full market price? So as per the information given in paragraph 2, we are told, as at that date, that is now at the start of the year, this company had granted the employees 2.5 million stock options. So basically what that means, and basically option is a right, a stock option is a right. And actually, unless told otherwise, you assume one stock option is equivalent to one share. So mean that if the employees exercise the stock option during the current year, then they would have been issued with 2.5 million shares, and then we deduct the shares which would have been issued to them at full market price. So in terms of how we compute these shares issued to the employees at full market price, one, you compute the amount which would have been received from the employees, assuming the employees exercise the stock option during the current year, and then divide that with the average market price. So how do we compute the amount which would have been received from the employees? We take the shares which would have been issued to them. Remember that we are making an assumption here that the employees exercise the stock option during the current year. So they would have paid an amount of 2.5 times the amount they were to pay per share. The amount they were to pay per share was 1.5. And then divide that with the average market price per share, which is the same with the average fair value, which is 2. So this will give us now the shares which would have been issued to the employees of the company free of charge. So let's work out on that. We compute that. So what do we have here? We have 2.5 times 1.5 divided by 2, and then we deduct that from 2,500, which will give us 625,000. 625,000 shares. So in our case, basically what that means that we already have now the increase in earnings and also the increase in number of shares. So we need to proceed and deal with the other type or deal with the other potential ordinary share, and that is 12% convertible bonds, where we need to compute the increase in earnings and also the increase in number of shares. So we have 12% convertible bonds. Convertible bonds. So we start by computing the increase in earnings. And the increase in earnings, as far as the bonds are concerned, in our previous class, we said that this is equal to the interest which was paid by the company, interest paid, but we multiply that with 1 minus tax rate. 1 minus a tax rate. So let's compute the interest which was paid here. Interest which was paid, which will be equal to 12% of the value of 12% convertible bonds, which is 5 million. 5 million. But it's also important to note when these boats were issued. The boats were issued from 1st of July 2021, and basically the year is ending 30th September 2021. So the company here paid interest not for the whole year, but from the date the boats were issued. So they were held for how many months? Or basically the company paid interest for July, August, September. The company didn't pay interest for the whole year. So multiply that with 3 all over 12. That will give us the interest paid, and then multiply that with 1 minus tax rate. Tax rate as per note 4 is 30%, so this is 1 minus 0.3, which will give us 0.7. So this will give us now the interest which was paid by the company, but net of a tax, net of tax. So let me compute that here, which is 12% times 5 million times 0.7, which will give us for 20,000. For 20,000. So then finally, as far as this is concerned, we need to compute the increase in number of shares. So increase in number of shares, basically this refers to the number of ordinary shares which the company would have issued on the assumption that these boats were converted into ordinary shares during the current year. So what we need is a conversion rate. The conversion rate is given in note number 3. Sentence number 2, where we are told the boat is convertible into ordinary shares at the holder's option on the basis of 60 shares per shillings 1,000 boats, per shillings 100 boats, not 1,000, 100 what? Boats. And in our case, we know the boats which were issued by this company, they had a value of 5 million. 5 million. So what we need to do is basically to determine the number of ordinary shares which would have been issued by the company on the assumption that these particular boats were converted into ordinary shares during the current year. So we take 60 times 5 million, divided that with 100, divided that with 100. It's also important to note the date when these boats were issued. The boats were issued 3 months to the end of the year. So basically what that means is that even if the holder of these boats converted them into ordinary shares, they could have converted them from the date of the issue, from 1st July 2021, meaning that these particular shares which would have been issued to them would not be held for the whole year, would only have been held for 3 months out of 12. So we have to weigh those particular shares equally on time what basis. So let's work out that. And we see the number of ordinary shares which would have been issued on conversion. We have 60 times 5 million divided by 100 times 3 divided by 12. So which will give us 750,000 shares. 750,000 shares. So that refers now to the number of ordinary shares which would have been issued, assuming that those particular boats were converted into ordinary shares. And what is important as far as this particular question for computing the diluted earnings per share are concerned is computing these items: increase in earnings, increase in number of shares for the various potential ordinary shares. So those are the items which give you marks. So having that, finally what we need to do is we compute the diluted earnings per share, which is equal to the PATOS, profit attributable to ordinary shareholders. We already have that here, 14,575,000. We divide that with WANOS, 11,100,000. To the PATOS, we add increase in earnings for all potential ordinary shares. So the increase in earnings there is 0. Increase in earnings there is 420. So come, you add them here. You add that here, even if it is 0, make sure you include it here. So you have 0 for stock option and for 20 for convertible boats. And then to the WANOS, you add increase in number of what? In number of shares. So the number of shares there 625. Here is what? 750. So you have 625,000, and this one which is 750. So we work out all that, and basically that should give us now the diluted earnings per share, diluted earnings per share, per share. So let's work out that. We see what we are going to get here. So we have 14,575 plus 0 plus 420. Okay, 420, divide that with 11,100,000 plus 625,000 plus 750. Yes, and that will give us shillings 1.2020, 1.2020. Yes. So basically that is it, that what was required there. And you can see that the marks which were allocated there were 4. Mostly what is marked are these items. These are the items which will give you a candidate now there. The 4 allocated what? The 4 allocated marks. So that's basically what was required as far as that question is concerned. Before we wind up, I want to give an assignment. As far as this computation of diluted earnings per share and also the computation of basic earnings per share is concerned. We have so many questions from the past papers, but specifically I want to give this question here to be your assignment. So in this the question for May 2019, question 4B. Question 4B, make sure you attempt that particular question, but I'm saying we have so many questions from what? From the past paper. So once you attempt that particular question, if you have a challenge, I usually encourage my candidates, my students, to acquire this particular revision partner from Manifested Publishers. It is updated up to the latest sitting. You'll be able to get the solution for all those particular questions at the back of this particular book. So make sure you have this because it will help you in course of your revision. So basically that brings us now to the end of that particular topic of the earnings per share. And actually from the past papers you can see this is a very, very important topic for you to be able to understand because it's highly examinable. So see you in the next session as we look on the other topic.
Greetings and welcome back to the lesson. Today we are going to analyze the approaches to corporate governance in the public sector. Approaches to corporate governance in the public sector. Now, corporate governance in the public sector refers to the systems, processes, and principles by which public organizations are directed, controlled, and held accountable. You understand? Approaches to corporate governance in public sector. So we are defining corporate governance in the public sector as the systems, the processes, and principles by which public organizations are directed, controlled, and held accountable. And the aim is to ensure that public resources are managed effectively and efficiently to achieve public policy, objectives and to serve the public interest. So there are several approaches to corporate governance in the public sector, and each approach has its unique features and emphasis. That is what we intend to study in today's lesson. We are going to give a brief adumbrration of the approaches to corporate governance in public sector. So the first approach is known as traditional public administration. The traditional public administration is an approach that emphasizes the hierarchical structures. It emphasizes bureaucratic rules and centralized decision making. It emphasizes hierarchical structures. It emphasizes bureaucratic rules and centralized decision making. These are the key features of traditional public administration. It emphasizes hierarchical structures, bureaucratic rules, and centralized decision making. And this structure or approach prioritizes accountability, but it is quite rigid and slow to respond to changing circumstances. Because of bureaucracy, change in this approach is not easy. Traditional public administration, that is the traditional public administration. Now, the second approach is a new public management. New public management. The new public management is yet another approach to corporate governance in the public sector. This approach emerged in the late 1980s and 1990s as a reaction to the perceived inefficiencies in the traditional public administration. It emphasizes market-oriented principles such as competition, emphasizes market-oriented principles. It emphasizes market-oriented principles such as competition, that is a market-oriented principle, performance measurement, and customer focus. It emphasizes market-oriented principles such as competition, performance measurement, and customer focus. Do you understand? And candidates, the new public management also aims to improve efficiency. It aims to improve effectiveness in the public sector, but it has also been criticized for its focus on economic rationality and neglect of social equity. So that is the downside of the new public management. It focuses mainly on the economic side of things at the neglect of the social equity. And I've said the approach developed as a result of the inefficiencies in the traditional public administration. The third approach is the new governance. New governance, or we can say new public governance. New public governance, that is the word. New public governance. New public governance. New public governance is an approach which is a response to perceived shortcomings of the new public management. You understand? Which emphasizes collaboration, network governance, emphasizes collaboration, it emphasizes network governance, and citizen participation. And citizen participation. It recognizes that public problems are often complex and require the involvement of multi-stakeholders. So the new public governance model aims to create a more inclusive and responsive and responsible public sector, but can also be complex to manage and may lack clear lines of accountability. So this one also has downside. We've seen it emphasizes collaboration, network governance, and citizen participation. The reason being that it recognizes that public problems are often complex and require the involvement of multi-stakeholders. This model welcomes many stakeholders, or what we are calling network governance, but that in itself is also a challenge because managing many stakeholders can be challenging, and that is the disadvantage of this new public governance model. It may be complex to manage, and there may be no clear lines of accountability. The fourth approach is a public value management approach. Public value management approach focuses on creating public value, which is defined as the value that public services create for citizens and the society. So the public value management emphasizes the importance of understanding and the importance of responding to the needs of the citizens and their preferences. It aims to make the public sector more relevant and responsive, but it can also be difficult to measure and may lead to conflicts between different stakeholders. That is the public value management. The fifth approach is good governance approach. The good governance approach encompasses a broader set of principles, including accountability, transparency, participation, the rule of law, responsiveness, and so on. It emphasizes the importance of ethical leadership, effective institutions, sound public policy, and so on. So the good governance model aims also to create a stable and a predictable environment for public services delivery, but it can also be challenging to achieve in practice. So these are, in brief, 5 approaches to corporate governance in the public sector. And in the Kenyan public sector, the Kenyan public sector has adopted a mix of these approaches. The traditional public administration still plays a significant role, especially in government ministries and departments. However, there has been a growing emphasis on the new public management. There has been a growing emphasis on the new public management principles, particularly in the areas of performance management and results-based budgeting. And in recent years, there has also been a shift towards the new public governance, which the government recognizes as being important in terms of collaboration and because of the aspect of citizen participation in public service delivery. And we know that the Constitution of Kenya enshrines the principles of good governance the principles of good governance are also enshrined in the Constitution of Kenya, including transparency, accountability, public participation as fundamental to conduct of public affairs. So here is your today's assignment on approaches to corporate governance. 1. Discuss the main approaches to corporate governance and the implications for public sector organizations. 2. What are the key differences between the new public management and the new public governance approaches, and how have they influenced corporate governance reforms in Kenya? 3. How can public value management be integrated into existing corporate governance frameworks to enhance the relevance and responsiveness of public services? 4. What are the challenges and opportunities in adopting a good governance approach to corporate governance in the public sector? In our next lesson, we are going to discuss corporate relationships in the government. Bye. I greet you all and welcome you to the Public Sector Governance, Policy and Administration class. Today we are going to discuss the values-based leadership in the public sector. Values-based leadership. Now, the values-based leadership is a leadership approach that prioritizes ethical principles, integrity, and national values as the foundation for decision making and actions in the public sector. It emphasizes the importance of aligning personal and organizational values with the core principles of the society and the public service. So what are the core principles of value-based leadership approach? The principles. We are going to discuss the core principles. Principles of value-based leadership. And I've described values-based leadership as a leadership approach that emphasizes ethical principles like integrity and national values like patriotism as the foundation for decision making and action. So the first principle is integrity. Integrity will always appear at the top as an ethical principle. Integrity. Now, upholding honesty. Integrity means upholding honesty, transparency, and accountability in all the aspects of the public service. That is the first value-based leadership principle, integrity. The second one is service to the public. Service to the public. Service to the public. Right? Prioritizing the needs and the interests of the public above personal gain or political considerations is the second principle of value-based leadership. Prioritizing service to the public. 3 is respect for human dignity. Respect for human dignity. This means treating all individuals with respect and dignity, regardless of their background, regardless of their personal characteristics, regardless of their tribe, their race, regardless of their religious inclinations, and so on. Respect for human dignity is a values-based leadership principle. 4, professionalism and excellence. Professionalism and excellence. It means striving for excellence in service delivery and maintaining high standards of professionalism in all aspects of work in the public sector. 5, accountability and transparency. Accountability and transparency is yet a values-based principle. That means taking responsibility for one's actions and being open and transparent in communication and decision-making processes. 6, fairness and equity. Fairness and equity is a values-based principle. And this means that ensuring that all citizens are treated equally and have equal access to public services and opportunities. Treating all equally without any form of discrimination, that is a principle. 7, patriotism and national values. Patriotism and national values. It means demonstrating loyalty and commitment to the nation and promoting national unity. Patriotism and national values. So these are 7 principles of values-based leadership. Then what are the benefits of value-based leadership? Benefits. The first benefit is that it improves public trust. This approach improves public trust. Value-based leadership improves public trust. When public servants act with integrity and prioritize the public interest, it builds trust and confidence in the government and its institutions. The members of the public are able to trust the government and to trust the institutions of government. 2, enhances service delivery. Value-based leadership fosters a culture of service excellence, leading to improved quality and efficiency in public service delivery. 3, ethical decision making. Value-based leaders make decisions that are consistent with ethical principles and national values, promoting fairness, equity, and justice. It also leads to reduced corruption. A strong ethical foundation helps to prevent corruption and promote transparency in the public sector. Then lastly, there is a benefit in relation to the staff. It motivates the staff or the public servants. Employees in the public service are more likely to be motivated and more likely to be engaged when they work in an environment where values are respected and upheld. So these are 5 benefits and 5 principles of value-based leadership. The first principle is integrity. Number 2, service to the public. Number 3, respect for human dignity. Number 4, professionalism and excellence. Number 5, accountability and transparency. Number 6, fairness and equity. 7, it promotes patriotism and national values. There are 5 benefits of value-based leadership. 1, improves public trust. 2, it enhances service delivery. 3, it encourages ethical decision making. 4, reduces corruption. and motivates public servants. That's the end of the lesson. Assignment 1. How does value-based leadership contribute to ethical decision-making and integrity in the public sector? 2. What are the key challenges in implementing value-based leadership in the Kenyan public sector, and how can these challenges be overcome? 3. What are the specific national values that should guide the conduct of public servants in Kenya, and how can these values be integrated into leadership practices? 4. How can values-based leadership be evaluated and measured to ensure its effectiveness in promoting ethical behavior and integrity in the public sector? In our next lesson, we are going to discuss professional codes and standards of governance in the public sector. Bye. Receive my greetings and welcome to the lesson, which is strategies for handling ethical and integrity challenges. We are going to discuss the strategies for handling ethical and integrity challenges. But before we get into the strategies, I think it's important for us to first of all highlight some of the ethical and integrity challenges in the public sector. So let's first identify some of the challenges. These are ethical and integrity challenges in the public sector. Now, ethical and integrity challenges are pervasive, you can say, in Kenya's public sector, which hinder the sector's efficiency, effectiveness, and public trust. And there are several key issues that contribute to the complex problem of ethics and integrity in the public sector in Kenya today. And the first challenge is corruption. 1. Corruption. Corruption. Corruption remains a significant challenge, manifesting in bribery, embezzlement, fraud, and abuse of office. And corruption erodes public resources. Corruption distorts decision-making processes. It also perpetuates inequality in the society. And the 2021 National Ethics and Corruption Survey by the Ethics and Anti-Corruption Commission found that bribery remains the most prevalent form of corruption in service delivery in Kenya. The second challenge is nepotism and favoritism. Favoritism and nepotism. Now, the practice of favoring relatives and favoring friends in appointments and promotions, often at the expense of merit, undermines the principles of fairness, the principle of equal opportunity, and so on. And that can lead to incompetent individuals occupying key positions, which then hinders service delivery and erodes public trust. In Kenya today, we have individuals holding office to which they do not qualify at all, and that is because of nepotism and favoritism, where individuals are appointed and promoted to positions which they do not merit. That is a challenge in public sector. There is also lack of transparency and accountability. Accountability and transparency. Lack of transparency and accountability is another challenge. There is opacity in decision-making processes and lack of access to information, which fuel suspicion and mistrust. And the absence of clear accountability mechanisms allows unethical behavior to go unchecked, further eroding public trust and confidence in the public sector. 4 is weak leadership and ethical culture. In the public sector in Kenya, we have a weak leadership and ethical culture. This is lack of strong ethical leadership at various levels of the public sector, which sets a poor example for employees. And when leaders engage in or tolerate unethical behavior, it creates a culture of impunity where corruption and other malpractices thrive. So when leaders are unethical, then it sets a very bad example, because remember, it all begins at the top. When the tone at the top is an ethical tone, then that is a challenge to integrity and ethics in the public sector. 5, inadequate enforcement of laws and regulations. Inadequate enforcement of laws and regulations. Now, despite the existence of laws and regulations that are aimed at curbing corruption, in Kenya there are many laws, there are many regulations that have been enacted to curb corruption and promote ethical conduct. But their enforcement remains weak, and that's why we have corruption being rampant in the public sector. And that is due to various factors, including inadequate resources. We have also political interference with the enforcement. There is also lack of political will to fight off these malpractices. So there is inadequate enforcement of laws and regulations, which is a challenge. 6 is conflict of interest. Conflict of interest. Public officials often face situations where their personal interests conflict with public duties. And without clear guidelines and robust conflict of interest policies, officials lack or make decisions that benefit themselves or their associates at the expense of public good, and that is a challenge. We've also many instances of abuse of power or abuse of office. The misuse of official authority for personal gain is another ethical challenge, and that can manifest in various forms, such as demanding bribes, using public resources for personal purposes, intimidating subordinates, and so on. Abuse of power. We have individuals in power who are abusing subordinates, who are misusing subordinates, and that is a challenge. All right? Intimidating subordinates, using the office for personal gain, abusing the office. This is yet another challenge in the public sector. So there are many challenges like inadequate remuneration also. Inadequate remuneration. We have some officers in the public sector who are not remunerated adequately. Low salaries, poor working conditions for the public servants can create incentive for engaging in corrupt practices to supplement their income, and that can also lead to low morale. It can lead to demotivation, further undermining ethical conduct. So these are some of the challenges of ethics and integrity in the public sector: corruption, nepotism and favoritism, lack of accountability and transparency, weak leadership and ethical culture, inadequate enforcement of laws and regulations, conflict of interest, abuse of power, inadequate remuneration. Now that you've understood the challenges, let's now discuss some of the strategies for handling ethical and integrity challenges. What are some of the methods or approaches that can be used to address these challenges in the public sector? Now, candidates, the public sector in Kenya, just like many others worldwide, faces numerous ethical and integrity challenges, which we have highlighted here. And these challenges hinder the efficient and effective delivery of public services. These challenges erode public trust. These challenges undermine the overall development agenda. And to address these challenges, there are various strategies that can be employed. One of them being the strengthening of legal and institutional framework. Strengthening the legal and institutional framework. Strengthening legal and institutional framework. And how can legal and institutional framework be strengthened? One way is to review and update legislation. Review and update legislation. Laws and regulations governing ethics and integrity in the public sector should be regularly reviewed and regularly updated to address emerging challenges and loopholes regularly, because the corrupt are always updating their corrupt ways, and therefore there has to be a way in which legislation is also updated and reviewed in order to take care of the emerging challenges and loopholes in legislation. Another way to strengthen legal and institutional framework is to empower oversight institutions. Empower oversight institutions like the Ethics and Anti-Corruption Commission, the Public Service Commission, the Office of the Auditor General, and so that these institutions are able to deal with the issues arising from unethical conduct from the public servants. You understand? Institutions should be empowered, should be adequately empowered by being adequately funded and empowered to carry out their mandates effectively. Another way to strengthen legal and institutional framework is to establish independent ethics bodies. Establish independent ethics bodies. Independent ethics bodies can provide impartial advice and guidance on ethical issues. They can investigate allegations of misconduct and recommend appropriate action. In Kenya, at least we have the EACC, which is an independent ethics body. That's how to strengthen legal and institutional frameworks. The second strategy to handle ethical and integrity challenges is promoting ethical leadership and culture. Promoting ethical leadership and culture. And ethical leadership and culture can be promoted through one, ethical leadership training. One way to promote ethical leadership and culture is by conducting ethical leadership trainings. These are leadership development programs which include strong emphasis on ethics and integrity. Leaders should be equipped with the knowledge and skills to create an ethical culture in their organizations. Another way is leading by example. Ethical leadership and culture can be promoted by leading by example. Leaders at all levels should demonstrate a commitment to ethical behavior and hold themselves accountable to highest standards of integrity. Leaders should hold themselves accountable to the highest level of integrity. That is one way to promote ethical leadership and culture. Leading by example. 3. Code of conduct and ethics. Code of ethics and conduct. Code of conduct and ethics. There has to be a clear and comprehensive code of conduct and ethics that is developed and communicated to all public servants. And the code should outline expected behaviors and provide guidelines on ethical dilemmas. That is how to promote ethical leadership and culture. The third point is through enhancing transparency and accountability. Enhancing transparency and accountability. And how do you enhance transparency and accountability? One way is to have open data and information sharing. Open data and information sharing. That means making information about government operations, budgets, and contracts easily accessible to the public, because that then can help to deter corruption and promote accountability. By having a system where information is shared openly, that enhances transparency and accountability. 2. Whistleblower protection. Those who blow the whistle should be protected. There has to be robust whistleblower protection mechanisms that should be put in place to encourage individuals to report unethical behavior within the public service. And that reporting should be without reprisals. Whistleblower protection. 3. Regular audits. There has to be regular audits and evaluations. Conduct regular audits and evaluations. There has to be regular audits and regular evaluations of public programs, of public projects, because that then can help to identify and address areas of weakness and potential misconduct. When audits are conducted, problems are revealed and corrective measures are taken in time. So that is the third strategy. We have explained how to enhance transparency and accountability. Moving on to point number 4. The fourth strategy is public participation and engagement. Public participation and engagement is another strategy. And how is this possible? This can be done through one way is through citizen citizen feedback mechanisms. Citizen feedback mechanisms. That means creating channels for citizens to provide feedback on public services, because that then can help to identify areas where improvements are needed and hold public servants accountable. There's another way is through participatory budget making. This is B, participatory budget making. Participatory budget making. Participatory or just participatory budgeting. That involves involving citizens in the budgeting process, which can then help to ensure that public resources are allocated in a way that reflects the priorities of the community. Now, the fifth strategy, number 5, is, remember, candidates, we are discussing strategies for handling ethical and integrity challenges. We've looked at strengthening legal and institutional framework, promoting ethical leadership and culture, enhancing transparency and accountability, and then public participation. Another way is through capacity building. And together with capacity building, we can add training. Capacity building and training can help handle ethical and integrity challenges. And how is that possible? One is through ethics training. Ethics training. Ethics training is one way to build the capacity and reduce or handle ethical and integrity challenges. There has to be regular ethics training for public servants, which will then help to raise awareness of ethical issues and provide them with the tools to make ethical decisions. 2, skills development. Development of skills. That means investing in skills development, which can help enhance the capacity of public servants to deliver quality services and resist corrupt practices. Train the civil servants, develop their skills so that they can deliver their services and do away with corrupt practices. That is point number 5, capacity building and training. Now, the next way to deal with the ethical and integrity challenges is number 6, technology and communication. Technology and communication. And how can technology and communication handle ethical and integrity challenges? One is through e-governance. Utilizing technology to streamline processes, to reduce bureaucracy and increase transparency, which can then help to minimize opportunities for corruption. One way to use technology is by having e-technology, which involves utilizing technology to streamline processes. This technology, e-governance, can reduce bureaucracy so that the human element is reduced from government processes, so that people do not deal with people when getting services, but people can engage with websites and other technologies to get government services. Like when applying for licenses, you just apply on e-citizen. When making payment, you make payment electronically. That can help to tackle ethical and integrity challenges. We can also take advantage of data analytics to handle ethical and integrity challenges. Using data analytics to identify patterns of unethical behavior. We can use data analytics to identify patterns of unethical behavior, which can help to target anti-corruption efforts more effectively. We can now target anti-corruption efforts by taking advantage of data analytics. Data analytics can help us identify patterns in corrupt practices and so on. So we've studied, or we've discussed 6 strategies for handling ethical and integrity challenges. That was a lesson. But before studying these strategies, we first of all identified the challenges. And one of the major challenges we talked about is corruption, nepotism and favoritism, lack of transparency and accountability, weak leadership and ethical culture, inadequate enforcement of laws and regulations, conflict of interest, abuse of power, inadequate remuneration. These are some of the ethical and integrity challenges in the public sector. We've gone ahead to discuss the strategies for handling these challenges, and we've grouped these strategies in 4 broad categories. One is strengthening legal and institutional frameworks. We've identified 3 ways to strengthen legal and institutional frameworks. One is reviewing and updating legislation, empowering oversight institutions like funding, capacity building, and so on, establishing independent ethics bodies. Then the second category is promoting ethical leadership and culture. Promoting ethical leadership and culture. One way to promote ethical leadership and culture is by having ethical leadership trainings, leading Greetings and welcome to the lesson. Today we are going to discuss professional codes and standards of governance in the public sector. Professional codes and standards of governance in the public sector. Now, these codes and standards are essential for ensuring ethical conduct, accountability, transparency, and effective service delivery. The codes and standards provide a framework for public servants to uphold the highest levels of integrity and professionalism in their duties. And the key professional codes and standards in Kenya include the Constitution of Kenya, the Public Officer Ethics Act, the Leadership and Integrity Act. We have the Public Service Commission Code of Regulations, and we also have regulations that have been developed by the EACC. So let's briefly explain some of these codes and standards, beginning with the Constitution of Kenya of 2010. Constitution of Kenya 2010 is the supreme law of the land, and it sets out the fundamental principles and values that guide public service. This constitution emphasizes integrity, transparency, accountability, and also public participation in government. The second standard is the Public Officers Ethics Act. The Public Officers Ethics Act outlines the ethical conduct expected of public officers, including avoiding conflicts of interest, declaring wealth, and refraining from corrupt practices. Public Officers Ethics Act of 2003. Number 3 is the Leadership and Integrity Act. The Leadership and Integrity Act that was enacted in 2012 is an act of parliament that establishes the legal framework for promoting ethical leadership and integrity in the public service. This act outlines the requirements for leadership positions, including the need for integrity, the need for competence, and suitability. Leadership and Integrity Act. We have another code that has been developed by the Public Service Commission. Public Service Commission Code of Conduct. The Public Service Commission Code of Conduct and Regulations. Code of Regulations. Public Service Commission Code of Regulations has been developed, and it outlines the standards of conduct for public servants. It gives the details, all right? And it covers areas such as discipline, performance management, conflict of interest, and so on. Then lastly, Code of Conduct and Ethics for Public Officers. Code of Conduct and Ethics for Public Officers is a code that is developed by the Ethics and Anti-Corruption Commission, which provides detailed guidelines on ethical conduct for public officers. This code covers issues such as gifts and hospitality. It covers areas such as the use of public resources and the relationship that the public servants have or should have, the kind of relationship between the public servants and the public sector, the relationship with the public sector. That is covered in the Code of Conduct and Ethics for Public Officers that has been developed by the Ethics and Anti-Corruption Commission. Then we have professional codes of conduct. Professional codes of conduct. Professional codes of conduct from different professional bodies. There are various professions within the public sector, such as accountants. We have professionals like engineers. We have doctors, lawyers who work within the public sector. And these professionals have their own codes of conduct that guide their ethical and professional behavior. Like the accountants, we have the Institute of Certified Public Accountants, which regulates the ethical conduct and behavior of all accountants, those who work in the private sector as well as those who work in the public sector. So that's all for professional codes and standards of governance in the public sector. We've outlined some of the professional codes and standards of governance in the public sector, beginning with the Constitution, the Public Officers Ethics Act, the Leadership and the Integrity Act, the Public Service Commission Code of Regulations. 5 is the Code of Conduct and Ethics for Public Officers that is developed by the Anti-Corruption Commission. Then we have the professional codes of conduct within the public sector. That is all for the professional codes and standards of governance in the public sector. Assignment 1, discuss the different professional codes and standards of governance applicable to the Kenyan public sector. 2, how effective are these codes and standards in promoting ethical conduct and preventing corruption in the public sector? 3, what are the challenges in enforcing professional codes and standards of governance, and how can these challenges be addressed? 4, what role can professional bodies and associations play in promoting adherence to professional codes and standards in the public sector? In our next lesson, we are going to study the framework for enforcement of ethics and integrity in the public sector. Bye. Receive my greetings and welcome to the Public Sector Governance, Policy and Administration session. Today we begin on the next chapter, which is Leadership, Integrity and National Values in Public Service. Leadership, Integrity and National Values in Public Service. These are 3 areas. Leadership, one is leadership. 2, that is leadership in public service, integrity in public service, and national values in public service. We are going to tackle each and every aspect of the subtopic, leadership, integrity, and national values. Let us begin with leadership in public service. Leadership in public service in Kenya. Now, leadership in the Kenyan public service has many aspects. It is a multifaceted issue that has evolved over time, and it plays an important role in driving public sector reforms, ensuring efficient service delivery, and upholding the principles of good governance. We will begin by identifying some of the aspects of leadership in Kenya public service. we will identify the key aspects. The first one being ethical leadership. Ethical leadership. Now, ethical conduct is a cornerstone of effective public service leadership, and leaders are expected to uphold high standards of integrity, transparency, and accountability in their decision making and actions. And here in Kenya, we have the Ethics and Anti-Corruption Commission, which plays a crucial role in enforcing ethical standards and combating corruption in the public sector. So the first aspect of leadership in public service in Kenya is ethical leadership. The second aspect is transformative leadership. Transformative leadership inspires and motivates teams to achieve a shared vision. Transformative leaders foster innovation, creativity, and continuous improvement in the public service. So the Kenyan government has recognized the importance of transformative leadership and has implemented various programs to develop leadership capacity within the public service. Transformative leadership is one that inspires and motivates the public servants to achieve a shared vision. The third aspect of leadership in public service is citizen-centric leadership, or citizen-centered, citizen-centric leadership, citizen-centric leadership. Now, public servants are ultimately accountable to the citizens they serve. So effective leaders prioritize the needs and interests of the citizens, ensuring that public services are accessible, affordable, and responsive to the diverse needs of the Kenyan population. And that involves active engagement with the communities and stakeholders to understand their concerns and their aspirations. Citizen-centered leadership is an aspect of leadership in public sector. The fourth aspect, performance management. Performance management. Now, performance management systems are essential for holding public servants accountable for their performance. And effective leaders set clear performance expectations, provide regular feedback, and also reward high-performing individuals and teams. And that creates a culture of excellence and continuous improvement within the public service. Public performance management. Now, what are the challenges of public service leadership in Kenya? Challenges. What are some of the challenges to public service leadership in Kenya? Now, public service leadership in Kenya today faces a myriad of challenges that hinder its effectiveness and efficiency in delivering services to the citizens. And these challenges are many and interconnected, stemming from various factors, including one, political interference and patronage. Stemming from number one, political interference and patronage. Political interference is a persistent challenge in Kenya's public service leadership, and it often manifests as undue influence in appointments, promotions, and decision-making processes. Patronage, where leaders prioritize loyalty over competence also undermines meritocracy. It undermines professionalism. All right? And that's why you may find that in Kenya, sometimes there is no meritocracy, there is no professionalism because of patronage, which is a challenge in the public service. Patronage is where leaders prioritize loyalty over competence, and that undermines professionalism, and that is a challenge today. 2, corruption and mismanagement. Corruption and mismanagement are challenges in the public service. Corruption remains a significant problem in Kenya's public sector. It erodes public trust, it diverts resources from essential services, and perpetuates inequality in the society. Mismanagement, often linked to corruption, leads to inefficient use of resources, and it also leads to poor service delivery. Corruption and mismanagement. There is also the challenge of inadequate capacity and skills. Inadequate capacity and skills. Many public service leaders lack the necessary skills and knowledge to effectively manage complex issues and delivery services in a rapidly changing environment. And that is exacerbated by limited investment in training and development programs. So you have people working in the public service without skills, without the capacity, and this inadequacy is exacerbated by lack of training and lack of development programs in the public sector. So these are challenges: inadequate capacity and skills. Number 4, bureaucratic inertia and resistance to change. Bureaucratic inertia and resistance to change is another challenge in the public service leadership. Now, the Kenya public service is often characterized by bureaucratic inertia with resistance to change and innovation, and that hinders the implementation of reforms and the adoption of new technologies and practices that could improve service delivery. Bureaucratic inertia and resistance to change. 5, weak accountability and transparency. Weak accountability and weak transparency. Now, accountability mechanisms are often weak, making it difficult to hold public service leaders responsible for their actions. There is also lack of transparency in decision making and resource allocation, which further undermines public trust and confidence in the public service. Weak accountability and transparency. 6, inadequate resources and infrastructure. Inadequate resources and infrastructure are challenges in the public sector. Limited financial resources and inadequate infrastructure, particularly in rural areas, pose significant challenges to effective service delivery, and that can lead to understaffing, lack of essential equipment, and poor working conditions, which can demotivate public servants and hinder their performance. There are also 7 social cultural factors. Social cultural factors. These are deep-rooted social cultural factors such as tribalism and nepotism, which can influence leadership choices, and they can also influence decision-making processes. So these factors can perpetuate inequality and hinder merit-based appointments. We are talking about social cultural factors which can hinder merit-based appointments and promotions. So Kenya is deeply rooted into tribalism and nepotism, which influences choices, influences who works in the public sector, and that has hindered proper service delivery. So these are 7 challenges in the public sector. Let's now discuss integrity. Integrity. We've done with leadership. Integrity in the public service in Kenya. Integrity. Now, integrity in public service is a critical pillar of good governance and sustainable development. It refers to the adherence of high moral and ethical principles. It refers to honesty, transparency, and accountability in the conduct of public affairs. And it is essential for building public trust. It is essential for ensuring efficient and effective service delivery, and also promoting a just and equitable society. That is integrity. Key elements. What are the key elements of integrity in the public service? The first key element is honesty and truthfulness. Honesty and truthfulness is the first key element of integrity in the public service. Public servants are expected to be honest. They're expected to be truthful in their dealings with the public, with their colleagues, and their superiors. And that involves providing accurate information. That involves avoiding lies, avoiding deception, and disclosing conflicts of interest. That's the meaning of being honest and truthful. The second key element is impartiality and fairness. Impartiality and fairness, being impartial, being fair. Public servants must treat all individuals equally and fairly, without discrimination, without favoritism, based on their face value. All right? They should not treat people based on ethnicity, based on their gender or religion or other personal attributes. And decisions should be based on merit and in accordance with the law. So if you are a public servant, you are required to treat all members of the public with impartiality and fairly, without discrimination, without favoritism, regardless of personal attributes, regardless of their ethnicity, regardless of their religion, regardless of their gender. Impartiality and fairness. The third key element of integrity, number 3, is accountability and transparency. accountability and transparency. Public servants are accountable for their actions and decisions and must be transparent in their dealings with the public. And that includes providing clear information about their work, disclosing potential conflicts of interest, and being open to scrutiny. So if you're a public servant, you are required to ensure that you are open to scrutiny, that your actions can be queried, your decisions can be held to scrutiny by the by different bodies of the government or by the public. So accountability and transparency is a key element of integrity. The fourth element is respect for rule of law. Respect for rule of law. Respect for rule of law. Public servants must uphold the rule of law and respect the legal framework within which they operate, and that includes complying with laws, complying with policies, and ensuring that their actions are consistent with the principles of good governance. That's the fourth element, respect for rule of law. 5, professionalism and competence. Professionalism and competence is a key element of integrity. Public servants should strive for excellence in their work and should also maintain high levels of professionalism, and that includes acquiring and maintaining the necessary skills and knowledge to perform their duties effectively and efficiently. Being competent. Make sure that if you're a public servant, you are well trained, and if you're not trained, make sure you upgrade your skills so that you provide your services with the highest level of excellence. That is professionalism and competence. So these are 5 key elements of integrity in the public service. 1, honesty and truthfulness. 2, impartiality and fairness. 3, accountability and transparency. 4, respect for the rule of law. 5, professionalism and competence. So let's now analyze the national values in public service. National values in the public service. Now, national values in the public service in Kenya are enshrined in the Constitution of Kenya and further elaborated in various laws and policies. These national values serve as guiding principles for the conduct and behavior of public servants, and they aim to foster a culture of integrity, professionalism, and service to the public. We'll analyze a few of these national values, and the first one is patriotism. Patriotism is the first national value in the Kenyan Constitution. That is Article 10. Article 10 of the Kenyan Constitution on national values and principles of governance. It reads that the national values and principles of governance in this article bind all state organs, state officers, public officers, and all persons whenever any of them applies or interprets this constitution, and next applies or interprets any law, or makes or implements public policy decisions. The national values and principles of governance include A, patriotism. So patriotism is the first one. Patriotism. Patriotism. You understand? Patriotism is the first value, and public servants are expected to demonstrate loyalty and commitment to the nation. Loyalty and commitment to the nation is being patriotic. Do you understand? Patriotism, national unity, non-discrimination, patriotism, national unity, non-discrimination, and respect for diversity. These are national values. You understand? Public servants are required to demonstrate loyalty and commitment to the nation. They are required to promote national unity and also to respect diversity, non-discrimination, and respect for diversity, or respect for the diversity of the Kenyan society. And they should treat all citizens equally without any form of discrimination. That is a national value. The next one is human dignity. Human dignity. Human dignity. Together with equity, social justice, human dignity, social justice, inclusiveness, equality, and so on. Public servants should prioritize the welfare of the public and uphold the dignity of all individuals. They should promote equality, they should promote equity, they should promote social justice. They are required to promote inclusiveness in public service delivery, and to ensure that all citizens have equal access to public services and public opportunities. 3 is integrity. Another national value is 3, integrity, accountability, transparency. Integrity, accountability, transparency, and responsible use of resources. Integrity is a fundamental value in public service, and public servants should act with the honesty, integrity, and transparency in their dealings with the public and their colleagues. That should be, they are required to be accountable for their actions and accountable for their decisions and use of public resources responsibly and efficiently. The 4th national value, servant leadership. Servant leadership. And this servant leadership is required from all public servants, and public servants are expected to demonstrate servant leadership, prioritizing the needs of the public and serving with humility and dedication. They should maintain high standards of professionalism, ethics, and competence in their work, continuously seeking to improve their skills and knowledge. Servant leadership. 5, collective responsibility. Collective responsibility. Public servants should work collectively and collaboratively and share responsibility for achieving common goals. They should support each other and work together to provide efficient and effective services to the public. So, candidates, these are 5 national values. There is the last one here in the Constitution is sustainable development. Sustainable development is a national value. That is to say that one should ensure that their decisions that they make are not meant to meet only the short-term needs, but also the long-term needs, taking into consideration the needs of future generations. So public servants should shy away from what we call short-termism. Short-termism. So sustainable development is a national value. National value. We've discussed human dignity, patriotism, good governance, integrity, transparency. So these are national values. And candidates, the national values are not merely aspirational. They are not merely aspirational, but are legally binding on all public servants. These are not things that the public servants should aspire to attain. No, these are values that are legally binding on all public servants. And the Public Service Commission is responsible for enforcing these values and promoting ethical conduct in the public service. So the PSC has developed a code of conduct and ethics for public officers that outlines the expected standards of behavior and the consequences of breaking these standards. So by upholding these national values, public servants can build trust, they can enhance service delivery, and contribute to the development of a just and equitable society. So the values candidates provide a framework for ethical decision making and public and a guide. These values provide a guide to the public servants in their daily interactions with the public and in the daily interactions with their colleagues. So that is the end of the lesson on leadership, integrity, and national values in public service in Kenya. We began by analyzing aspects of leadership in public service, and we identified 4 aspects: ethical leadership, transformative leadership, citizen-centric leadership, and we have performance management. We also identified 7 challenges in public service. One is political interference and patronage. Number 2, corruption and mismanagement. Number 3, inadequate capacity and skills in the public service. Bureaucratic inertia and resistance to change. 5, weak accountability and transparency. 6, inadequate resources and infrastructure. And social cultural factors. We went further to define integrity in the public service and identified 5 key elements of integrity. 1, honesty and truthfulness. The second one is impartiality and fairness. Number 3, accountability and transparency. Number 4, respect for the rule of law. And lastly, professionalism and competence. In closing, we've discussed the national values in Kenya. 1 is patriotism, national unity, non-discrimination, and respect for diversity. Number 2 is human dignity, which can be actualized through equality, social justice, inclusiveness, and equality, equity, and equality. Number 3 is integrity, accountability and transparency, servant leadership, collective responsibility, and sustainable development. Here is your today's assignment on leadership, integrity, and national values in public service. 1, How does political interference undermine effective leadership and integrity in the public service, and what strategies can be implemented to mitigate this challenge? 2. In what ways can public sector leaders effectively model and promote national values such as patriotism, integrity, and social justice within their organizations? 3. How does the lack of ethical leadership contribute to the erosion of integrity and national values in the public service? And what measures can be taken to foster ethical leadership? 4. What role does citizen participation play in promoting leadership, integrity, and national values in the public sector, and how can this participation be encouraged and strengthened? In our next lesson, we will study and discuss principles of corporate governance. Bye. Hello and welcome back to the lesson. Today we are going to discuss the framework for enforcement of ethics and integrity in the public sector in Kenya. Framework for enforcement of ethics and integrity in the public sector. Now, the framework for enforcing ethics and integrity in Kenya's public sector is multifaceted, comprising of laws, institutions, policies, and practices that are aimed at promoting ethical conduct and preventing corruption, ensuring accountability among the public servants. In this lesson, we will focus on the legal framework and the institutional framework for enforcement of ethics and integrity in the public sector. Let's begin with the legal framework. The legal framework or guidelines. The legal framework. Now, the first framework or guidelines stems from the Constitution. The Constitution of Kenya 2010 is the supreme law of the land and sets the foundation for ethical governance. It outlines fundamental principles and values that guide public service, or such as the integrity, transparency, accountability, public participation, and so on. If you look at the Constitution, it has laid out the principles that public servants must adhere to in the conduct of their duties. So that's the first legal framework, the Constitution of Kenya. It outlines principles, guiding principles like transparency, public participation, accountability, integrity, and so on. Then the second legal framework is the Public Officer Ethics Act. The Public Officer Ethics Act of 2003. Public Officer Ethics Act. Now, this act provides a comprehensive framework for ethical conduct in the public service. It outlines the specific codes of conduct, conflict of interest rules, financial disclosure requirements for public officers. The Public Officer Ethics Act. The third legal framework is Leadership and Integrity Act. This was enacted in 2012. This one is 2003. Leadership and Integrity Act. This act strengthens the legal framework for promoting ethical leadership and integrity in the public service, and it establishes procedures for vetting public officers for integrity and suitability for leadership positions in Kenya. Then apart from this legal framework, we have institutional framework. Institutional framework. Institutional framework. Institutions. We have various institutions that help in the enforcement of ethics and integrity in Kenya. The first one is Ethics and Anti-Corruption Commission. The EACC, Ethics and Anti-Corruption Commission. Now, this commission, its primary mandate is to combat corruption and promote ethics in the public sector. The commission investigates and prosecutes corruption cases. The commission educates the public on ethical values. It also develops anti-corruption policies. That's the first institutional framework. The second institutional framework is the Public Service Commission. Public Service Commission. Public Service, the Public Service Commission. Now, the Public Service Commission is responsible for ensuring that public servants adhere to the Code of Conduct and the Code of Ethics. It has the power to investigate and also the power to discipline public officers who violate the code. 3, Office of the Auditor General. Office of the Auditor General. Office of the Auditor General, the OAG. The OAG's office audits the accounts of public entities and reports on their financial management and performance. And this auditing helps to ensure accountability and transparency in the use of public resources. The Office of the Auditor General. 4, Commission of Administrative Justice. The Commission on Administrative Justice. Commission on Administrative Justice. Commission on Administrative Justice. Commission on Administrative Justice, also known as the Ombudsman, investigates complaints of maladministration and injustice in the public sector. This commission helps to ensure that public servants act fairly and impartially. Commission on Administrative Justice. So this is the legal framework and the institutional framework. We also have the policy framework for enforcement of ethics and integrity in the public sector. Policy framework. Let's analyze the policy framework. Policy framework. Now, the first guideline is the National Anti-Corruption Policy. In Kenya, we have the National Anti-Corruption Policy. The National Anti-Corruption Policy. This policy outlines the government's commitment to combating corruption and promoting ethics in the public sector. It provides a framework for action for various stakeholders, including government agencies, the civil society organizations, as well as the private sector. The National Anti-Corruption Policy is the first policy framework on the enforcement of ethics and integrity in the public sector in Kenya. The second policy framework is the Code of Conduct and Ethics for Public Officers. Code of Conduct for Code of Conduct and Ethics for Public Officers. This code is developed by the Ethics and Anti-Corruption Commission, and it provides detailed guidelines on ethical conduct for public officers. It covers issues such as gifts and hospitality, use of public resources, issues to do with the relationship with private sector, and so on. These are two examples of two public policy framework for enforcing ethics and integrity. We have other mechanisms like whistleblower, other mechanisms like the whistleblower protection. Whistleblower protection. The whistleblower protection. The Witness Protection Act provides protection to individuals who report corruption and other unethical practices in the public sector. That is one other mechanism for enforcing ethics and integrity in the public sector. Public participation, very key. Public participation. Public participation. Now, the Constitution guarantees public participation in governance processes, and that provides an avenue for citizens to hold public servants accountable and demand ethical conduct. Then there is the role of media. 3, media and civil society. The media and the civil society. Now, the civil society organizations and the media also play a crucial role in exposing corruption and advocating for ethical governance. Media and the civil society. So that's all we can say for today as far as the framework for enforcement of ethics and integrity in the public sector goes. We've categorized the framework into 4. One is the legal framework. Under the legal framework, we've discussed the Constitution of Kenya, which lays the foundation for ethics and integrity in the public sector. There are principles that are outlined in the Constitution that public servants must adhere to in the conduct of their duties. The second legal framework, the Public Officers Ethics Act of 2003. Number 3, we have the Leadership and Integrity Act. Then we also have institutions that are key in enforcing ethics and integrity in the public. One is the Ethics and Anti-Corruption Commission. The second one is the Public Service Commission. The third one is the Office of the Auditor General. Then we have the Commission on Administrative Justice, the Ombudsman, also known as the Ombudsman. Policy frameworks. We've, in today's lesson, studied 2 policy frameworks. One is the National Anti-Corruption Policy. The second one is the Code of Conduct and Ethics for Public Officers. Then we have other mechanisms like the whistleblower protection, the public participation, and media and society. That's all. Assignment 1. Describe the institutional framework for enforcing ethics and integrity in the Kenyan public sector, including the role of the EACC, the Public Service Commission, and the Office of the Auditor General. Number 2, what are the strengths and weaknesses of this framework and how can it be strengthened to enhance its effectiveness? 3, what role does the legal framework play in enforcing ethics and integrity, and are there any gaps or inconsistencies that need to be addressed? 4, How can citizen participation and whistleblowing be effectively integrated into the framework for enforcement of ethics and integrity? In our next lesson, we are going to discuss the strategies for handling ethical and integrity challenges. Bye. I greet you all and welcome you to the lesson. Today we will discuss corporate relationships in the government. Corporate relationships in the government. The subject is public sector governance, policy, and administration. Now, corporate relationship in government refers to the interactions between various entities within the public sector, as well as with the external stakeholders like the private companies, the civil society organizations, and international partners. So these relationships are governed by laws, they are governed by regulations, and they also may be governed by policies aimed at ensuring transparency, accountability, and ethical conduct. Now, the key corporate relationships in the Kenya government include the interagency relationships. Interagency relationships. Number one is the interagency relationships. The interagency relationships. Now, government ministries, departments, and agencies often collaborate to achieve common goals and to deliver services effectively. And such collaboration involves sharing information, sharing resources, sharing expertise, and coordinating activities to avoid duplication and ensure efficiency. So this is the first relationship, interagency relationships. These are government ministries interact with the government departments as well as government agencies, what we normally refer to as the MDS. Another set is the government-owned corporations. Government-owned corporations. Now, the Kenya government owns and operates various corporations in sectors like energy, transport, finance, manufacturing, and so on. And these government-owned corporations have their boards of directors and management teams, but are ultimately accountable to the government through the relevant ministries. So there is that corporate relationship between the government-owned corporations and government ministries, departments, and agencies. 3 is a public-private partnerships, the PPPs, public-private partnerships. Now, the government increasingly engages in public-private partnerships to leverage private sector expertise and resources for infrastructure development and service delivery. And these partnerships are